if you compare against the put. So it tells you that at the higher level of around 24,150, there's a major call lighting, and they believe that it's very unlikely that Nifty will rise above that level or say above 24,200. One stock that has been the focus for the last few days, has been the weak and has been dragging market or say Nifty, is Reliance. Yesterday intraday it had slipped below the level of 1300, but at the end managed to close around that level. What about FIs? So in the index futures, they remain on the selling side. Yesterday also they have sold almost 1800 crore, but positive parties on the stock futures, they have bought almost 2300 crore. Now they have added long positions of almost 9300 contracts, but the worst parties on the short side addition is more than 19,000 contracts. But nevertheless, FI's long exposure has increased or seen a minor increase to 17%. That's the highest we have seen in the last 2 months. Come to the options data. As I have told you, on the put side, 23,900 and 23,850 have seen maximum increase in the open interest. Also, premium for both these put options has seen a rise. On the call side, 24,000 and 24,050 were the most active ones. So support 50 DMA of 23,850, resistance 24,150. That's your 100 DMA. Coming to stocks, keep an eye on all the aluminium names, Hindalco, Vedanta, because aluminium prices have been moving lower and LIC has been seeing fresh longs, and all the healthcare stocks have been in the focus for the last few days, and Max Health is looking very strong.
Okay, so Darshan, thank you so much for that. We'll keep an eye out on those important levels there in the world of FNO as well. So thanks so much for that. Let's move on and talk about private banks in more detail, right? They're going to be in focus today as a whole host of leadership changes take place. The board of HDFC Bank has appointed former DFS Secretary Rajiv Kumar as part-time chairman. Ritu joined us to give us more details on this one. Ritu, good morning.
Hi, good morning, Winnie. You know, HDFC Bank has ended months of speculation over its leadership, finally naming former Finance Secretary and ex-Chief Election Commissioner of India, Rajiv Kumar, as its next permanent chairman. Now, Rajiv Kumar is going to succeed Atanu Chakravarti, who, remember, stepped down abruptly in March. And then you had, KK Mistry stepping in as the interim chairman since then. But of course, now this permanent chairman has come in. The appointment is going to be for a 3-year term, subject to Reserve Bank of India's approval. Rajiv Kumar has also been appointed an additional independent director for a 4-year period, and the bank is going to seek shareholder approval for the appointment at its AGM on the 5th of August. Now, you have yet another seasoned bureaucrat who's coming over to take the chair at India's largest private sector bank. In fact, Rajiv Kumar and Atanu Chakravarti even overlap briefly at the finance ministry. So an interesting appointment there, to say the least. In terms of who Rajiv Kumar is, he's a 1984 batch IAS officer. He later went on to become India's 25th Chief Election Commissioner and oversaw the 2024 Lok Sabha elections. He's also served on RBI's Central Board, the Financial Stability and Development Council, and on the boards of SBI and NABARD. And of course, like we said earlier, he was the DFS secretary as well. Now, for HDFC Bank, this is a huge, appointment because it marks a governance milestone, bringing a permanent chairman on board after what was months of uncertainty following the way Atanu Chakravarti exited with those words. And, with this out of the way, as we have been reporting right here on CNBC TV 18, it also paves the way for the reappointment of CEO Sashidhar Jagdishan. So, big developments overnight at HDFC Bank.
Absolutely, Ritu. But stay on and tell us more about the CFO reshuffle that we're seeing at banks as well.
Well, that's an interesting one, Rachna, because it's turning out to be this game of musical chairs among CFOs in the private banking space. And we at CNBC TV 18 have been reporting every move. First, you have HDFC Bank that officially confirmed our news break. It appointed Puneet Sharma as its next Chief Financial Officer. He will become CFO designate from the 1st of September and then formally take charge on the 1st of December, succeeding Srinivasan Vaidyanathan, whose current term at HDFC Bank as its CFO ends in October. Now, Puneet Sharma has served as Axis Bank's Group CFO since March of 2020. Before that, he spent about 12 years at Tata Capital, including as the Group CFO there, so brings relevant, deep experience across, the services sector here. We were also the first to report Puneet Sharma's move from Axis to HDFC Bank, and like I said, now it's been confirmed. But the story hardly ends there. You have Bandhan Bank, interestingly, that also announced yesterday that its CFO Rajiv Mantri had resigned, saying he is leaving to pursue another career opportunity, and that other career opportunity we've been given to understand is Axis Bank. He's going to succeed Puneet Sharma there, taking on as the next chief financial officer. We, of course, have reached out to both, Rajiv Mantri as well as the two banks involved, but neither have commented on our story. But if the appointment does go through, it's going to complete what is going to be a three-way CFO shuffle. I mean, you have Puneet Sharma moving from Axis to HDFC Bank, Rajiv Mantri moving in to fill in that position from Bandhan Bank to Axis Bank, and now, of course, Bandhan Bank will have to search for its next CFO.
Ritu, absolutely. We'll wait out for the details coming in on now who comes in as the CFO for Bandhan Bank as well. But thanks so much for those details on the private bank front. The CFO is coming in there. Thanks so much. But on that note, we'll tip into a very short break. After the break, we'll get you cues in the world of US markets, what's happening on the Wall Street. Stay tuned in.
Welcome back. You're watching Power Breakfast on CNBC TV 18. On to the updates from West Asia then. US President Donald Trump claims Iran has requested a meeting following the exchange of strikes last week and says it will take place in Doha today. When speaking to reporters, he added that the meeting may or may not be important. Listen in.
There'll be a meeting on that tomorrow in Doha, and they're going to Qatar. I think they've already left, or they're just about getting ready to leave. So we'll see how that goes. But we're doing very well on that front. But the meeting in Doha is going to be perhaps important, perhaps not. We're going to find out. But we're winning militarily. It's almost won militarily, I would say. And it's really very simple. It's the denuclearization of Iran. We don't want them to have a nuclear weapon, and they're not going to have a nuclear weapon. And they've agreed to that, in all fairness.
On the other hand, Iran's foreign ministry says that there are no planned meetings at any level with the United States in the coming days. But it says an Iranian expert delegation will be dispatched to Doha with this week to follow up on the implementation of the Memorandum of Understanding signed on the 17th of June, including the release of frozen Iranian assets. Elsewhere, Iran's president slammed the US unreasonable boasting and unfounded threats and says that Tehran will fulfill its obligations under the MOU if Washington adheres to it.
All right, while all of that is going on, oil prices are holding gains ahead of the US-Iran talks. But to get us all the updates from the commodity space, we have Manisha Gupta joining in now. Good morning, Manisha.
Morning, and thank you so much for that. Well, yes, it is going to be very important as the markets resume and focus on the US-Iran peace deal in Doha. Iran has maintained that it intends to continue overseeing traffic through Strait of Hormuz, a proposal which is opposed by the US, Europe, and the Gulf Arab states as well. So it's going to be quite interesting on how that meeting goes through. In the meanwhile, you have seen the crude oil prices decline by 23% for this current quarter. The declines also have come in for the precious metals and the base metal prices. Gold, for example, has declined 2% overnight, and with that, it's headed for an 11% decline for the month of June. Silver is trading at December lows, also headed for a 20% decline for the month of June. The declines also have come in for copper, which is down on profit taking. All of these markets are now awaiting the U.S. monthly jobs data. That would give you further direction.
Okay. Manisha, thank you so much for updating us of what's happening in the world of commodities this morning. But here is some opinion from Kevin Hassett, Director of the White House National Economic Council, on the outlook for oil prices. Listen in.
So the way to think about it is that we've got pipelines in Saudi Arabia and UAE that before the war were operating really below capacity. And because the straits were closed, then they've come up with ways to operate closer to capacity. There's been a big drawdown in inventories globally. And so I think that basically once traffic is really moving, we go back to more than 100 ships a day, then you're going to see prices even come down from there because there's going to be so much oil pouring out. And so, you know, in the meantime, you know, right now we've got the memorandum of understanding. We've got, you know, Vice President is on the case, and the President has said that we're going to have some more talks tomorrow. My view is that what's going to happen between now and the 60-day memorandum of understanding discussion is that they'll be testing the resolve of the President now and then.
All right, that's Kevin Hassett. The meeting may or may not happen is what US President Donald Trump has said. But to get you all the updates from the US market, though the futures have somehow slipped into the red, but Wall Street ended higher on Monday with the Dow Jones closing above the 52,000 mark for the first time. Nasdaq led the gains while the S&P 500 also ended firmly in positive territory. CNBC's Brandon Gomez gets us a wrap of all the action on Wall Street.
Markets were higher across the major indexes in Monday trading, with the Dow closing at a record high and its biggest quarterly gain since 2022. The Dow climbed 306 points, the S&P 500 rose 86 points, and the Nasdaq was higher by 522 points. The Supreme Court today ruled that President Trump does not have the authority to fire Federal Reserve Governor Lisa Cook for now, but left open the possibility of firing her in the future. In a 5-4 ruling, the court did not rule on whether Trump has the ability to fire Cook or another member of the central bank, but in Chief Justice John Roberts' majority opinion, he wrote that independence and, quote, the appearance of independence are key to the design of the Federal Reserve. Comcast shares ending the day about 4% higher after initially rising more than 20% after announcing plans to split its cable business from its media and entertainment assets. The move, which is expected to be completed in about a year, will create one company anchored by Comcast's cable, wireless, and business services arm, and another that includes NBC, Peacock, and Universal theme parks, film, and TV studios. The announcement comes less than a year after Comcast spun off its cable TV channels into a separate company, Versant, which is the parent of CNBC. That is what is happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But on that note, we're going to slip into a very short break. After the break, we'll talk about what's happening in the world of AI and technology. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech in our special segment AI Pulse. We have Rachna joining us for that. Rachna, over to you again.
Well, first up is Apple accusing India's antitrust regulators of copy-pasting rivals' claim. According to Reuters, Apple said investigators reached their findings without running their own analysis and called for them to be quashed. The 2024 CCI report found Apple engaged in abusive conduct on the App Store and wrongly forced developers onto its payment system. A hearing is set for July 21, so we'll have to look out for that one. Staying with India, then Kunal Shah, the Cred founder and first Indian to be running WhatsApp, has now announced his first major update at the app. WhatsApp will let people chat using usernames without handing over a phone number. Reservations open this week with a wider rollout expected later this year. There is no public directory, so if someone needs your exact username, they have to reach you. The AI reset is reshaping how India's biggest IT firms grow. Money Control reports that the top 10 IT companies spent close to $4.5 billion in acquisitions in the first half of 2026, buying AI and cloud capability rather than building it in-house. Mid-caps like Coforge are outpacing larger peers, some prioritizing deals over dividends. The logic here is speed, because it is faster to buy talent than to train it. To US markets then, Alphabet has joined the Dow, replacing Verizon, rising around 4% on day one. But the badge hides a rough month. The stock is tracking its worst stretch since early 2025, with 6 of the past 7 weeks in the red. Investors are focused on AI execution, compute shortages, cheaper Chinese models and talent leaving DeepMind. Back to Apple then, and in a shift in security, it told Reuters it is pushing out fixes faster on their own instead of bundling them onto the next big iOS release. The reason is AI, which Apple says is speeding up the tools attackers use. Monday's 26.5.2 update sets this pattern. And in a reality check to end this on, Ford has brought back its veteran engineers after leaning too hard on artificial intelligence. Over 3 years, it rehired or promoted around 350 staff members after automated quality systems fell short. It worked. Ford topped the JD Power initial quality study for the first time in 16 years. So clearly AI is not going away, but it is now trained by the expert it once tried to replace. That's all we have from the world of AI for now, but we'll get you more updates through the day.
Okay, thank you so much for that, Rachna. But with that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. Or at least we look out of our windows here in Mumbai and it's raining. It's a little more than pitter-patter. A little better than yesterday, but not enough. I'm Prashant. With me, my colleagues Mangalam and Reema. Guys, hi, morning.
Hi, good morning. It's a Tuesday morning, but it's also the Nifty monthly expiry, month end and quarter end and half year end all put together. So the last 1 hour is going to be very important.
Last 1 hour is going to be extremely important. But the important part is that, it's still more of the same. So it was pitter-patter. A little more than that is a splatter, I guess. So that's what's taking place in the market as well right now. We're in that range. Yesterday as well, we navigated through that range. Do we do that today as well? Well, the Gift Nifty so suggests.
With a little baby, I can tell that Mangalam is reading Roald Dahls. A little more than pitter-patter is a splatter, I think. All right, well, let's just take it from the top then and, tell you what you need to know. It's oil, right? I mean, tensions are simmering. It's not as if weekend there was fighting and then there was everybody piped down a little bit. But this morning there is confusion whether there is a meeting afoot in Doha, Qatar or not. So oil's at about $72.5. All eyes on whether US-Iran talks take place in Qatar today. And it's a question mark because Trump essentially claimed that Iran requested for a meeting. Iran essentially says that nothing is planned. They say, well, over the next few days, a delegation of ours will be there and they'll be engaging with other mediators, etc. But they're not saying that we requested for a meeting and there is something planned for today. They've denied it. So it's anyone's guess, right? Is there a meeting? Is there no meeting? I guess we'll find out when both parties are in a room and there is some reporting around it. US equities, they staged a rebound led by tech and AI. Nasdaq was up 2%. Actually, a pretty large move. 25,820 on the Nasdaq. And you basically had S&P, which was down for the last 5 sessions straight. And the S&P ended about 1.17%. Now, the U.S. Supreme Court, in other news, ruled that that Fed Governor Lisa Cook may remain on the Fed board while the case sort of against her proceeds through the lower courts. There's a lot of reportage around it, and some of it essentially saying that the courts essentially the majority have sided with protecting Fed independence. On the other hand, there are those. There's others which say, well, the eventual thing where it's been left off is to say that let this find its own course, due course. It's more procedural in that sense, but. That is essentially which was being closely watched. Now, last evening was pretty consequential for large banks here because lots of churn, lots of movement, almost like a musical chair as far as CFOs are concerned. So Rajiv Mantri of Bandhan Bank is now going to be the CFO at Axis Bank. Puneet Sharma, who was the CFO of Axis Bank, is now going to be the CFO of HDFC Bank. So that is, of course, the news with regards to the CFO churn, CFO movement. And of course, we reported all of it yesterday evening. Our colleague Ritu put it out, and all of it first here on CNBC TV 18. HDFC Bank, by the way, has also got a new chairman who's been appointed for a 3-year period. And we'll talk more about all of this as we go on. Yesterday, in the last hour, there was news that the Delhi government, the Delhi cabinet actually has doubled down with the EV adoption policy. The Delhi EV policy is going to kick off from the 1st of January 2027. And, the difference between this and, of course, the draft policy is that this is a mandate. I mean, it sounds like a mandate. There is, of course, the incentive package as well to set up infrastructure, scrappage, to scrap old vehicles. So it's a decent-sized package which will run all the way till 2030. But the point is, this sounds like and actually is a mandate, and the cabinet has cleared it. The question is, will other states follow? Will other states pick up on Delhi's example and follow with their own policies, which perhaps will be important? I mean, everybody's got an EV strategy, but for the bulk of players out there, internal combustion engines, the traditional older vehicles are by far the larger proportion of sales. And of course, what happens to the city gas distribution companies, IGL, MGL, So is this a bit of a structural overhang? Delhi immediately may not make much of a difference, but if other states follow, I think, that concern, it's always been there, what happens when it all becomes EV, but for IGL, MGL, is that concern brought forward a little bit? So keep an eye, and we'll talk more about this as we go forward. I'll just tie in the levels here. The Nifty hovered around the first support we put out yesterday was 23,970. We've left off at about 23,950 yesterday. It's neither here nor there. We hovered for the bulk of the session after the sell-off at about 11:30. And then we hovered around this 23,970 odd level. So there was no decisive big move in that sense. So keep yesterday's low as a support, which is 23,925. But if that goes, then you're looking at the next level, which is 23,800. But yesterday, you could say it was a break, but we'll wait for confirmation today. For the first immediate sort of upside target is 24,100. So it's still a very, very tight range. The market moved a little bit on the downside. We'll see what happens today. GIFT Nifty gives you a quick sense of how we're likely to start, and then we'll pick it up from there. 25 odd points higher is the indicative, open indicative start. Mangalam has walked across to the wall with the F&O stance and the positioning. Mangalam, over to you.
Well, it is June series expiry today, and if you look at the last few series moves on the frontline index, you would realize that maybe the market's been consolidating for quite a while right now, at least at the index level. So after the decline that we saw after the war, March 12% decline and a rebound in April, about 7.5%. May series was down about 0.3%, and June so far is up 0.1%. Not too different from the range. It's more of pitter-patter, and that's exactly what the range is telling you as well. If you look at the Nifty last week, the low on the Nifty was 23,785, and the high was 24,262. This perfectly exemplifies, the range that the market has been navigating around, 23,800 to about 24,300 thereabouts, which is basically just a little over the walls of 50 and the 100-day moving average on the Nifty as well. Both of them come up for you. The only interesting part here is that now the difference between the 50 and the 100-day moving average is coming closer, and typically this happens ahead of a big move. So let's see how narrow can these levels go before the market decides to move. For the Nifty Bank, which has actually been a bit of an outperformer, the only thing to track right now is whether we continue to hold the 200-day moving average. Till such time we do that, there's no real problem for the Nifty Bank either. The GIFT Nifty ahead of expiry, indicating again more of the same, no major changes, just a 25-point uptick. And that's what we're seeing from the flows perspective as well. The FIs yesterday sold about 1,350 crores. This month so far, their selling has been fairly more contained than the previous few months. The DIs bought about 2,800 crores. Yesterday, while the FIs sold about 1,800 crores in index futures, remember these flows are a lot more mixed given the expiry days that we're watching out for. But on a low base, any more long positions that the FIIs add, that increases their long percentage. And that's exactly what's happened over the last few trading sessions. The FIs are now 17% long. But at the higher levels, we are seeing some sell-off for the Nifty, and that's something that's reflective in the call action that we saw. The FI sold 2 lakh calls. This compares with about 60,000 calls that they sold, which implies that resistance on the way up is higher than support on the way down. And that's reflective once again in the put-call ratio as well, which has slipped below 1, closer to 0.85 as against 1.06. What are these options that the FIs are writing right now? 24,000 call, fairly active in trade. We've seen a lot of writing at the 24,050 call as well. So the 24,000 call, premium of 64 rupees, 24,050 call, that comes up for you, the premium of around 45 rupees as well. At the lower level, we've seen writing at the 23,900 put, but were the market to break out, there has been a lot of punt buying at the 24,150 call as well, were we to cross past the 100-day moving average. The option writers are currently positioned for a Nifty expiry range between 23,850 to 24,100. It's consolidatory, but were the markets to break out above the 100-day moving average, the option buyers, the punt buyers, are prepared for that as well.
Thank you very much for that. The GIFT Nifty for now is flat. A quick check on Asia before we proceed. Well, the big story is the Japanese yen has weakened to its lowest level against the US dollar since 1986. We're talking about a 40-year low for the Japanese yen, and now it's almost touching that 162 marks. That Nikkei will come up for you on your screen. And this yen weakening is taking place in Japan despite stronger than expected economic data. Retail sales went up by 5.3% in the month of May, fastest since November 2023. The Japanese markets are up nearly 1%. The other one to focus, of course, is Korea. Yesterday, we were saying there were expectations of a big spending spree by the two top chip makers, Samsung, SK Hynix. Well, the announcement came through yesterday. They are planning, the two giants, Samsung Electronics and SK Hynix, are planning to spend $880 billion for chips and data centers. The government says this amount is essential to survive in the AI era, and they plan to double their memory production capacity in the next 5 years. So this will have implications, a ripple effect on the rest of the entire memory cycle. World Bank says the amount that these two companies are planning to spend is close to 5% on South Korea's 2024 GDP. Stephen Englander, Managing Director, Global Head of G10 FX Research and North American Macro Strategy at Standard Chart, now joins in. Stephen, thank you very much for joining in. But let's begin, not about AI, but your view on the dollar index, because that's been creeping up slowly, and even what the Fed action is. We will watch the US non-farm payroll data that's due on Thursday. Markets are shut on Friday because this, is a read for what the Fed does in the month of September. So your expectation on the dollar index and what the Fed action will be?
Okay, so we expect the dollar index to continue to edge upwards. But I think where we differ from most of the market is that we don't see it as mainly a cyclical force. We see it as a structural force. We think that AI, broader productivity growth are important forces pushing up real interest rates, not for bad reasons, for good reasons, because of the higher productivity of capital. And we think that's has added support to the dollar and will continue to add. By contrast, we expect the Fed to stay flat through 2026. We don't see any huge imbalance or emerging imbalance that would make them move.
Got that. So Stephen, what's the view? Dollar higher or lower?
Dollar higher. And again, think of long-term interest rates. The biggest and most powerful driver of a currency is what the market thinks is sustainable long-term interest rate is. And if we're correct, and the indications are, in the data already, that U.S. long-term productivity growth is picking up, it means that the Fed's forecast that the neutral interest rate is 1%, and that Fed funds will drop to about 3%. Ultimately, that those are wrong. That they will probably see higher rates, not because the Fed is tightening or doing anything to obstruct the economy, because that's the equilibrium level that the economy needs, given the forces at play. So the big dollar driver will be capital inflows, both equity and portfolio inflows, direct investment inflows, private equity inflows, supported by fixed income. But we don't see that it's going to be short-term policy rates that's going to be the biggest mover.
All right, short-term policy not going to be the biggest mover right now. You're saying dollar higher, which is intuitively softer for commodities in terms of pricing outlook. And, the peace talks would also mean that some of the commodity prices which saw some overheating are now going to cool off. In light of that, what's your thought on the entire commodities basket? And do you have a view on emerging markets?
Well, look, we think both emerging markets in FX terms are going to continue to be under pressure. We think that the U.S. is probably well positioned to be at least the first user or to get the greatest initial advantage in terms of these new technologies. And it'll be hard for emerging markets to keep up. What I would say is that there's a segment of emerging markets that's very big, but it's a segment that's not much talked about, which is so-called frontier markets. The perception of the risk in these markets seems to have narrowed considerably versus traditional EM. So their strength may be part of the reason that traditional EM is kind of facing pressure.
Right. In that, what do you see India as doing? Because in EMs as well, the couple of AI plays that there are have done extremely well. In fact, their returns are at par, if not better than some of the developed markets. So do you think that trade continues in EMs as well? There's the AI trade, the non-AI trade.
Well, we don't see oil as having much further to go. And, that's the big reason for the, downward adjustment in dollar INR that we saw at the beginning of May. from here forward, it's more going to be the rate story and the growth story, and we don't. There's nothing that we see that's terrible about India, but we don't see it as being particularly well advantaged at this stage. So some pressure on INR.
Some pressure on INR. I don't know if Stephen, you've heard this or not. The trading community view, and people like Paul Tudor Jones, I don't know if you follow, have all been betting on the fact that we are at the cusp of a big slide in the dollar from here. So it's not done that yet. I don't know if what will it take, according to you, Stephen, for that view to pan out?
I think we would have to be heavily disappointed in AI and productivity growth, because that would take away the support for real interest rates, the support for nominal interest rates that we see coming up. So, and obviously equities are counting on earnings growth driven by productivity growth and technology. So if we saw that removed, the motivation for the capital flowing into the U.S. would disappear, and the U.S. would just be another big country with a big fiscal deficit and a big external deficit, and that would be a formula for a weak dollar. But if we continue to see this kind of robust growth and that drives earnings growth and makes the U.S. an attractive destination for capital, we see dollar strength rather than weakness.
All right, Stephen, we'll leave it there. Thank you very much. AI productivity is going to disappoint, and it's quite incredible that AI and of course what AI is expected to do is the driver for so many macro things out there as well. Some of the traditional relationships really have, of course, broken down since ChatGPT arrived on the scene late 2022. Thank you very much, Stephen. Really appreciate your time here on CNBC TV 18. Let me tell you what the interactions are, which you'll see come up on the show. So 8:35, the management of KEC International is going to be with us. Now, Power Grid has revoked the company's exclusion order ahead of schedule. That's positive. 9:20, Tahir Badshah of Invesco Mutual Fund. We'll talk stocks, markets, sectors within 9:30. The management of Persistent Systems. On the acquisition yesterday, the stock was down sharply. 9:35, the management of Hindustan Copper will be with us. So that's always an interesting conversation. And Kirloskar Oil will be speaking with us at 9:45 to talk about the data center opportunity and the outlook going forward. And 9:50, Karan Thorani, Vilara Capital, with us to talk about the intensifying competition in quick commerce. So, and towards the end of the program, Lata in conversation with India's best agri experts, the impact of a 42% shortfall in the monsoon season as at the end of June. So Ramesh Chand and Harish Damodaran, you'll hear them at 10:15.
All right, with that, we'll take a short break, but a lot of stock-specific action to track today. A bunch of them on the from the banking side. We'll get to all of them in just a bit in our special top 10 segment. But in case you're wondering what we're looking at, HDFC Bank, L&T, KEC International, NCC, Genius Power, Sterling & Wilson, Pace Digitech. They are all on our radar on the back of positive news flow. We have Bandhan Bank and Yes Bank, which are stocks which are likely to open in the red. Meanwhile, Axis Bank, views out there, mixed. Welcome back. This is June series expiry day on Bazaar Morning Call that you're watching. A bunch of stocks on our radar. The Gift Nifty indicating an absolutely flattish start. It's been a bit of a consolidatory month, but not so much for a lot of stocks. And we are getting to all of them in just a bit. Our entire team up for you this morning. Ritu joins in. Ritu, a lot of work to do last evening, all of last, during the day as well, with a lot of resignations and appointments coming in the banking space. So much has happened.
It's been a day, Mangalam. Big leadership moves at HDFC Bank overnight. One that closes the chapter on months of governance uncertainty. Another that is triggering a game of musical chairs among the top banking CFOs. First, HDFC Bank has named former Finance Secretary and the ex-Chief Election Commissioner Rajiv Kumar as its new part-time chairman for a 3-year period, subject to RBI's note. He's also been named an additional director for a 4-year period. That will be approved by the shareholders on the 5th of August at the AGM. Now, with the chairman's appointment now in place and that clean chit earlier from the external legal review on the allegations that were made by Atanu Chakravarti, that governance overhang on the HDFC Bank stock hopefully goes away, and all eyes are now going to be on the reappointment of CEO Sashidhar Jagdishan, which is expected to be taken up in the coming days, as we have been reporting right here on CNBC TV 18. Separately, HDFC Bank has confirmed our news break. It has named Axis Bank's outgoing CFO Puneet Sharma as its new CFO. Puneet Sharma, remember, has been Axis Bank's group CFO since 2020, before which he was a group CFO at Tata Capital. So plenty experience there. And as we reported again, first here on CNBC TV 18, he is going to be the CFO designate now at HDFC Bank from September and formally take charge in December after the incumbent CFO Srinivasan Vaidyanathan retires in October. Now, that move has also set off a musical chair in the private banking CFO space. We learned from our sources that Bandhan Bank's outgoing CFO, Rajiv Mantri, who just announced his resignation at the bank yesterday, is all set to join Axis Bank as its new CFO to replace Puneet Sharma, who will be heading to HDFC Bank, completing this 3-way bank CFO reshuffle.
Well, Ritu, congratulations. Outstanding work and a busy day, busy evening. Wonderful. So that's the banking changes that you heard from Ritu first here on CNBC TV 18. All right. Now, Cabinet has approved the additional investment in the National Infrastructure Investment Fund, that is the NIIF. Vivek has got more details here and what this would mean for the listed universe. Vivek, take it away.
Well, good morning. Expect a whole host of infrastructure companies, smart meter players to remain in focus today. So an additional commitment has been made by the Cabinet, by the government of about 30,000 crore rupees in the NIIF, and this is the second tranche of the NIIF. So now the total commitment made by the government towards this particular fund is 60,000 crore. So what is it that they will take investments across? Number one, transportation, energy, digital infrastructure, as well as urban infrastructure and e-mobility. That would be the key focus areas of the second tranche of the fund. A little bit of background as far as NIIF is concerned. It's India's sovereign anchored fund, professionally run and managed by the National Investment and Infrastructure Fund. And the Government of India, remember, is a 49% shareholder in NIIF. Currently, in the first tranche, they are handling close to 40,000 crore. And capital, remember, was raised from sovereign wealth funds, pension funds, multilateral development funds, as well as domestic mutual funds. So expect, this particular development to give a positive sentiment across the entire infrastructure universe.
All right, Vivek, thanks a lot for that. Let's now go across to Ananya, who joins in with all the developments at Yes Bank. Ananya.
Well, Yes Bank likely to remain in focus after its board approved enabling resolution to raise up to 7,500 crore through equity and 8,500 crore through debt, subject to shareholder and regulatory approvals. Now, this can be raised through various permissible routes through domestic and overseas market. Now, with total dilution capped at 10%. Now, importantly, the bank has not announced any investor fundraising route or timeline yet. Interestingly, the board had approved an identical 16,000 crore fundraising plan in June 2025 as well, but no material capital raise was subsequently announced under the approval. So AGM is likely to happen on the August 19th. So need to watch out for that going forward.
Okay, well, thanks very much, Ria, for that. More stocks with news flow. Vivek is here with that list. Vivek, take it away.
Well, that's right. Keep an eye out on Sterling and Wilson Renewable Energy. A couple of days ago, the company's partner had put it up on their website, and Sterling and Wilson has updated the the exchanges last evening. They've received the LOA, the letter of award, and this is for a 50-50 JV that they are part of, and they've received an order worth over 5,200 crore. This particular order is in Egypt, and the company's partner is Hassam Alam Construction, one of the largest players as far as the Egyptian construction market is concerned. What is this particular project for? 100 megawatt alternating current capacity of solar PV project, which will be integrated with a 600 megawatt hour BESS. So it's a large project for Sterling and Wilson, and this particular project adds significantly to the current order book of slightly over 11,800 crore. The other stock on the radar is Page Digitech. The company has given an update as far as the capacity expansion plans are concerned. They've received the manufacturing equipment for capacity addition to take their BESS capacity from 2.5 gigawatt to 5 gigawatt. The company says by Q3 FY27, they will be able to ramp up capacity to close to 5 gigawatt hour. Now, the executable order book of the company at the end of FY26 stood at a little over 11,300 crore.
Take that point, Vivek. Thanks a lot for that. Pace Digitech had given a strong update for their business going forward as well, and that caused the stock to see a big move over the last few trading sessions. But thank our entire team, and in case you missed it, here's a quick recap of all the stocks that we're tracking this morning. Stocks with positive news flow: HDFC Bank, KC, L&T. We have NCC, Genus Power, Sterling and Wilson, Pace Digitech, and stocks with negative news flow is Bandhan Bank, Yes Bank, while Axis Bank is where the street still has a mixed view. Let's go across to Manisha, who joins in with a roundup of all the action from the commodities market. Manisha, more of the same?
Thank you so much. Well, I'll start with the crude oil prices, where we're looking at prices trading off its highs. It actually has seen a decline of around 20% for the month of June. There is increased oil flows from the Persian Gulf, which is weighing onto the prices, and the markets will now watch out for the US-Iran conversation in Doha, where Iran continues to maintain that it intends to continue overseeing traffic through Strait of Hormuz, a proposal which is opposed by US and Europe and the Gulf Arab states as well. But it's not just about the crude oil prices, which have been declining. The precious metals, base metals also are under pressure. Gold is now trading below $4,000 an ounce. We've seen 2% of a cut come in the overnight markets. The prices are headed for an 11% decline for the month of June. Same is the case with silver, trading at December 2025 lows, and we've seen 20% of a cut come in for prices in the month of June for silver as well. Copper, zinc, all of that trading slightly on the weaker side as well. The strength in US dollar index is one side of it, but the markets also are waiting for the US monthly jobs data that would set further direction.
Manisha, thank you very much for that. We'll take a quick commercial break here. We will come back with the management of KEC International. Power Grid has revoked the company's exclusion order ahead of schedule. Vimal Kejriwal talks to us about that and more. Stay tuned.
Welcome back. Let's get back to the big story that we had yesterday, the Delhi EV policy. Sudarshan now joins in to tell us the impact that he's gathered from various brokerages. Sudarshan.
So yesterday we have seen the Delhi cabinet has gone ahead and approved EV policy, that's electric vehicle policy for 2026 to 2030. But do remember that all the details they have in this EV policy are the same that they had mentioned in the draft that government had released in the month of April 2026. Now government is looking to implement this policy from July 1 of 2026. That's basically from tomorrow. Talking about the entire investment, Delhi government is looking to make an investment up to rupees 15,000 crore. Of which 7,000 crore would be towards EV purchase incentives and 8,000 crore would be towards charging infra development and tax concessions. Talking some details about the EV policy. First, government is looking 30% electrification of Delhi's entire vehicle fleet by 2030. Second, if we are talking about the registrations for electric three-wheelers, from January 1 of 2027, there will not be any new registration for petrol and CNG three-wheelers. As far as two-wheelers are concerned, from January 1, 2028, there will be no registration of petrol and CNG two-wheelers. On incentive part, government is looking to incentivize electric three-wheelers for up to rupees 50,000 in the first year, and for two-wheelers, incentives will be up to rupees 30,000. If you are looking to buy private electric cars, there would not be any road tax and registration charges if the car prices are up to rupees 30 lakh. Now coming to brokerage views. Nomura believes that Delhi has doubled down on EV adoption policy, and the biggest beneficiaries can be Mahindra & Mahindra, Tata Motors PV, Eicher Energy and Sona BLW. Citi believes that it's awaiting more clarity on any incentives for strong hybrids, but it also says that execution is going to be tough given Delhi's borders with Haryana and Uttar Pradesh. While Delhi contributed 5% to all India passenger vehicle sales, 3% to two-wheeler sales, 2% to three-wheeler sales in FY26. So just talking the contribution part in the details, if you talk about Delhi's contribution to total volumes, it's not been that much. It's been it's been in the range of 1 to 6%. If you talk about the EV market share, the highest market share is for TVS Motor. It's around 17%, followed by Bajaj Auto at 12%, Hero Moto at 12%, and Ola Electric at 4%. Now, coming to the key beneficiaries. First one, it's going to be positive for companies like Bajaj Auto and Mahindra Last Mile Mobility for electric three-wheeler part. For two-wheeler part, it's going to be positive for TVS Motor, Ola Electric, and Eicher Energy. Moderately positive for passenger EV makers like Tata Motors PV and Mahindra, and it can be minor negative for hybrid-focused OEMs like Maruti Suzuki. So bottom line, Delhi EV policy is approved, but the real impact can be seen only when it's the neighboring states like Haryana and Uttar Pradesh also go for similar measures.
Thank you very much for that. Of course, impact on OEMs, but also there will be an impact on City Gas Distribution Company and what this will mean for CNG offtake. So Sonal joins in with her understanding and the brokerage view. Sonal.
Well, you know, for IGL, three-wheelers is not such a big market. It's mostly to do with cab aggregators, four-wheelers and buses as well. Nomura has put out a note where they talk about how it could be structurally a negative for IGL's Delhi auto CNG volume trajectory, which is not so big for them right now. They say CNG two-wheelers are not material for IGL CNG volumes, but three-wheeler sales, they have been on a structural downtrend already because of higher EV adoption that we've seen in this particular space. CNG three-wheelers are less than 20% of their total three-wheeler sales. The more significant risk will be for the car segment, as I said earlier, the cab aggregators, buses as well, because that is more than 65% of their overall volumes for the company. Near-term earnings impact appears limited. New vehicle addition rates should structurally deaccelerate in Delhi from FY27 onwards. So it is a long-term negative for IGL. But of course, remember, there was some policy earlier in 2023 where they were talking about bringing new fleet for cab aggregators, which will be completely EV as well. That could be a dampener if that comes by. For MGL, however, there is no direct policy impact because IGL is the one which has exposure to Delhi market. For MGL, it's largely Maharashtra, but if Maharashtra also picks it up, it could be a potential negative. For Gujarat Gas, however, if similar policy is implemented in Gujarat, it will not be a big impact because they are largely into industrial and PNG segments. So Gujarat Gas could not see a big impact. But yes, for IGL, it will be a long-term impact. And if it is implemented in Maharashtra, MGL could be impacted too.
Okay, all right. Sonal, thanks very much for that. the two changes, right? One, of course, the fact that compared to the draft policy earlier, this is more like a mandate. You got to do it. You must do it. And the second important change is that the draft made it seem like perhaps there is going to be room for hybrid vehicles as well. And in the final sort of policy, which has now been cleared by the Delhi cabinet, there's nothing for hybrids out there, which actually is not what's happening globally. I mean, hybrids are a very, very important part of the entire mix wherever EV adoption is taking place. But at least in Delhi's case, from what we know, there is no mention of hybrids out there. It's just EVs. Well, let's just talk about the big banking changes which have taken place. Bandhan, Axis, HDFC Bank, people moving across organizations. Amit Tandon is with us from IIAS. We also have Abhizar Divanji, who's with us, and someone, of course, who's tracked banking for a while. Amit, good morning. Good to have you with us here. Thanks for joining in. Just a quick word in. I mean, I guess for HDFC Bank, this is the most consequential, right? They've got a chairman, they've got a new CFO. How do you see it?
Absolutely. I think slowly all the ducks are kind of getting into a row. They've got the report also yesterday. I mean, there is some controversy whether Mr. Atanu Chakravarti should have contributed or not, but at least that is behind us. You've got the new chairman, the CFO, again, he's a KMP, so he's there. So now the next step is what happens to all the eyes will be on the CEO's appointment.
Yeah. All eyes will, and of course, I mean, as we reported yesterday, Amit, once they have the chairman there, they move with the CEO appointment. I think with the external firm giving a clean sheet, the road ahead for Sasi Jagdish and the current CEO to seek a reappointment becomes much clearer.
Sure. At least in terms of process, you have the NRC, you have the chairman. It rests with the Reserve Bank of India in terms of how they want to proceed with the matter. But certainly, compared to where things were about 6 weeks or even 2 weeks ago, we have a much, much clearer outlook with regard to the path which is there.
Amit, with regards to the new chairman, right? I mean, a fair bit of commentary on social media, at least what I've seen, talking about how it's an ex-government official, an IAS, and how this is, I don't know, somehow inappropriate. But I remember we've had, I mean, I think the post of chairman at HDFC Bank right from the beginning. I mean, Shamla Gopinath, former Reserve Bank of India, was. I guess one of the early in the days was the chairman of the board, and I think we've had others as well there. Do you see an issue at all?
Well, not really. Actually, before they've had a series of people from the Reserve Bank of India, whether it's the executive director or the deputy governor at RBI, and then we've had a round of people from the bureaucracy. Just given the amount of I would say how rocky things have been with HDFC in the recent past. It's not necessarily a bad thing to have someone who is with the civil service. The incumbent chair has occupied some really important posts, and importantly in the banking sector as well. So he would be very sensitive to some of the pressure points there, and the ability to talk to the government, to the regulators is very important at this stage as the bank tries to stabilize its operations and, more importantly, its image in the market today.
Yeah. Abhizar Divanji is also with us. Let me get a quick word in. Abhizar, thank you for joining in. Your first thoughts, Abhizar, on the new chairman at HDFC Bank, of course, getting a new CFO as well?
Yeah, I mean, fresh start, I would say. I don't think who comes in as chairman is important as a person as against the background, in my view. And as Amit just said, I think it possibly helps if there is a bit of lobbying to be done or points of view to be presented. A government official may help. But having said that, I think you just need somebody who's more articulate and fair and objective. So I think if those qualities exist in the existing chairman, I think HDFC is in for a good run. Of course, the new CFO will help. Any which way, the CFO was retiring, the earlier one. So the new one coming in, I guess, has had a track record of being rock solid. He's kind of managed relationships pretty well with the investors, etc. I've known him from the past. And clearly, that kind of a thoroughness in robust reporting and robust communication with investors is I think, something that HDFC can do well with. So I think pretty good in terms of where the management build-out is happening. I think the most important thing in some of the large banks is to build a leadership pipeline, which I think I see across the banking industry as being slightly weaker. We had times when ICICI Bank, I remember in its heydays, used to have a host of leadership pipelines available, and it was difficult to choose as to who would be the next in line for the CEO position. I think that's what the banking system generally lacks. And if you are able to focus on a good leadership pipeline, I think we'll be good.
No, you're absolutely right. Abhizar, so that's the chairman bit, and I think we've heard from Amit and Abhizar, and both of you concur that having someone with the background that the new chairman has perhaps helps in getting the point of view across, interfacing with governments and that kind of thing. On the CFO bit, Abhizar, a bank CFO, right? I mean, a CFO at any other organization, what's the basic difference and how critical is the role? I know it's a very basic question, but I thought I must ask it. Yeah, go on.
Much wider role. It's not generally an accounting and audit role.
Correct.
As CFOs were perceived to be earlier, especially in banks. It's more of a, what I would say, a back-end CEO role. So kind of the check and balance to what the CEO does in the market. And then an objective communication of the bank's performance to stakeholders. I think that is really what a CFO is now for. So a general check normally on what is happening in the business, how do you interact with the regulators, how in spirit are you compliant with regulations, and obviously checking and balancing the CEO whose primary objective is the growth and development of the bank.
Yeah.
I think a CFO is somebody who needs to have a good amount of business skill and a level of skepticism, which a CEOs generally lack because they're growth-oriented.
Yeah, yeah. And especially true in a banking environment. But, I mean, I think we are talking very specifically about the CFO's role as far as the bank is concerned. I can tell you that the CFO at least this is industry feedback from CIOs that I've spoken with. I mean, it's pretty favorable with regards to the new CFO at HDFC Bank. And what he was able to do at Axis Bank in that sense. Directionally, Abhizar, from here, what should we expect in terms of the focus areas at HDFC Bank that the new team perhaps will? And of course, I mean, this is all before the CEO post also comes up. And I guess, as I was discussing with Amit earlier, Mr. Jagdishan's case becomes clearer now.
I don't know about Mr. Jagdishan's case.
My point is not about whether Shashi Jagdishan's case is clear or not. My point is essentially the focus area. Abhizar, you think?
Yeah. So as a bank, I think the focus is now off the governance issues for sure. And I think it's been proven that it was more noise, which is what has been consistently said. Having said that, now I think there will be an objective view that the RBI will take on the CEO appointment. And will not get biased by the lagging governance issues, especially what Mr. Chakrabarti had to say. So I think those issues are behind.
Sure.
So yes, I think RBI will be more objective in how they decide.
Amit, just that same question to you. Just focus areas from here.
Prashant, what I wanted to say was the path for the appointment is clearer. That's the point I made, rather than who it will be.
Of course.
So that is what it was. Look, I think what happens with a lot of these issues is they are a distraction. The senior management spends all their time, so they need to get back to doing what they did best, which is focus on operations. As happens always, the processes need to be tightened. You have newer and newer regulations. You have to ensure that you don't trip on them. So I would, and of course, there's growth. So it's back to business as it was some time ago, rather than getting waylaid by this. There's the issue with the fixed deposits, etc., etc. So get all that behind and move on.
Got that. Wonderful getting those insights and perspectives. Amit, thank you very much. Abhizar, thank you very much for joining us. And good speaking to both of you on these appointments. And of course, I guess the one organization which is going to be closely watched in terms of stocks and when markets open is going to be HDFC Bank, Axis Bank, of course, as well. But I guess HDFC Bank a little bit more. Thank you very much, gentlemen. I think, Mangalam, we have the management of KEC International ready. So let's go across.
Yes, we do. KEC International, the first management of the show. Power Grid has actually revoked the earlier exclusion order. So obviously, what this means for the company's overall prospects, and just to get a sense of how business has panned out as well so far, we do have with us Vimal Kejriwal, who's the MD and CEO of the company. Good morning, sir. Thanks a lot for joining in. Let's talk about the Power Grid reinstatement. If you could give us a sense on, what was it stopping you from when it came to your ability to get a little more orders from them? Now that this has come by, how much better it is? And if you could also then give us a sense of how the first quarter has panned out, because you earlier did give us a target of 10 to 15% growth in this entire year, with the first quarter being absolutely flattish. Could you give us a sense on how that's panned out?
Morning, Mangalam. Thanks for having me. As far as the quarter is concerned, I think it still remains what it was earlier, and we still stick to our annual growth of 10 to 15%. The West Asia, where we have a large presence, still has not settled in terms of shipments and supplies, etc. While construction is going on. So I think the quarter will remain where it is. Year will definitely be better. As far as Power Grid is concerned, I think there was a little bit impact where we could not bid for their projects, the tenders for the last few months, which now has been revoked. And it has fortunately come at a right time where there is a strong pipeline of HVDC and other tenders to be bid in the next 1 month or so. So clearly there could be something positive which will happen on the order intake going forward.
Could you quantify that? How much did Power Grid earlier account for in your overall business? The last couple of months that you weren't able to bid for them, how much could the potential loss have been? And now that you are able to bid over the next 1 month, what's the potential gain here?
So, Mangalam, difficult to put in numbers. The reason I'll tell you is that today most of the tenders or projects are being awarded on TBCB, where either Power Grid wins or Adani or Sterlite or IndiGrid and all that. So in a way, what we did was we hedged our bets, and whatever we could not get from Power Grid, we did get a lot of orders from the other private sector players. So the loss and all that is difficult to quantify, saying what would have been or what you can not get. But I think the positive part is that it's come at the right time, where there's a lot of things. And also we are seeing Power Grid becoming a little bit more aggressive on the TBCB side, having secured a few orders. Last year was not very good for Power Grid in terms of their ultimate share in TBCB, which we're already seeing going up. So we do expect that this will help us.
What's the Power Grid pipeline? You said the revocation comes at the right time. So what's the pipeline in the next 3 months?
So as of today, we have around 10 plus tenders to be quoted, more than 6,000 crores in the, I'll say, next couple of weeks itself.
Okay.
That's
Got that. This is from Power Grid.
This is from Power Grid, but they'll ultimately bid in for the TBCB projects. So let's assume that they win 50% or 60%, then the actual order translation can be 3,000, 3,500, 4,000 crores.
So, sorry, Mr. Kejriwal, good morning. Prashant here. Just those numbers again, you're saying tenders which will be put out is about 10,000 crores?
No, I said that there are about 10 plus tenders from Power Grid which are in the market today to be quoted in the next couple of weeks itself. Okay. And I think the total amount is roughly more than 6,000 crores out of that. And since these are tenders which they will also bid in for TBCB, assuming that they win 50%, let's put a number, then at least 3,000 crores would translate into orders for EPC companies.
Got it. The opportunity for companies like you and others is about 3,000 crores. Should be finalized pretty soon. That's essentially what you're telling us.
Yes,
there
absolutely.
is this one very large HVDC tender, right? Which is also in the it's massive, which should be decided. We were told in the next couple of months, Mr. Kejriwal?
I think it will be faster than that. I think the bidding is happening next Monday, if I'm not wrong. So once the bid happens, then maybe a month or two, unless the prices are wavered, then the government may take time to decide. If the prices are normal, it's on a fast track. So I don't think it will be months. It will probably be weeks when it gets decided.
And there are only two players in that sense. And then, I mean, downstream, more the work may come to EPC companies, etc. But technically, there are only two players, right?
So there are two players on the converter side. Okay, transmission side, there are a lot more players, obviously. And also what will happen is on the bidding side, we are seeing a lot more interest. So we do not know who will win the bid from HVDC. But yes, you're right, on the converter, there are only two players.
That is the majority of the size of the order, is it?
It will at least be 50 to 60%.
Is the converter. And there are two players. Got it. You're also participating for the rest of it?
Definitely, yes.
And sir, how are the margins for an EPC company on HVDC orders versus the regular transmission and distribution, T&D orders?
So it could be marginally higher because the competition there is slightly lower than the normal orders. But typically, you will see maybe 5 or 6 players. In this, you may see lesser than that. And it's a more difficult and a little bit more complex job. So I'll say maybe 100 basis points or 150 basis points.
Okay. And just one more question, going back to the point about, the Middle East situation. In Q4, you indicated that resulted in a loss of revenue of close to 400 crore rupees. In Q1, as things stand, will you be able to quantify how the situation in Middle East is? Are you still losing revenues, or is it back on track now, normalized?
So, as I said earlier, on the physical part of it, on the project construction, etc., it's going on very well. There's absolutely no issues. We have more than 20 projects all doing well in Saudi, Oman, and UAE. Supplies are still under a constraint. Shipping lines are taking a lot more time. Ports are still busy. We are still not getting ships from Europe or China coming in there. So there will definitely be a continuing impact on the supply part of it. Let's say a transformer or a conductor, hardware, etc. They are still getting impacted. Plus, there is still some impact on the steel supplies to the projects or to our factory. Okay, so there is a timeline which is happening there. So there will be some impact continuing. But as I had said earlier, it's just a rolling over. It will come hopefully now in Q2.
Right, so it's delayed, not denied. Just a couple of words before we let you go, Mr. Kejriwal. You earlier had said that you are expecting an order win of close to around 30,000 crores this year. This was when the PGCL revocation was off. And now that this has come about, would you revise your guidance upwards?
Difficult, because I'll tell you, the PGCL was supposed to get off around August. So it's been roughly, I'll say, around 2 months early. So there could be some marginal impact. I think in 30,000, it's too little to say whether it will increase. But yeah, I will try to do more than that. But I think our target still remains at 30, yeah.
All right, target's 30. I mean, because you said the opportunity over the next couple of months could be about 3,000 crores. Assuming you get, even 15% of that, that could be an additional uptick of nearly 500 crores on your guided numbers. And a final word on the labor shortage. You said that you required about 30,000. You got about 15,000. Has that number improved a bit after all the elections have happened and, all the migration has come back?
Still not fully in place. I think we have around 21, 22 till now. Okay.
All right.
We are still seeing some shortages, yes.
Got that. Sorry, I'm just going back to that HVDC thing, Mr. Kejriwal. You said we will have a decision most likely next Monday, you said?
No. The bidding from the developers would happen, I think, next Monday or so. And then, obviously, the ministry or whoever is in charge will have a look at it. And if the bids are quite okay, then it will happen immediately. If the bids are wavered, then it may take some more time. So my view, our discussions are that in a month or maximum 2, the award would happen.
Got it. Mr. Kejriwal, thank you very much for joining us, sir. Good speaking with you. It's always a pleasure, and good luck.
Thanks, Prashant. Thank you so much.
Well, that's the management of KEC with some perspective there. We'll take a quick commercial break here. Mayuresh Joshi is going to be with us for some fundamental stock conversation coming up in just a bit.
Welcome back. You're watching us here on Bazaar Morning Call. Mayuresh Joshi, Director Market Smith India, joins in now. Mayuresh, let's start with the IT pack. Yesterday, the acquisition that Persistent made. What do you make of that? And in general, do you think the next leg of growth for all these IT companies will come in from their balance sheet? They'll start making acquisitions?
Morning, Mangalam. I think that seems to be the base case scenario because I think they have to move very fast in this direction over the next few quarters. And therefore, I think acquiring niche smaller companies absolutely makes sense so that they can at least move up the value chain from the mid-single digits in terms of reported AI revenues that they're probably having. The other element, Mangalam, is also that upskilling of their existing staff or employees. And therefore, I think a substantial amount of investments probably might have to go there as well. I think in both these factors will probably make us believe that the growth vectors that are probably missing might start coming through. But how soon does that happen is something that the street is probably looking at. And therefore, I think the constraint pressure that you're probably seeing in terms of competition, announcing new models, etc., is obviously playing on the sector as well.
And just before we take a short break, a question on the banking space. So many leadership announcements were made, specifically on HDFC Bank. They have a new CFO joining in. Axis Bank CFO's moved. What do you make of all those management changes? And is there anything particular that you like here?
Mangalam, again, I think something which was expected to probably happen in terms of the leadership changes across the top-tier banking names. And therefore, I think as a strategy, I think few of the mid-cap private sector banks is something that we've continued liking for a long period of time. Karur Vysya Bank in particular, I think very strong set of numbers that the bank has consistently reported over a longer period of time. And our own expectation is that the kind of growth numbers coming through, whether it's advances growth, whether it's the deposit accretion that the bank is probably doing, the asset quality pressure which are not built up on the balance sheet at all, and they've maintained their name very, very well in view of balance sheet expansion is way leading to better ROAs and ROEs. I think this is one bank which is showing amazing amount of ratings, rankings, EPS and RS strength as we see it. And therefore, this continues to be a holding in our global book.
Mayuresh, I have many more questions, but the tyranny of time, we are hard-pressed because of that banking news that we had to address early on. Thank you very much for joining us and being here on CNBC TV 18. We'll take a break. We're back with the pre-open rates. Sudarshan Sukhani and Mitesh Thakkar will be with us with some technical trading ideas. There's 2 minutes to open. The pre-open, that is. Okay, welcome back. There's 14 minutes to go for the market open. The pre-open is, of course, kicked off, and first rates will start to come up. Sudarshan Sukhani is with us. Sudarshan, good morning. Good to have you with us here. Thanks for joining in. 11:30 yesterday in the morning, markets kind of came off pretty sharply. Not sharply, we ended about 70 points lower. Where does it leave us? Still very range, Sudarshan?
Yeah, good morning. Yes, it leaves us in a very narrow trading range. So the view for the Nifty is that the two possible events are there. One is a sharp correction towards 23,800. Remember, today is monthly FNO expiry also. Anything can happen. If the Nifty comes towards 23,800, it's a buying opportunity. If it decides to break above 24,100, and that's a long way off the way the markets are behaving, that's another buy. Now, if you have long positions, my suggestion is that you close them and wait for any one of these two events, 23,800 buy, crossover 24,100 buy. Between these 300 points, do nothing.
All right, do nothing between this 2,300 points. We'll get to you for your stocks. We have Mitesh joining in as well. Mitesh, yesterday and all of last week, and if you look at just the price movements over the last couple of series, the market's been in this consolidation sort of zone. Do you think there's a trade today?
So my sense is that I think, we might just spend some more time in the sideways activity, which is broadly 24,300 on the upside and 23,800, 750 on the downside, which means that on the index, trading will happen, once you're near the edges. So you would try to buy around 23,850, 830 zones with a stop below 23,750 and try to exit or sell close to about 24,300. I think that's the trade which might be in place for next 2 days. So today, as we are kind of in the middle of the range, no trade to begin with, but let's see, how it goes during the day.
Mitesh, what about stocks?
Yeah. On the stock side, I have a mix of buys and sells. A sell on DV's lab on a mild pullback, say around 65, 75, 65, 80. Keep a stop at 66.50 and a target of 6,440 can be looked at. And Canara Bank is a sell with a stop at 128.5. I would suggest a target of 119. While on the buying side is LIC India, which is a buy with a stop below 420 for targets of 455. And LIC Housing Finance, which is a buy with a stop at 549 for targets of 585.
Sudarshan, what about the stocks that you're recommending?
I have a largely long trade. Next, Apollo Hospitals is a buy with a stop under 8,500. Sun Pharma is a buying opportunity. It came out from the highs yesterday, but that gives us a buy on dips opportunity. Buy with a stop under 1850. Bharat Forge is another buy. Same story. The markets rallied in the morning. It came off from the highs in the afternoon, but that again is a dip. Buy Bharat Forge with a stop under 2140. NMDC is my intraday short with a stop above 87.50. So that's 4.
Thank you. We'll come back to you for some more. It's time now for a CNBC TV 18 exclusive. Remember, Persistent was clearly the newsmaker of the day yesterday. It made a strategic bet with the acquisition of a German digital company called Nagarro. Sandeep Karla, Executive Director and CEO at Persistent Systems, is now joining in. Sandeep, let me begin with the two specific concerns that are raised. One, that the company that you're acquiring has a lower revenue growth and lower margins than Persistent. In fact, Kotak goes on to say that this acquisition might not even accelerate the revenue growth of the combined entity beyond what you would have been able to achieve by yourself. So we get the strategic rationale behind this acquisition, but I think the question is, what will the combined entity grow at now, and what is the timeline to bridge the margins?
The growth rate at Persistent today is roughly about 17% year on year. Now, we just announced a large deal, which is 125 million ACV and which is roughly about 650 plus million in TCV. And that's on the back of our capabilities in software engineering, the AI side of it, and so on. So we are very confident, number one, of Persistent growing at a relatively good pace. This is not a guidance. This is basically based on what we see today. We should be able to grow consistently like we have over the last several quarters. We have had 24 sequential quarters of 3% plus growth. We hope to keep that engine on with our deal wins that we are seeing and the pipeline that we are seeing. So that is one part that I want to highlight to your viewers. Second thing, now we look at Nagarro. What is Nagarro to us? Why are we doing this acquisition? I'll like to point out 4 things, and then I'll come to the point on the growth. So this is not a scale-led acquisition. This is not about consolidating revenues. This is a strategic acquisition. This combination gives us truly a global footprint. From a geography perspective, if you look at it, Persistent is 81, 82% in the US, 8% in Europe. If we look at the combined companies will be 65% in the US/North America, 22% in Europe, the rest is in the rest of the world. Even in the rest of the world, today Persistent does not have a Middle East footprint. Persistent does not have a Japan footprint. And obviously within Europe, we are not present in countries at scale like Germany, Switzerland, France, Italy, even places like Turkey, which is closer to MENA and so on. So this is a good acquisition from a geographic diversification. Now from an industry diversification. If you look at the industry side of the house, we basically are big in tech, the ISV part of the world. We are big in BFSI and healthcare life sciences, whereas Nagarro is big in industrial. Industrial is traditional industrial plus auto and other verticals for them. They are big in consumer and so on. So from a vertical, from a geographic, in perspective, these are two things. Now, service line perspective. If you look at the service lines, we do not have a SAP footprint at all. Nagarro works with SAP both on the product engineering side of the house, as well as they have significant revenue coming from implementation services, $200 million and more.
Sandeep, we get that the acquisition makes sense. There are a lot of, synergies, the geographically, clients-wise, lots of complementarities. But, Persistent is a very fast-growing company. Even in a tough time, last year you grew 17%. I think the question or the fear is that now combined entity may not grow at this level. For example, Nagarro's revenue growth was only 6%. So what will the combined entity grow at?
Our significant confidence is we can bring the growth of a Persistent over the next 1 to 2 years to the combined entity. Obviously, we have to pass the regulatory hurdles, come together and start executing. So hopefully that gives you the lay of the land here.
Oh, that's good to know. So you're saying the combined entity will be able to grow at Persistent standalone revenue growth, which has been in high teens, last year 17%. What about on the margin front? If you could, give us an indication about that.
When we speak to the management, when we speak to the next in line, we don't see that the company is incapable of growth. We think they were distracted for a period of time. We believe they have the aspirations and the ambitions and the capability to grow at the same rate as Persistent has. Obviously, that needs a certain amount of rigor to be brought in, certain amount of focus to be brought in. And based on our diligence and our discussion with the management, we are confident that will be the case. Now, coming to the margin side of the house. Now, obviously, margins, etc. Again, it goes back to the point where you can scale an organization entrepreneurially to a certain extent. Then you also need to bring in a certain rigor, a certain discipline. And if you look at it, they have been working on that for a longest period of time. Basic things like having a formal CFO organization. That was not something they believed in. They corrected it. So they have a mature CFO as of this point in time. They are trying to change gears operationally. And that's the opportunity for us. That's the opportunity for anyone to come in and say, capabilities are good. Fundamentally, the company is good. Very, very complementary to us. Now, if we bring the rigor, we put the processes, there is enough and more margin to be driven into the system. But we would first take that margin, put it towards growth in the next 1 to 2 years, like we have brought Persistent in the last several years. I remember clearly 7 years back, our EBITDA, forget EBIT, was fairly low. And today, we are coming to best in class. So we are very confident, given our experience, given what we are seeing from the management and their willingness to work with us on this, most important, and work with us on the integration side. And I'll come to integration details in a bit. We are very confident this will be a good combination. It'll need work, but over the next several quarters and years, this will be the best growth and among the most reasonable mid-cap margin companies in our sector.
So Sandeep, margins 3 years down the line?
So for the next 2 to 3 years, our aspiration would be to bring it in the range of 17, 18, but reinvest. First would be to make sure that we bring the growth back into the company. The growth in the company gives the confidence to everyone, and then we take the margins up. So over the next 2 3 years, you can expect it to be where the Persistent side is. But again, first thing would be get the quick wins on growth, over a period of time, optimize the margins, and then go from there. We are not trying to bring a value company into the market where people should invest in us for the best margins or dividends. We are trying to bring, as a combination, the best growth company in our sector, the most, a company built to last in the AI era, where we are very differentiated. We are not scaled for the sake of scale. We are scale in the right places and the right technologies.
We're not building a value company. People should invest in us for a growth even in an AI era. So combined entity, are you confident that you can grow mid-teens, high teens?
That would be our aspiration. Mid-teens would be our aspiration. If we can deliver better than that, we have done in Persistent, we have grown better than that as well. This is not a guidance, just to remind you, this is our aspiration. We have delivered very well over the last several years. From what we have seen and the management commitment, we are confident we should be able to live up to our aspirations. And even from that perspective, let me remind you and your viewers, whatever we have said in the past, whether it was we would do a scaled acquisition in Europe, small tuck-in acquisition in the US, we will be a $2 billion company aspirationally by FY27, we want to be aspirationally $5 billion company by FY31, each one of them we have strived to achieve and we have delivered to most of our aspirations.
Sandeep, on the valuation front, you paid a 140% premium to Nagaro's closing price. Do you not think, to some extent, you have overpaid? Because to pay that, you've also turned from a cash company to a company which will take on debt. And you've categorically said that you don't want to do a QIP to fund it.
Let me reinforce, we don't want a QIP. We are not looking at a QIP in the next several years, unless there is a need for us to do it for other reasons. So for this acquisition, we don't need a QIP. We are very comfortable with the debt that we are taking. We have many inbounds where many people would love to collaborate with us, many PEs, etc. on the asset. Those options are always available, but at a Persistent level, we will not look at a QIP for this. We can easily, through the accretion that we have with this combination, pay for that. And even if you look at it, we have put a document on our website in our investor section. Any of you can see it. We believe this will be EPS accretive, cash EPS accretive starting year one. If you take out the one-time expenses for the acquisition, we are EPS accretive at that level as well. Now, that is without the synergies. We have not worked out the cost synergies. We have not worked out the revenue synergies. We want to, work over that in the next several months in parallel to getting the regulatory things, because we will have to keep some hypothesis. Once we have the regulatory approvals, then those will be hard cases that we will build on. But even without any synergies, we are very comfortable with the EPS accretion. We are comfortable with the kind of, the debt that we will take on, and we can service it without doing QIP.
Just one final question then. What is plan B, Sandeep, if the open offer fails to get you the acceptance requirement, the threshold requirement to delist from the Frankfurt Stock Exchange for Nagaro?
First of all, few data points. At this premium, and we were invited to attend the AGM of Nagaro, which happened today. It was a very positive AGM. The investors were very receptive to the kind of premium that is there. And by the way, while we definitely believe we have paid the right value, it is a significant premium for the existing shareholders. We are very confident they will tender in. And to give you some more data points, we already have 21% that we have signed up for. And that will, as soon as the regulatory approvals come and we close the other tender offer, that is already in our control. Now, with the same large stakeholder, we have another 3% that is in different options, etc., that we have the option to have. So that is another 3%, that takes it to 24%. The management and the management board members hold somewhere in the range of 14 to 15%. That is committed to us. So that takes it from 24 to roughly 38%. It is, and we have done the analysis. We are pretty confident we'll get the rest, and we are in no hurry to take the rest outside of 50% plus one. We are happy to run the company for the next 1 to 2 years or more, as may be the case. We are comfortable with the management team. We are comfortable we can put the partnership agreements, etc., as required at different stages and be able to run the company nicely.
Okay, well, lots of details. We wish you all the best of luck as you go ahead with the acquisition. And thank you very much for joining us. Persistent, I think, at the end of the pre-open is slightly higher. It was one of the big casualties yesterday, ended about 10% down. But bunch of names, right? Market open coming up right there. So 24,000 odd on the Nifty. The Nifty Bank, about 1/3% higher. The Sensex about 0.29, 0.3% in the green. So it's a much better start, 0.4 higher on the small cap index or so as well. So that's what we have at this point in time. So, 50 points, 24,000 back on the table once again. And 250 on the Sensex. The Nifty heat map on your screen. So more up than down. Maruti and Adani Ports and Indigo and Tata Motors, etc. are higher. Eicher is the biggest loser. It's followed by Tata Consumer, Max Health, and Infosys. So about 15 odd names are down, and the rest of the 50 stocks are starting at least in the green. Rima.
Well, it's autos, whether it's in Eicher Motors, you should pull up a Bajaj auto because Delhi's 2026 EV policy does suggest a significant pivot towards EVs at the expense of ICE and hybrids. And there's going to be a hard stop on three-wheeler sales from 1st of January 2027 for Delhi, and even for ICE two-wheelers from April 1st, 2028. So you will see a negative impact on names like a Royal Enfield, Hero MotoCorp, Bajaj Auto, TVS Motors. And these haven't opened up with deep cuts because it's only Delhi. It remains to be seen whether other states follow through. But Eicher Motors clearly is taking a brunt. On the way up, we should pull up an Ather and Ola Electric to see whether this EV push is pushing up the stock prices. On the way up, though, you've got Maruti, Suzuki, even Tata Motors, which has a presence in EV and could be a beneficiary along with M&M. These are stocks you should watch for. So the top gainers include Maruti, Tata Motors, Interglobe Aviation is seeing some buying. Trend is higher in trade, Adani Ports, Power Grid, Cipla, Bharti Airtel. These are all stocks with gains of more than 0.5%. On the way down, as I said, Eicher Motors has now slipped below the 200-day moving average too. Tata Consumer, HUL, a couple of IT names like Infosys, Wipro, and even a Hindalco opening up in the red. The stocks, the banking names, one by one, we'll pull them up. An Axis Bank, an HDFC Bank, and a Bandhan Bank. These three will also come up on the screen.
Yep, a lot of these, gas companies are doing extremely well. Sonal did speak about the likely, them being immune to this, not being as impacted by this EV policy. So Mahanagar Gas has actually opened about 5% higher. We're seeing some traction in IGL as well, which is about 1.5% higher. Mahanagar Gas obviously is less impacted by this, so it's up around 4%. Bharat Forge this morning has opened about 4% lower. We are seeing a bit of an up move on KEC as well. Them getting the access to power grid orders. We had management joining in as well. Over the next couple of weeks, there could be nearly 3,000 crores worth ordering opportunity from power grid, and of which they could win about 500 crores. So management fairly positive on the prospects coming in out here. That stock has opened about 4% higher. But Genius Power, that's the stock which is actually the stock of this morning, down about 11% after nearly 2.5% equity, nearly 3% equity, which has changed hands via a block deal because the news was fairly positive. The cabinet approving a 30,000 crore fresh investment in NIIF should have actually taken the stock higher, but this block deal has caused a bit of a downtick on that counter, down about 11%. Arvind is doing well. A lot of these textile players are doing well. We have Bombay-based real estate and other real estate players as well gaining this morning. So we have Keystone Realtors, which is higher. We'd just like to see whether Pace Digitech has also opened with a fair amount of gains, because that was one of those stocks which was doing extremely well ever since the management came out with their update. And now we have an incremental update on the capex for Pace Digitech as well. Let's see whether the street has reacted positively to that or not. The stock has corrected a fair bit from the highs, and from there seen a bit of a recovery as well, opened about 3% higher.
Okay, well, I think that is the sort of overall picture as things stand right now. I mean, the initial burst higher is gone. We are down about 10 points or so, 23,940, but it's of course all about individual names. And even, I mean, yesterday the market was sideways, but lots of action, lots of activity in that sense. Tahir Badshah is with us, Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Good to have you with us here. Thanks for joining in. For a change, Tahir, let's start with something topical or slightly more news-related. The Delhi EV policy, I think generally people are surprised by how quickly this has been brought forward. And the question is, will other states follow, and what are the implications for the listed auto companies in your assessment? Tahir, let's start there.
So I think, this is, I think, part of the overall push which and the direction which basically I think Indian Autos is likely to take over the next few years, which is that, EVs and adoption of electric vehicles is going to only rise across different segments of the market. Delhi always has been the state which typically takes the lead in the implementation of this, and therefore to that extent it's not a surprise. But clearly this is also something which will be relatively more gradual. Of course, the implementation dates itself are a little stretched out in time. And more importantly, I think it also needs to be supported by enough EV charging infrastructure and so on, and also to ensure that there are no leakages and stuff like that. So I think it's important that we probably are able to implement well in this policy. But clearly, I think directionally, and we've liked this theme about EV adoption, and we have represented that in our portfolios also in one way or the other. So I think overall, I would assess this as a positive development.
But are you surprised that hybrids have been left out of it completely? And from a portfolio implications, this is negative for a company like Eicher Motors. You can see it reflected in the stock price today. So if someone does have I'm not asking you for a stock view on Eicher Motors, but Eicher Motors has been a wealth creator. It's been an investor favorite. If someone does have stocks which get negatively impacted by this policy, what is the advice now?
Well, I think there will be always a demand for some niche categories, and that is where a few companies are positioned. I don't think we are not expecting obviously the whole of the market to shift to EVs. There will be a mix, and to that extent, I think some of these companies which are in either the traditional conventional fuel category or probably even in the hybrid category need to execute well, or probably have those niches expanded over a period of time to be able to deliver growth. But I don't really think that's a big challenge from a longer term standpoint. Of course, the negative sentiment, the near term sentiment is probably negative for them at this stage.
Are there any ancillary plays that you have in the EE space which obviously would get some value addition, and is there an investable case out there? The ones that maybe say make the battery infrastructure or other parts?
Well, at this stage, I think we are more excited by the OEMs, at least as far as India is concerned, and from the domestic market standpoint, two-wheelers as well as four-wheelers in the form of the mix. I think as far as ancillaries are concerned, I think we are probably more excited from the point of view of their ability to kind of expand the market or probably increase wallet share as far as the international markets or the global markets are concerned. So I think we are approaching the segment distinctly from this agenda.
Let's move beyond autos. What else are you noticing in this market? Is there anything particular that's caught your fancy over the last month or so?
I think we've been positioned in this for a fairly decent period of time. We've also taken the brunt along with it. I mean, in the last 3-4 months when oil prices were where they were, obviously this sector was under a lot of cloud. There was also a little bit of the apprehension as far as a little bit of the receding impact as far as GST is concerned from last year. I think on both these counts, probably things have turned out a little more differently. Now in the last few weeks or so, I think we've seen obviously oil prices have retracted and recoiled a lot. And more importantly, and that takes away a lot of pressure from the whole sector as such. Additionally, we've also probably seen demand numbers hold up reasonably well, even from what we're hearing as far as June monthly sales are concerned. So I think on both these counts, things are turning out to be somewhat better than what the market's expectations were, and therefore it is not surprising to see the kind of momentum which has once again started to develop in this sector.
By the way, today is the 30th, Tahir. Last month, right? And this may be important for, of course, the market. I'm talking about retail money into mutual funds. We'll get data in the next, I guess, 1 week or so, maybe a little longer later than that. But the prior month saw a very sharp dip. Has this month been better?
Well, I'm yet to see, obviously all of us are yet to see the numbers for the industry at large, but I think overall trends are reasonably fine. A little bit of maybe a month-to-month pressure over the last month, and especially given the fact that, last month there was a lot of apprehension as far as where the West Asia conflict was headed, and probably also concerns with regard to the monsoon and its development. I think on both these counts, we're getting somewhat better. Definitely better as far as the conflict is concerned and geopolitics. Somewhat better on the monsoon, although that is still a story which is yet to unfold. So I think we saw a little bit of loss of momentum as far as last month is concerned, but nothing which is probably very worrisome. Even for us in particular, I think our trends have been quite fine. We have been in the in the top few in terms of gains in market share and so on. So that I think is continuing for us from a flow standpoint. And for the industry at large, I think the SIP number has held up quite well. A little bit of decline marginally on a month-to-month basis, but like I said, nothing which is very alarming at this stage.
Nothing which is very alarming. Got it. Tahir, in the entire industrial space, which is where bulk of the activity has been, we just had the management of KEC. We were talking about this massive new, the HVDC order, which is going to run into tens of thousands of crores, which should be finalized according to them in the next one and a half months or so. What's the view? Ordering, of course, I think remains strong, but question is how much is being factored into stock prices now? Tahir, what do you like here?
Well, we've liked a few things for a while now, especially in the transmission space. And I think obviously those have done well, but earnings momentum for many of these companies is going to remain very strong. I think, as you rightly mentioned, even order books are reasonably strong and flowing in a way. But I think valuations are obviously a little more demanding now compared to what they were earlier. A lot more demanding, I would say, compared to where they were earlier. So at this stage, we are happy to hold what we are. We don't mind trimming a little bit as and when our portfolios become a little heavier with some of that exposure. But by and large, I think the play still remains valid. We see a lot of investments, at least as far as transmission is concerned. We are gradually assessing opportunities as far as the distribution part of the power ecosystem is concerned, and that is where we believe there could be incremental trends which can develop the way it is developed in the transmission space over the last 2-3 years. They optically probably don't look cheap, but for many of these, I think growth can probably accelerate as we go along, and probably in most of the industrials we've seen over the last 2-3 years, wherever growth has been very strong and execution has been decent, it has been accompanied by very strong expansion in margins as well. So I think something similar can definitely pan out in a few of these companies which are part of the distribution ecosystem or probably ancillaries to the distribution segment of the power market. So I think incrementally we are probably trying to assess opportunities in that.
But are you comfortable with the valuations? Because it's not that the transmission sector is not discovered. Many stocks have already been multi-baggers from here on.
Yeah, like I said, some of these are clearly discovered. The valuations out there are fairly demanding. But then there could be pockets. It's not across the board. Of course, we'll have to kind of do it very, very granularly and bottom up. But there could be stories which are probably are still at the very initial stages, and where, like I said, on basis of current numbers, maybe valuations look expensive. But earning surprises could probably be stronger in some of these segments compared to a few others. So I think we have to just be a little more nuanced. Where things are probably already played out, we continue to hold, especially if at least as far as the theme is valid, and we believe that numbers will continue to flow. But there could be some other pockets on the other side where the story is just about getting started, and we can probably capture the same journey as what we did in a few others over the last 2-3 years.
Okay. Just one final question then one theme that you're most bullish on, other than the ones we've discussed, or a sub-theme, sub-segment?
I think we've liked healthcare for a fairly long period of time. We've, that's something where we probably more recently we've seen some correction and then a little bit of a bounce back as well. But I think that's something which stands out quite fine in terms of earnings delivery. I think valuations are somewhat more comfortable. I wouldn't say that they're cheap, but relatively more comfortable now. And I think we've seen a pause in some of those stocks in the last some time in that space, and therefore we believe that that is a place where we can probably now put incremental money to work. We've already had a decent positioning out there, but again, that's something which we are happy to add. And financial services, incrementally banks, but from a more structural standpoint, I think capital markets have remained our favorite for a fairly long period of time. And incremental opportunities continue to kind of beckon in that space from a more structural long-term standpoint. So I think these are some of the things, a couple of things which we've liked. And then, of course, as we discussed, the whole of the power sector, industrials, ecosystem, that is still something where we see fairly strong earnings momentum, and you have to be just a little choosy in terms of what valuations you pay, or probably try to look for companies which can deliver earnings surprises compared to the expectations of the market. So I think we don't have a choice but to go as granular and bottom up as possible in some of these things.
Got that. Ms. Tahir, thank you very much for joining us. Good speaking with you. Really appreciate your time and insights, as always, here on CNBC TV 18. Well, I think let's move on to the next conversation. We have Sanjeev Kumar Singh, Chairman and Managing Director at Hindustan Copper, who's now joining us. We're going to talk about a bunch of things. The business outlook, of course, for 28 and beyond that, FY 28 as well. Volume and production expectations, capacity expansion plans. There is this sort of tariffs on imported refined copper, and the entire tariff issue with regards to the US, which is going to be in focus as well. So once again, welcome to the program, sir. I have to say that today is also an important day because your tenure comes to an end, sir, at Hindustan Copper.
Yeah. Very good morning. You're very correct. Today is my last day in Hindustan Copper Limited.
Right. And short tenured, but I dare say an effective one, because I guess you took charge at a time when, copper as a metal actually it's been at the forefront in terms of the usage in new industries, etc. for the last few years. But Hindustan Copper, I guess, is the only vertically integrated copper producer in the country. So, sort of you presided over it over the last 1 year, sir.
Prashant, I'd like to say that before CMD, I was director mining in the same company. So I worked here for more than 3 years and then 1.5 years at CMD. So total period was 4.5 years, and the continuity was maintained. And this helped me in taking the company to new heights. And as far as the productions, what you have asked me.
Sorry, I'll come to the production, etc. here. So as you sort of, move away from the CMD position, sir, tell us a little bit about where Hindustan Copper is. Because, the focus for such a long time has been about opening up assets, which, of course, the company has, and operationalizing those assets. So just give us a sense of where things are.
See, as of now, all assets are open, number one. So the real picture you will see in 26-27. All mines are open, and all the tenders which were supposed to take this company from 4 million tons to 12 million tons are in place, awarded, work started. And the reflection you will see in the 26-27 results not only, I mean to say, very shortly within the first quarter results, you will see the increase in production from the last quarter. I mean to say, first quarter of 25-26 with respect to the first quarter of 26-27 will give you more faith and more comfort on Hindustan Copper Limited.
Mr. Singh, then in that case, if you could, give us some quantifiable numbers here as well, because the last time you joined us, you did say that you are indicating about 4.7 million tons in FY27, which was about a 25 to 28% jump from last year. The first quarter, where does that stand? And more importantly, beyond just the volumes, even copper prices, in your stated objective, you had assumed copper prices between $9,000 to $10,000 per ton. Prevailing copper prices are closer to 13,000. So that would obviously have a better, flow through in your EBITDA and net profit.
First question is easy that I can answer. I can just tell you that this first quarter will be definitely much, much better than the first quarter of 25-26. Don't ask me the figures. The second question about the LME and all that, copper prices, I can tell you still there is a mismatch between the demand and supply. So this mismatch and the requirement of copper as it is going on with respect to the AI and the data centers, as you must have seen, will definitely keep the prices bullish, or I always say tight. And you see the big miners in the world, for example, Codelco, their production has also been stagnant. The Grasberg mine, which was scheduled to come in 26-27, has been deferred to 27. So these things, these two particular elements will definitely keep the prices very strong.
The street likes what you're saying, if the prices are strong, because basis your guidance or basis your internal assumption, your 2030 net profit was closer to 1,600 crores. And I remember having this conversation with you. You said that these numbers are fairly conservative. And now that you're saying that prices are likely to stay higher, brokerages are estimating numbers between 2,500 to 3,000 crores when it comes to profitability by FY30. And I'm not even speaking about FY30. Let's speak about the current here and now. If you could give us the volume targets that you have for this year and also at what prices?
See, as far as volume, I already mentioned it's 4.7.
Yes.
The breakup is 3 billion tons from Malanchkhand. 1.2 will come from Khetri and 0.5 will come from the ICC group of mines, that is Ghatshila. So
Yes.
4.7, we are already on the target. I already mentioned the quarter one picture will show you that we are already on the target as far as the volumes are concerned. And regarding profitability, see, I again told you in last interview also that our focus is on the operational part, operational efficiency. We have to produce copper, ore, and concentrate subsequently at the lowest cost. Means we should see that the costs don't go away, don't go off from that. So operational efficiency is our prime focus, and definitely side by side we are developing other mines also, which will definitely help us in a later period of time. And I told you our target of MIC in this year 26-27 is already 32,000 plus, whereas last year we had done 27,421 approximately. So you can see what growth we have targeted. So first quarter we are on target.
MIC, I remember you said it would be between 33 to 34 as against, yeah.
Yeah, 33. That's what I said, 32,000 plus 33,000, yeah.
Right, and that would be margin accretive for you, right?
See, why I say plus, because what happens in the production of copper concentrate, the grade plays a very important role. Grade is not constant over the period of the year. Suppose if the grade falls, if I achieve slightly less than 33, so it will be wrong. So that's why I always speak out 32,000 plus or around 33,000 tons.
All right, we take that point. And, if you could give us a sense also on the near-term capex plans that you have. You said that you are not looking at raising any funds in the very near future. You have an enabling provision for a QIP, but you don't need external funding over the next 1 year. But given the prospects that you have, is there any chance that you will advance the capex and maybe as a result of that see an increased, requirement for fund and capex?
We are not going to advance the capex. I said 26-27, it will be around in the range of say 600 crores, and all will come from our internal accruals. 27-28, the capex may go around 1,000 crores, and that too also, we are trying to do it from our internal accruals. Although QIP is there, we are a debt-free company. So for debt, there is no issue for Hindustan Copper.
Right. Mr. Singh, there is, we know, for example, there are private companies which are exploring, copper assets overseas. And we've spoken to a few of them. Is there a focus overseas for Hindustan Copper as well?
See, I already mentioned we have an agreement with Codelco, the largest copper company of the world, which is a public sector like Hindustan Copper to the Chilean government. And we are already in advanced stages of taking the blocks there for the mining operations. Transaction advisor is already in place. They are doing EY India and EY Chile are evaluating those things, and we are making the commercial terms, agreements. We are already in advanced stage of discussion with the Codelco. Our team went there with our MOU partners. They have come back last month. It was in the last week of April itself. And things are in very advanced stages. You will hear some very good news from Hindustan Copper about the blocks being mined in Chile.
So could you give us some, we'll wait for actual details, but this is like an offtake agreement, and you will excavate and you will basically get the copper back here. That's
as far as with respect to the draft discussions with Codelco, we will be acquiring the blocks. We will do the mining operations jointly along with Codelco. We will do the beneficiation part, prepare the copper concentrate, and that copper concentrate will be brought back to the country.
Got it. And what are the quantum output that we're looking at, sir? I mean, just give us a broad sense.
No. That can't be spoken as of now because the blocks are big and unless until you do the designing part of the mine, you can't come to a conclusion of the capacity of the mines. No, it's improper to say as of now.
But the mines that you are going to acquire, you said you will acquire, right? You will have a sense of proven reserves, etc. Would that be something you can disclose?
No, that's better not to speak of because we have an NDA with them, and since both the transaction advisors EY Chile and EY India are working very closely with Codelco and Hindustan Copper, so at this stage, that's enough. I have said that we'll come up with some very good information when my successor comes. He will speak some very good things for the country, I should say. It's not for Hindustan Copper, it's for the country.
Well, we understand that, I'm sure, and you were evaluating reopening two mines which weren't part of your guidance, which was Dikchu and Pathargora. If you could give...
Yes. Dikchu, which is in Sikkim, we are already trying to make a joint venture with the Sikkim government. The joint venture agreements are to be finalized. The draft has been shared. There also the team had visited twice. I had met the Chief Minister, Sikkim also. Honorable Chief Minister was very positive. So things are moving well there. Simultaneously, you asked about that Dobani Pathargora block in Jharkhand. We have requested the Jharkhand government and the things are moving there also in a proportion.
All right. And you did 55% margin in the fourth quarter. Does that sustain in the first quarter?
That I can't speak out. I can only compare the first quarter with the first quarter because what happens, the mining operations, it's a cycling in nature. The first quarter is normally a development phase. The third and fourth quarters are the production phases, and the second quarter is the monsoon. So it's not...
So you can give us a full year guidance. You can give us a full year guidance.
Full year guidance, definitely we will... EBITDA margin I had mentioned, that will try to maintain.
You said 40%. That's far too different from, the 55% that you did in the last few quarters. And also the prices have maintained at higher levels, which is why we're just trying to understand whether you can, up that guidance.
It's not better to up that guidance as of now. No, it's not like.
All right, we take that point. Thank you so much. We tried very hard, but you kept your cards close to the chest.
Yeah. And Mr. Singh, congratulations once again in what has been a pretty eventful tenure. Further future plans, sir?
As of now, there is a cooling period of 1 year. I have to sit at my home and then I'll take up some assignments. Definitely, I'll work for the country. No doubt about it.
Thank you. Thank you very much for that. Appreciate it, as always, here on cnbc TV 18. Well, we'll take a quick commercial break here. The management of Kirloskar Oil with us on the other side. We talk about the data center opportunity and the outlook going forward for that business in just a bit.
Welcome back. We're actually at the low point of trade so far. The first hour, the Nifty is down 75 points. And the key factors that have dragged the market right now are one, Nifty IT. The IT index has actually moved to the low point, down about 2%. And the other one is Reliance. Reliance too is at the lows of the morning so far. So we'll monitor how that goes along because the Nifty Bank is not falling as much as the frontline index and the mid caps as well. Over the last few days, we've seen the mid-caps underperform, but today, actually, they're outperforming. And even with a cut of almost 0.2% on the index, the advance decline is still slightly in favor of the advances. 1,500 stocks in the green for about 1,300 which are in the red right now. But one stock which has actually done extremely well over the last 1 month, over the last 6 months, the last year, or maybe the last 5 years as well, is Kirloskar Oil Engines. And we do have with us Gauri Kirloskar, who's the Vice Chairperson and Managing Director of Kirloskar Oil Engines. And obviously, we will discuss their Hypernext win and the data center opportunity, the Kagal Capex, HHP growth runway, and growth as well as margin outlook for the company itself. Thanks a lot, Gauri, for joining in. The power gen segment, that's what everyone's talking about. And the kind of order wins that you've had in the data center opportunity, the hyperscaler opportunity. Could you give us a sense on, more potential that you're targeting here in terms of order wins, and at what pace can this segment grow over the next 2 to 3 years?
Thank you. Thank you very much for having me on your show. Yeah, great question. I mean, it's been very exciting to get the order last week because as a company, over the last 4 or 5 years, we've actually been really focused on increasing our product range into the high horsepower segment. And within the high horsepower segment, the data center segment is, of course, the fastest growing. I think, everyone is aware of the kind of capex that's being spent, whether it's in India or abroad. So it was a segment that we really couldn't ignore if we were addressing this section of the market. I think the way we look at it is the kind of customer that the data center customers is quite different from everyone else. It has a very different technical demand on the product. And for us, it's a big breakthrough win to have a customer have the confidence to place that large order on us. And so incrementally, we have to now be focused on execution. And we certainly hope that this will open up more opportunities for us in the data center segment, which is big. But, we have to execute and incrementally win those orders.
Gauri, will the revenue from Hypernext be booked in FY27 itself? And are there any other orders in the pipeline for data centers?
Yeah, great question. So the order, it's a composite contract. And so that means that we have the first fit product that has to go. And it also includes a large, not large, but a long-term service contract along with it. So the first part of it, which is the first fit, we do have a commitment that we would deliver it to the customer in this financial year. However, having said that, I think these kinds of projects are large projects. There's a lot of things that have to go right for the customer side to be ready as well. So I would put that caveat on it. In terms of other data center opportunities, look, we're talking to as many potential customers as we can. These orders take a long time. There's a long cycle in terms of, the technical specifications, and then you have to coordinate with the MEP consultants, possibly also meet the end customer as well to prove your solution. So it's a long process, and we're certainly engaged with many other potential customers in the segment.
Gauri, hi, morning. So just to map the market, right, because this is the first for you, and with regards to data center capex, we are just perhaps at the beginning here in India. We've got about 1.5 gigawatts operational. We've got, this number, depending on who you sort of ask, the numbers vary, but I've seen number 6 gigawatts, 10 gigawatts, by 2030 and beyond. Could you give us a realistic sense of what is the total addressable market as all of this comes up? Because all of this will require power and power backup, and this is all mission critical. So just give us a sense if you've mapped that.
So, just as you said, I think those numbers are changing every day. I think what's really important, because these numbers are huge, like you said, they're changing every day. Even the customers we talk to may have a certain pipeline, but the fact remains, like, what are you actually executing and how long will it take? I think that the numbers that we're seeing will happen, but it will maybe take a longer time to happen. So that's the way I think about it. We don't really look at it top down, meaning we don't say, okay, this is the size of the total addressable market for data centers just because it's huge. And then, maybe we could get a certain share of that. And that would mean this much revenue for us. I think in terms of where we are in terms of our technology and our product being out there, it really is a bottoms-up approach about proving our product at scale, where we now have the opportunity to do so. And we certainly hope that we'll be able to capture some of this opportunity.
No, I'm not trying to get a exact number from you or share this much, or that's of course hard to do because the numbers themselves are changing. But a large part of these numbers, for example, from 1.5, if we go, I think the next 4 gigawatts is already funded, so it is coming up, it is happening, right? What is in a typical data center? I mean, say for example, I don't know. I mean, if you take 100 megawatts, what is the power requirement, and where does Kirloskar Oil play, and how much of that ordering will Kirloskar Oil play? That's broadly what I was trying to understand. In some way, if you can relate that.
Yeah, so, that also, I think in terms of how we've addressed it, if you'll just allow me a little bit to talk about how we've actually gotten a breakthrough in this market. Traditionally, the traditional way to solve for the problem of guaranteed uptime, what data centers need is guaranteed uptime. And what they usually do, and what that means is that they solve for this by N+1 or N+2 redundancy, which means that if you need a certain generator for a certain load, you would actually have 2 or 3 of these generators sitting there idle. The way that we've addressed this problem is we actually have a multi-core technology, which we call OptiPrime. And this means that it's an N+R architecture, which means that by decomposing generation actually into multiple independently controlled power modules, which have an intelligent data layer on top of it, we've actually embedded this redundancy throughout the module rather than it sitting in idle standby generators. So just going back to your question, if there's a certain power requirement for building out a 1 gigawatt data center, then they usually have to buy N+2 or N+1 or N+2, and we've actually reduced the need for that, which has made our solution a lot more compelling.
Right. So I understand your reservation to give us exact numbers, the opportunities, because all these things are, dynamic. But there are estimates that brokerages have made. One of them actually expects your power gen segment to compound at over 35% over the next 3 years, which is at a much higher clip than your own growth. Would you believe that to be realistic, or is that an understatement or an overstatement?
So what I would say is, we have a goal also to be a $2 billion company by fiscal year 30, right? And that also implies a certain pretty high double-digit growth rate, with power gen being the largest component of our revenue. What I would say is that for us, in the domestic market, the low and medium horsepower space, we're pretty much saturated. We enjoy a pretty good market share. And so for us, the growth opportunity really exists only in the high horsepower market, which includes the data center market, as well as exports. Exports for us also, we have negligible market shares abroad. And so we really have the opportunity, if we play our cards right, to do it. I don't think it's impossible. To answer your question, I don't think it's impossible, but I would certainly put it at a very aspirational growth rate to be growing at 35% in power gen.
All right.
And I believe for your peer, Cummins India, because exports is a growth driver that you're looking to tap into going forward. And I believe for your peer, Cummins India, exports are restricted because they already have a parent entity there. On exports, what are the numbers, the pipeline, the TAM that you're looking at, or the opportunities, say, next 5 years down the line?
Yeah, so we're a very different organization because we're primarily, Indian, going out into markets outside. And I actually talk about it as international business rather than exports, which means that we're not just shipping out to distributors, but we truly have to build a business from the ground up. Whether it is to put in place a team, whether it is to find a partner or a JV, or to get our service network in place. So it takes a lot of time. We've made certain investments in markets that we've focused on, and those are the Middle East, where we've seen at least our exports growth over the last couple of years has primarily been from the Middle East region, as well as South Africa, the larger African subcontinent. And a little bit of Southeast Asia. These are the areas close to home. The big market and the largest market in the world is the US. We have been spending time there. We have been making investments there. But that for us is more of a longer term view in terms of us being successful in that market, because there are a lot of large incumbent players, but there's certainly a very large opportunity as well.
Gauri, just one detail that we want from you. The $2 billion target that you have, if you could tell us when that happens, what would your revenue composition look like? Right now, it's about just half of it coming in from power gen. You have a tenth coming in from exports and some opportunity in defense, all these factors. So just give us the revenue breakup at $2 billion, the aspirational revenue breakup. And what would the margin picture of the company look like? Because over the longer period, these are margin accretive bets that you've taken.
Yeah, and exactly that. I think, the idea is to increase the share of revenue from margin accretive businesses. And those for us remain the same. The pillars have always remained the same. It's high horsepower business, it's international business, and it's aftermarket business. So if you look at the growth of all of our business units over the last couple of years, they've all grown very healthily in double digits. And what I would say is that we would certainly want the international business to be a larger component of the overall pie. We would also at that point have seen a larger uptick in the aftermarket revenues because of, say, CPCB4 Plus warranty period being over, as well as larger AMC contracts being signed on high horsepower customers. The defense opportunity, I think you would have seen we made an announcement recently that we formed a separate defense subsidiary. And the reason we've done that is because I do think that as a company that has its own in-house R&D, as well as IP that is really owned and owned in India, we have the opportunity to do much more than we currently do under the Make in India initiative, and to give it that focus, to have a separate team and capital allocated to that business was the idea of setting up that subsidiary. So I certainly do hope that gets traction as well.
Okay, all right. Gauri, we wish you all the best of luck and hope you come back and we can have these discussions once in a while. Thank you very much for joining us here.
Thank you very much.
Thank you. All right, well, let's just look at markets which are just treading water, nothing much, 60 points lower, 23,890 is where we are at. Market breadth is almost even Stevens, 1,500 up and about 1,350 stocks which are lower. Now, the quick commerce race in India is intensifying, and biggies like Amazon and Flipkart are scaling up their instant delivery services. Our colleague Shireen caught up and had the opportunity to speak with Amazon's top boss, Andy Jassy, on his big India bet worth about $48 billion. Here's an excerpt from that conversation.
Let's talk about India, Andy. As I pointed out, it's about $75 billion that Amazon, 40 already done, 35 committed to India. Are you topping that number now?
We are. So as you said, we've invested about $40 billion since 2010 in India, and we announced another $35 billion by 2030, and we're upping that by another $13 billion, so an additional $48 billion total by the year 2030.
And how is that likely to impact the listed quick commerce spaces and the new IPO that is likely in the quick commerce space itself? We have Karan Taurani, who's the Executive Vice President, Elara Capital, joining in. Karan, we've spoken so far about the quick commerce race intensifying, even as some of the players are looking at optimizing their mix and getting to profitability. And this at a time when biggies like Amazon, Flipkart, and even Reliance hadn't even made public their commitments to this space. Do you think there's another round of competitive activity that will play out in the quick commerce space that would make profitability and perhaps the valuations a little more elusive?
Hi, Mangalam. Morning. I think what's happened here is that clearly, as per our earlier conversations, you are seeing a convergence of e-com and Q-com. Just to put things in perspective here, very briefly, Q-com is close to 10 to 15% of India's e-com market. Now, why are e-com players chasing the Q-com market aggressively? Because when Q-com started, it was a mere grocery proposition. But Q-com has, in the last 2 years, scaled up into various other categories, which are a sweet spot for the e-com business, in the likes of beauty, personal care. There has also been small white goods, apparel, accessories. So I think e-com players or other larger incumbents like Amazon, Flipkart coming into this business clearly make sure that this model is here to stay. And, the consumer behavior will change permanently and it is kind of irreversible to a certain extent. So I think it's good news that Amazon is coming in. But I think to put in things context here that, you will see stability as far as profitability is concerned. You will see winners and losers within incumbents of QCom. So companies which were betting on discounts, companies which were betting on pure price wars, will focus on profitability. We have seen that in the case of Instamart. This is going to be probably the first quarter when they'll have a contribution break-even. They have curtailed their growth guidance downwards. On the case of players like Blinkit, I think their moat is very strong. On a unit economic standpoint, they are the only players which are contribution profitability and EBITDA break-even as far as quick commerce is concerned. And as things go by, you may see some kind of jitters in terms of price wars. But from a longer-term perspective, I think Blinkit also, we may not see any negative surprises because if you look at the management, I think 3 quarters back, they had guided for 100% plus growth. And last quarter, they did come out with a guidance of 60% plus, which means they've revised the growth guidance downwards. So largely, the negative impact of e-com companies, coming into the QCom business is largely priced in. And now it is all about internal execution. So if Blinkit were to able to grow their EBITDA margins or the profitability in the QCom business consistently over the next 10, 12 quarters, you will see a consistent re-rating in terms of valuation multiples for them.
All right. And what about, Instamart? If you look at the 3-horse listed race or the likely to be 3-horse listed race, you have the updated red herring prospectus coming in from Zepto. You have the details that Swiggy has put out already. Does it so appear that Instamart is, slowing its quick commerce business down or not finding the kind of value because of the competitive activity that is taking place out there? And in light of that, what would your view on the stock be?
So firstly, I think if you look at Instamart, there's a clear focus here that they want to achieve contribution break-even, and they have successfully executed that. Most probably, we believe that they should be a contribution break-even in Q1 FY27. But for them, the EBITDA break-even is still some time away. I think they'll take another 2.5 years for EBITDA break-even, given the kind of losses they are making right now. I think it's a conscious effort because what happened after Swiggy's QIP was that there was a bet wherein they could actually grow faster, closer towards 50-60% in terms of growth rate, and also achieve profitability. But because there was no positive impact as far as contribution is concerned, or because there were no reduction in losses, they had to compromise on growth. I think they've taken this call, and I think if profitability does come in, you actually see some value, for the business, because on the current market cap basis, if you value the food business, the quick commerce business is trading at virtually zero valuation or negative valuation. So I think from that perspective, they have taken a bold call. I think execution is what they have to do from here on. Plus, I think, the category is becoming bigger. So I think, Mangalam, about a year ago, when we spoke to people on ground, quick commerce as a category, we did not know if it will scale up in the non-metro markets. But in the last 6 months, the feedback has been quite positive and mixed, wherein the category is doing well in the non-metro markets as well selectively. So because the category is becoming bigger, both from a vertical standpoint and from a geographic standpoint, I think there is opportunity for 3 to 5 players to coexist here for now. And I think Blinkit will be one of the larger players which will coexist with Amazon and Flipkart.
And your pecking order remains Blinkit over or Instamart, Blinkit over Instamart or Eternal over Swiggy in terms of stock price?
I think definitely we would still prefer Eternal over Swiggy, because I think Swiggy is more of a high risk, high reward. It's clearly the bet on execution. The growth rates have kind of converged. Swiggy potentially will lose market share in the QCom business over the next 2 years. As far as Eternal is concerned, we believe that they'll potentially maintain market share with this kind of competitive intensity. They don't need to gain market share because they're sizably large as far as QCom business is concerned. They're close to 35-40% kind of market share. And I think if they execute on profitability, you will see rating of valuation multiple, for the quick commerce business and Blinkit.
And you don't see these things changing with the announcements that the larger players have made, which includes the likes of Reliance, Flipkart, and Amazon?
So I think if you look at Amazon, Flipkart, and Reliance, these are some broad numbers that we could kind of gather through our checks. But, their e-com business is still sizably large. I think if you look at their QCom penetration, so their QCom orders as a percentage of e-com orders is not more than about 7 to 12% in a best case scenario. Secondly, they are actually trying to transition their e-com customers to QCom in terms of better user experience. Because what was happening is that the customers are migrating from e-com apps to QCom apps as far as certain categories are concerned. So this is more of a value add kind of a thing which they're doing. This is is more of a survival because, QCOM is going to eat into e-com's vertical market share, which is why e-com is forced to enter into QCOM. As I said, both will coexist. And I think the winners here are going to be the one who would execute well as far as profitability is concerned. We don't see QCOM business proposition going into price loss for a long time from here on.
All right, take that point. The impact of this on the staples and the distribution modes, etc., we'll discuss at another occasion, and your call on other consumer stocks as well. But for now, thank you so much for joining in. With that, we'll take a short break of the news that the market holds with a cut of almost 30-odd points. Recovery in the Nifty Bank, actually, which has done extremely well, up around 1/3% at the high point of trade. Let's see whether this can take the Nifty higher from here too. On the other side of the short break, we have Manisha Gupta joining in with the focus on the commodity space.
Welcome back. As promised, let's talk commodities. Manisha is now joining in to tell us more. Manisha, what are you looking at?
Well, I'm looking at the month of June, behind, and it's actually been a negative month for most of those commodities there. Energy, precious metals, base metals, many agriculture commodities also are headed for a weaker June this time around. And that is because the markets are pricing in a 60% probability of a Fed rate hike in the month of September and an 80% probability for a rate hike in the month of December as well. The dollar index continues to trade around those 14-month highs. That has been pushing the dollar-denominated commodities on the lower side as well. And then it has been about the geopolitical tensions easing. That has led to some money coming out for many of these tangible commodities. Take a look at the gold prices, and we are trading below $4,000 an ounce.
All-time high has been 5,600 in the month of January. It has been a 2% decline in the overnight markets. We are trading below 4,000. Another 0.5% of a decline coming in for the Asian markets. And prices are headed for an 11% decline for the month of June. It's down 14% for the June quarter as well. Not just gold, the silver prices are trading at the lowest since December 2025. It's a 20% decline in the month of June coming in for silver prices also. If you look at the overall decline that we have seen in for the crude oil prices, well, that stands at 20% down for the month of June and 23% down for the quarter as well. The decline in crude price comes in on the back of US-Iran peace talk, reopening of Strait of Hormuz. The markets are now watching out for the talks in Doha. The overseeing of traffic through Strait of Hormuz is in focus right now on whether or not the premium or a toll would have to be paid there and who really handles or controls Strait of Hormuz. So that's going to be an important development to watch out for. Take a look at the metal prices, and they're all negative as well for the month of June. Copper is down 6.5%, a very sharp 17% decline for the aluminum prices. All the war premium going out of there. You have zinc, which is down 3%, nickel down 15%. All of this decline coming in matter of last 1 month itself. And then you also have the ferrous metals. Iron ore is down 4.5%, steel down 4% as well. And the PGMs have declined as well. So palladium is down 12%, platinum down 18.5%. There's no place to hide. Almost everything. All of these commodities are trading in the negative for the month of June. The final plate should come in on your screen, and that tells you on how the agri-commodities have performed, a negative there as well. Barring sugar, which has gained 2.5%, everything else, whether it's edible oils, rubber and industrial commodity, which is down 9%, corn down 9% as well. And the markets do believe that as of now, all of these agriculture commodities are not factoring El Nino in Southeast Asia. If that happens, you perhaps could be looking at a turnaround there. But the precious metals, energy, perhaps could be looking at further declines.
All right, Manisha, thank you very much for that. So, as we wrap up, June is largely all negative across commodities. We take a quick commercial break. We are back, and Lata on the other side discusses the agri roadmap with some of the best experts in the field, the impact of a 42% shortfall in the monsoons as of the end of June. So that conversation comes up in just a bit.
Welcome to Indianomics. The monsoon deficiency for the month of June is a whopping 42%. The total sown area for all major crops as of June 28th for cereals, pulses, oilseeds, all major crops is between 4 to 20% below the long-term average. The IMD has forecast good rains in the first half of July, but has also said that El Nino conditions are seen rising through August and September. So, are there chances of the monsoon getting more deficient than the 90% that the IMD has forecast so far? What will this mean to agri output, to food inflation, and more importantly, to rural prosperity? For all these questions, I have with me Dr. Ramesh Chand, former Niti Aayog member and currently distinguished professor at ICRIED. Also with me is another agri-expert, Harish Damodaran, rural affairs and agriculture editor at the Indian Express. Gentlemen, good morning and thank you very much indeed for your time. Dr. Chand.
Good morning.
To start with you, sir, minus 42% for June and area sown in terms of acreage is about a good 8% less for rice. For oil seeds, it is, a minus 19% compared to year-ago levels or compared to the long-term average. Would you worry that this time the agri output can be badly hurt?
Yes, there is a concern, but first I would like to make a technical correction in the deficiency that we are looking.
Yeah.
You see, two things have combined. One is late arrival of monsoon, and second is less rain than what normally we expect. If I make allowance for late arrival of monsoon, then deficiency is about, say, 30%. It is not 40%. So that's why when we are comparing area, we should compare the net sown area of previous week with the current week. Okay. That is just one correction. But of course, the magnitude of deficiency, even if it is 30%, it is quite big. It is quite large. So even if subsequently rainfall is normal, the output in rain-fed area is going to be affected. This is what I can say as of now, that if in the future things are normal, then what is the effect? Then I would say that rain-fed area is still affected. Irrigated area may not be affected. But since we have this forecast that El Nino is going to affect rainfall in August, in July, so I think we should prepare ourselves to meet the contingency, to meet the eventuality. Just one more number for the your viewer I want to add, that if we look at the total rainfall, June we normally get about 18 rainfall. 18% is the share of June rainfall in the total rainfall. So 40% efficiency would mean, you can just say, in the overall 7%.
Okay.
So that is the kind of situation.
Because June is much less than other months, therefore it is more like a 7% is what you're saying.
Yeah. Overall, in the overall. Okay. If the rest is normal.
Got it. Harish, if you can add a little more color to what you are picking up from IMD and from your prior experiences of covering the country like no one else has, do you think we have to be prepared for more than 90%?
See, I think this June has been a shocker because this deficiency which we are talking, 42% or something, it is even without El Nino, because El Nino is still in what they call as a moderate phase. It's not yet strong or whatever, super strong or something. So even with a moderate El Nino, we have 42%. And plus, you must see how. First of all, it arrived in Kerala on June 4th, which was basically 3 days late. Then you had some initial progress. Okay. And then if you see, I think till 15th, I think the deficit was something like 32%. Then you had the monsoon made no progress at all between 15th and 21st. Okay, then there was some revival, your Bombay, Maharashtra and all got. Now again, after 24th to 30th, the monsoon, whatever, the northern limit of the monsoon as they call, it's static, it has not been moving. So I think when we started off the season, what we thought was, June, July will be okay, and then El Nino's effect will kick in. So here we are seeing that even before El Nino has kicked in, we are seeing a deficient monsoon, and we have the prospect of, whatever strong and super strong and all, maybe from September onwards. And then we enter the Rabi seasons, and El Nino is not, it's not, the impact is not just low rainfall, it also translates into warmer and shorter winters, So I would be more worried about the Rabi crop, I think Kharif we'll manage, somehow we have enough stored this thing. And as I think Dr. Chand was saying, we have some irrigation cover. So I would be more worried about Rabi than Kharif right now, and of course what I'm saying, about June I think was unexpected. I think IMD was saying 10%. Now it looks like we'll close this month with 40%, and we are entering, into whatever into a strengthening El Nino. If there was no El Nino, then I wouldn't have been worried, then it's okay,
Yeah.
A weak June is fine, July, August would be fine. But if we are entering an increasingly constrained kind of a situation, that kind of, it makes things a little worrying. And especially, Rabi, I think I would be very worried.
Okay. Yeah, actually, the IMD may give us a more updated number later today at their press conference, but we will work with what we have. Dr. Chand, what do you expect in terms of impact on specific crops? The output of rice, the area sown, as you pointed out, is less because it's -8% because it started late. But do you think we are going to end up with a much lower crop in terms of cereals, pulses and oilseeds? Oilseeds is -19% if you compare June end to June end of 2025. So which specific big crops would you be really worried about?
I will be worried about, say, soybean, because more than 95% area under soybean is rain-fed. As far as rice is concerned, you see, in case of rice, 3/4 area is under irrigation.
Yeah.
Last Sunday, I came back from Punjab and Haryana, I found all around the national highway, the rice transplantation is not less than the area covered last year.
Okay.
So rice is a 3/4 area irrigated. I think there the impact will be much lower. The biggest impact will be where we have more than 90% rain-fed area under individual crop. And there we have this soybean, even maize in Madhya Pradesh, irrigated area is only 4 or 5%. So we have pulses, we have millers, we have oil seeds, which will be worst affected. And that is the experience from the past also.
Okay.
That in the irrigated area, the impact is much less. Though impact is there, but it is much less.
Okay.
So I would say that oil seed, since soybean is our biggest oil seed, and in Kharif it is a dominant oil seed. So the other one is groundnut. So biggest impact I expect on soybean, then cotton, then in some state, then these nutri cereals, they will be affected much more than the, as you are also showing the number,
yes.
-19.
Yes.
Cotton also 15%.
Yeah, those are acreage.
So,
yes.
Yeah. So even based on the general framework that which area and which crop are affected more, it is directly based on area and irrigation.
Okay. So would you worry about inflation, sir? Because ultimately cereals are the biggest weight in the CPI, and there we have good buffer stock. Oil seeds, edible oils is importable. We depend a great deal on imports anyways. So if you have to make an assessment on inflation, what would it be at this stage?
It looks like market is already factoring in this fact. In the case of rice, we have comfortable buffer stock, and even otherwise we produce 26% more rice than what we require. And if you look at yesterday's retail price and 1 year back retail price, rice is only about 5%. But the impact is visible in case of edible oils. There could be many reasons at international level also. So it's not that El Nino is affecting only India. Some other reasons are also going to be affected. This heat which we are witnessing.
So imported prices of edible oils are also likely to be higher, you're saying?
Can be. Yeah, can be. You see, for two reasons. One is as we are seeing this so much heat in Europe, and sunflower is a major crop in Europe. We also import some this sunflower oils. Like you see, it affects through so many channels. And also, since India is the biggest importer of edible oil in the world, so if there is domestic shortfall and market factor in, so price generally goes up.
Okay.
So I think there will be
food inflation.
Pressure.
Okay.
There will be pressure. We can't say there will not be pressure on price.
I will come back to you for a more exact number, which you all may have calculated in a career, even if it is a floating number. But Harish Damodaran, the other reason why we want, rural, why we worry about monsoon is rural prosperity and rural consumption has been a big bulwark in terms of consumption for the Indian economy. In your perambulations in rural areas, would you worry that rural demand for, as a fuel for Indian economy may be less this year?
Last 2 years, in 2024-25 and 2025-26, we had excellent agricultural output.
That's right.
Both these were non-El Nino years. So if you see last year, I think we sold something like 11.6 lakh tractors. I think tractors are the best indicator of rural consumption demand and those kind of things. Whereas and plus you had relatively low food inflation also. So I think definitely if the rains aren't going to be good and more worryingly, if the temperatures during the winters are not going to be good, I think there will be a problem as far as rural demand is concerned. But overall, I mean, just adding to what Dr. Ramesh Chand said, because see, not only India, the world over had very good the agricultural output both in 2024-25 and 2025-26. In fact, record production, so it is not just India, even world over, whether you see rice, wheat, rapeseed, palm oil, everything, So we have entered this drought year, whatever, like I think Dr. Ramesh Chand was talking about, the high temperatures in Europe. And then, of course, now El Nino, which will also impact places like Indonesia and Malaysia, our palm oil. So we have started this year with high stocks, and that is what is keeping our inflation low, So if you see, I mean, even globally, your oil prices rose, your gas prices rose, coal rose, gold rose, all your base metal, everything rose, whereas food inflation has been relatively mild, So I think we have started off with high stocks, and this should, to some extent be some kind of a, buffer.
Yes.
But I don't know whether this buffer will last us beyond Kharif,
I can see.
We need to look forward.
I can see that you are more worried about
Rabi.
You are more worried about the second half for two reasons: that the stocks should last, and whether the strengthening El Nino conditions and the heat will impact the Rabi crop as well, and that would mean rural prosperity.
Globally and here.
Got it. I want to tie down both of you to some numbers, but I have to take a commercial break. That is numbers for CNBC TV 18. Coming back from the break and getting more solid numbers on both output, inflation, as well as likely problems we may have because of the global prices. All those questions after the break. Well, for Bazaar viewers, it's Chartbusters time. You will get to hear the entire chat after market hours.
Well, it's a rocky start on the monthly expiry day. The market opens higher, quickly gives up gains, but also comes off lows. It's the IT sector, which is the top sectoral loser. Reliance also bowing down the market, but the Nifty Bank is flat, outperforming, even is the midcap index.
HDFC Bank appoints ex-Chief Election Commissioner Rajiv Kumar as part-time chairman, while Puneet Sharma is appointed CFO designate after stepping down from Axis Bank. Axis replaces him with ex-Bandhan Bank CFO Rajiv Mantri, whose resignation was announced just yesterday.
Delhi's cabinet passes the EV policy, targeting 30% of the total fleet being electric by 2030. Stocks of Ola Electric, Eicher, are higher, whereas Eicher slumps due to lack of electric offerings.
KEC International rallies 4%. The management tells CNBC TV 18 that the company is one of two potential bidders for an HVDC project next Monday. Also, they tell us that over 6,000 crore rupees worth power grids projects will be now open to bidding for tenders for the company, a good opportunity that lies for them.
Maruti Suzuki is one of the few legacy auto gainers. Jefferies has upgraded the stock to a buy rating, raised its target to 16,500 rupees a share, citing strong demand and easing input costs. The stock up 3%. Stock Nifty gainer. Good morning. You're watching us here on Chartbusters. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Vinny Motiwala. It is dilly-dallying for the market right now. It's down about 50 points for the frontline index, but the midcap index is actually outperforming. The Nifty Bank is outperforming, and a couple of these consumer discretionary plays doing extremely well. Case in point, Maruti, which we alluded to in the headlines. We have Titan as well, which is up nearly 2%. And then we are seeing some traction in names like Bajaj Finance and Bharti Airtel. On the way down, it is the IT pack, which is taking the frontline index lower, and Eicher Motors, which is a non-EV play, which is playing out in the market right now. Among the stocks that have surged in just the last few minutes, we have Amara Raja, which has moved to the high point of trade. And we've also seen some traction in Cochin Shipyard. More stocks advancing, a few more stocks advancing than the number of stocks which are declining. Good morning, Vinny.
Hi, good morning, Mangalam. A few more stocks that are at least advancing than declining in today's trading session. So let's just look at the chart, right? But very close to each other, just very few in terms of the numbers that are advancing. But nonetheless, we're seeing the broader end of the market, especially the small cap, which is doing better than the benchmark indices. That outperformance is coming in there for them. So watch out for that. And today, in terms of some bit of a green, we have the Nifty Realty as a sector which is holding on to strong gains in the trading session. Watch out for that. Slight bit of a gain for the banking side, while IT on the flip side is among the top sectoral losers. But yes, that's the market setup. A lot of individual movers in trade as well, and that's what we'll be talking about. On that note, let's also bring on board Manish Hatiramani for a technical check on the market. Manish, good morning. Thank you so much for joining us on the show. Today, obviously, is the monthly expiry that we have for the Nifty as well. Yesterday, also, we saw a bit of a downtick coming in. And today, after opening up a bit on the higher side, we're seeing Nifty trading at the lower levels, most of that near that mark side. 23,898 right now. What are the levels you're keeping an eye out on now?
Good morning, Mangalam and Vinny. Thank you so much for having me on the show. Well, during our last interaction, we did discuss the importance of that level of 24,250 being a stiff resistance level. We reacted very fiercely and instantly thereafter. 23,850 would now be the level to watch out for in the short term. We did see, I think, about 851 as today's low, but I would be watching out for a closing below 23,850. If we are able to do that, the index might lose some short-term stability and we can fall to levels closer to 23,700 and then 23,550.
Right. On the Nifty Bank, what are the levels that we should be tracking, Manish?
So I'm working with a support at 57,600. As long as that holds, we will be aiming higher. If we break that level, it could be a slide all the way down to 56,800.
And currently on the way up, what's the target here?
I would be looking at an open target of about 60,000.
And an open target on the Nifty would be?
On the downside or on the upside?
On both sides.
Well, on the upside, we still have a very stiff resistance of 24,250. If we can get past that on a closing basis, I would be looking for 24,600, 24,700.
Manish, what are the top stocks or top picks you are looking at this morning?
I'm working with 3 sell calls. My first sell call is on Kotak Bank. which is for a target of 380, stop loss of 412. This stock resisted around the 415 levels and we turned from there. Yesterday's volume has supported this decline in price. The second is on Adani Ports for a target of 1745, stop loss 1835. This stock had turned sideways after 2nd of June, and we are now seeing early signals of this range breaking on the downside. The third one is on Reliance Industries for a target of 1265, stop loss 1310. 1335 to 1340 were resistance levels for this stock, and we have respected them and taken a U-turn from there. Post 29th of May, we are also seeing inclining volumes with a price decline on most days.
All right, we take that point. Just before we let you go, you want to revise your calls on Kotak Mahindra Bank once, because looking at your target at 380 and stop loss is closer to 410, right? If I got that right?
Yes, that's right.
Because the stock is at around 394, so that gives you a return and risk ratio of 1:1.
That's correct. So Mangalam, because of that reason, in such situations where risk reward is skewed, I would probably want to sell when the price goes up a little higher.
Okay, take that point. Thanks a lot for joining in and giving us your calls on stocks as well as the index. With that, let's get in our ideas for profit segment coming in from colleagues at Money Control Pro. Varsha joins in with a stock that she's tracking. Varsha.
We are talking about Radico Khaitan, where the growth story is steadily shifting to a more balanced premium plus luxury play. The real driver continues to be premiumization. In FY26, Prestige and above volumes grew 28%, led by strong traction across brands like Magic Moments, After Dark, and Royal Ranthambore, all steadily gaining market share in the rising demand environment for premium spirits. What stand out is now this mix shift is how feeding into the profitability. EBITDA margin has improved to 19% in the March quarter, reflecting a better product mix rather than just cost tailwind. At the next level, the luxury portfolio is beginning to scale meaningfully. Brands like Rampur Indian Single Malt and Jaisalmer Craft Gin are gaining visibility with luxury revenues already crossed to rupees 475 crore and expected to grow another 25% in FY27. Adding further support is the potential India-UK FTA, which could improve sourcing economics for Scotch-based premium whiskies and support margin stability. At around 52 times FY28 earnings, valuation are not cheap, but with multiple growth engines now firing, premium luxury and balance sheet improvement, the long-term story remains well supported.
Okay, thank you so much for that. But let's take a short break on that note. And after the break, we'll come back. We'll get you more on markets, more stock-specific action. Stay tuned in. Welcome back to Chartbusters on cnbc TV 18. Nifty as of now still at those 23,880 levels, seeing a bit of a decline from when we started the show. Slight bit downtick that we're seeing coming in for the Nifty 50 as well. But on that note, there has been a bit of a musical chairs underway at the big banks, and with HDFC Bank, Axis Bank and Bandhan Bank all involved in this. Let's go across to Ritu to give us details of the CFO rejig, what's happening here in the private banking side. Ritu, over to you.
Well, thanks for that. Big leadership moves at HDFC Bank overnight. One that closes the chapter on months of governance uncertainty, and another that's triggered a game of musical chairs among top banking CFOs. First up, HDFC Bank has named seasoned bureaucrat, the former DFS secretary, and the ex-chief election commissioner Rajiv Kumar as its new part-time chairman for a 3-year period, subject to RBI's approval. And he's also been appointed an additional independent director on the board for 4 years, with shareholders set to vote on his appointment on the 5th of August at the AGM. Now, with the chairman's appointment in place and that clean sheet from the external legal review on the allegations that were made by former chairman Atanu Chakravarti, some of that governance overhang on the HDFC Bank stock hopefully goes away. And importantly, this also now clears the path for the reappointment of CEO Sashidhar Jagdishan, which is expected to be taken up in the coming days, as we've been reporting right here on CNBC TV 18. Now, separately, HDFC Bank has confirmed another news break. It has appointed Axis Bank's outgoing CFO Puneet Sharma as its new CFO. Puneet Sharma, of course, has been at Axis Bank, their CFO since 2020, before which he was also the group CFO at Tata Capital. And now, as we reported first here on CNBC TV 18, he's set to take over as the CFO designate first at HDFC Bank starting September, and then formally take charge as a full-time CFO in December after the incumbent CFO Srinivasan Vaidyanathan retires from HDFC Bank in October. So the question is, who replaces Puneet Sharma then at Axis Bank? And that's the question, and that's where this game of musical chairs has been set off. Our sources indicate that Bandhan Bank's outgoing CFO, Rajiv Mantri, who again announced his resignation at the bank just yesterday, brings more than 25 years of experience across Bandhan, Citi, Stancy, etc., is all set to join Axis Bank as its new CFO to replace Puneet Sharma, who in turn will be headed to HDFC Bank, completing this 3-bank CFO reshuffle, with Bandhan Bank, of course, still left to hunt for a new CFO.
All right, Ritu, thanks a lot for that. One of the stocks of the morning right now, we have Godrej Properties, which is up 2.5%, surging right now. We have Cochin Shipyard, which we just spoke about. That too is seeing a big spike. And a lot of these Mumbai-based real estate players, in particular, Godrej Properties, like we spoke about, look at Phoenix Mills as well. That's up around 2% too. So we are seeing a bit of a spike across the board. Lodha Developers also has moved to the high point of trade. But among the stocks which are buzzing around since morning, it is KC International. In a relief, Power Grid has revoked its exclusion order on the company ahead of schedule. Earlier today, we spoke with Vimal Kejriwal. We discussed the plans for them to bid for HVDC projects as well, and Power Grid's move to revoke the tender restrictions and the incremental positive impact it could have on their business. That stock up 2.5%. Let's hear out Vimal Kejriwal.
I think the bidding is happening next Monday, if I'm not wrong. So once the bid happens, then maybe a month or two, unless the prices are wavered, then the government may take time to decide. If the prices are normal, it's on a fast track. So I don't think it will be months. It will probably be weeks when it gets decided. There are 2 players on the converter side. Okay, transmission side, there are a lot more players, obviously. And also what will happen is on the bidding side, we are seeing a lot more interest. It will at least be 50 to 60%. About 10 plus tenders from Power Grid which are in the market today to be quoted in the next couple of weeks itself. Okay, and I think the total amount is roughly more than 6,000 crores out of that. And since these are tenders which they will also bid in for TBC, we are assuming that they win 50%. Let's put a number. Then at least 3,000 crores would translate into orders for EPC companies.
Okay, that's KC International for y'all. We'll watch out for that. As of now, stock holding on to more than 2% of gains. On that note, we're going to submit a very short break. More about the markets, more on the stock side as well after the break.
Back among the stocks in the in the small cap space, the ones which are spiking right now at decent volumes. Look at Arvind, up around 8.5%. Global Spirits is the other one which has seen a big spike as well. And just the last few minutes with a decent amount of volumes backing TV Today. So look at that one as well. That's seen a decent spike. But the ones which are in focus today, the auto pack, specifically the electric vehicle pack. We have Sudarshan joining in on an update on the Delhi EV policy, the impact of that, the brokerage call, and the stocks that get negatively impacted by that as well. So
the reason you have mentioned, because your auto names are in the focus, are Delhi government's approval to electric vehicle policy 2026-2030. If you talk about the details, all the details are the same that they had announced in draft in the month of April 2026. And now government is looking to implement this policy from tomorrow, or say July 1 of 2026. So talking about highlights, first, government is looking of 30% electrification by 2030 of its entire fleet. From Jan 1, 2027, only electric three-wheeler will be registered, and for electric two-wheelers, it will be the same from Jan 1 of 2028. Talking about the incentives, electric three-wheelers will be getting incentives up to rupees 50,000, and electric two-wheelers will be getting incentives up to rupees 30,000 in the first year of the implementation of EV policy. Now, if you're looking to buy electric cars, your road tax and registration charges might be waived off if that is registered in Delhi. Now, what's the impact on all the names? So just I have taken one parameter, that's the EV contribution to the total volumes. Today, top Nifty loser is Eicher Motors, because there is almost zero contribution to electric vehicle for Eicher Motors. Coming to Hero MotoCorp, it's in the range of 2 to 3%. That's the reason this stock too is under pressure, down somewhere in the range of 1 to 2%. Bajaj Auto and TVS Motor are better placed if you compare against peers. For Bajaj Auto, the contribution of EV to total volumes is in the range of 8 to 10%, and this comprises of both two-wheelers as well as three-wheelers. For TVS, it's in the range of 6 to 7%. Ather Energy and Ola Electric are higher in the trade because entire contribution to their total volumes comes from electric vehicle, and they are 100% pure EV players. In the passenger vehicle space, for Mahindra and Mahindra, contribution of electric vehicle is in the range of 6 to 7%. And as you know, Tata Motors PV is in the leader, and it holds the market share somewhere around 40 to 42%. And total contribution to volumes from electric vehicle is in the range of 12 to 13%. So bottom line, the implementation of Delhi electric policy is not that impactful. The real impact can only come if the neighboring states like Haryana and Uttar Pradesh also decide to go for similar measures, because the contribution from Delhi to total volumes of all these OEMs is still in low single digit.
Take that point, Sudarshan. Thanks a lot for that. So those are some of the details that have come in from the Delhi EV policy. Neighboring states more crucial right now. But it's not just the auto space. We're seeing the auto ancillary space as well, which is spiking right now. Uno Minda has actually moved to the high point of trade. And alongside that, we've seen some traction in Indian hotels as well. Indian hotels actually seeing a bit of recovery as we speak. It's up around %. It opened in the red. So from lows of today, it's recovered about 2% and moved higher. Though remember, the stock is still a significant distance away from its 52-week high. Among the other stocks in the broader markets which are doing well, we did speak about Cochin Shipyards, but look at Mazagon Dock. That too has moved higher, and all the defense stocks are moving higher in a pack. And finally, before we leave you on this edition of Chartbusters, don't lose the sight of Bharti Airtel, which started out well, had a decent contribution to the frontline index, right now as well has moved to the high point of trade. So if at some point the contribution chart of the Nifty comes up for you on the screen, you'll see among the top contributors, among the top 3, would most definitely find Bharti Airtel as it's mentioned. There you have it. The top contributor is Bharti Airtel, followed by Maruti Suzuki. With that, we wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up next from Vinny, me, the entire team. Thank you so much for watching.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Fatakia. Joining me as always is Ritu Singh. Well, it's been topsy-turvy start for the markets and volatile at best, and unsurprisingly so, considering the fact that it is the monthly expiry today of the Nifty contracts. As this very brief recovery that you saw over the last few minutes is now starting to get sold into yet again. So we are back below the mark of 23,900. The bulls would be looking to at least defend the 23,800 mark on a closing basis. We have been hearing from a lot of the technical analysts as well that in case we close below the 23,850, 23,800 zone, there is a very decent chance that the Nifty clips below the 23,700 or even towards the 23,500 zone. But as always, there is plenty of stock-specific activity, Ritu.
There is so much activity today, Hormaz, whether that is the banking stocks, the auto, or more specifically, the EV stocks. And we'll cover all of that through the course of this show. But, you know, look at the market breadth, though. That tells you, despite, you know, the frontline index showing red, flashing red on your screens, you have the advanced decline ratio that still shows you that there are more stocks that are advancing than declining. About 1,600 stocks that are, you know, advancing on the National Stock Exchange versus about 1,340 stocks that are on the decline. What's holding up still in, you know, green is the broader markets. You have the midcap index, which is trading with a gain of 34 points, and the small cap index with gains of about 85 points. But yeah, it's the Nifty IT pack that's dragging the markets lower, trading with cuts of almost 1.8% as we speak. And the bank Nifty, which has been flattish since the start, has now again slipped into the red below you know, the 57,700 mark, now at 57,680 odd levels as we speak. So, you know, plenty of action as always to cover. So let's go across to Hormaz, who's walked over to the wall to put the spotlight on the top movers in trade. Hormaz.
You know, as Ritu was highlighting, right, the index may not be showing any significant moves, continues to remain in that range even in today's session. And there are two primary reasons why the index is seeing these kind of choppy moves. On one side, you have the banking index. The banking stocks have been in the spotlight all through yesterday and today. The Nifty Bank has now slipped into the red as well, around about 50 points lower, but that is not falling as much as the IT index is falling. The IT index is now down almost 2%, and most of the names there are either at 52-week lows or at multi-year lows as well. Take a look at these names, and Infosys and TCS yet again among the disappointments, but the fall today in mid-cap IT is a lot more pronounced compared to the large-cap IT names. Look at Birlasoft. KPIT Tech has recovered slightly from the lows. The KPIT Tech was down around about 6% at the start of the trading session, so there is some recovery that's come in at lower levels. Now look at the electric vehicle players after the Delhi EV policy that was announced yesterday. Both Ola and Eicher doing fairly okay for themselves. 5% for Ola, 3% for Eicher. Eicher was up 8% in yesterday's trade as well. Eicher Motors, of course, is one negative implication because of the announcements that were made. So 4% lower here. That too is seeing some recovery from the lows. At one point was down 6%. And IGL, structurally negative implications for the stock, but the stock is fairly resilient in today's trading session. Look at the newsmakers. Earlier in the day, there was a block deal that took place in Genus Power, and sources are telling CNBC TV 18 that a clutch of HNIs are buyers in this transaction. So after a 10-11% fall, there is some buying from lower levels that has come in, 6.5% lower on Genus Power. Nalco has resumed its losing streak after the strengthening of the US dollar yet again in the global markets, and Maruti Suzuki now at the highest point of the day after this upgrade coming in from Jefferies, who also raised its price target to around 16,500 rupees on the stock. The outperformance continues for the pharma sector. And today it's the smaller pharma names that are making the moves in today's session. Jackson Powell, of course, is a news flow driven name, 13.5% higher on the stock. But Gland Pharma is doing well, as is Kaplan Point and Krishna Medical too, seeing gains of anywhere between 2.5% to 4%. And lastly, the textile names are at 52-week highs today. Look at Arvind, that's up 8. SP Apparels is up 11. Then NRB Bearings and GMR Airports too doing well for themselves, both at 52-week highs, Ritu.
Well, Hormaz, thanks very much. This sets us up very nicely to invite our next guest. Jyoti Vardhan Jaipuria, the founder and MD of Valentis Advisors, joins us on the show now. Jyoti Vardhan, always a pleasure to have you back here. Well, let me start today on the financial space itself with this spate of news overnight. On one hand, you know, a stock like HDFC Bank struggling with those governance concerns. You know, do some of those that overhang get addressed to an extent? And this CFO shuffle from one bank to another. I mean, does this also open some room for uncertainty and strategy changes? We're also looking at CEO changes at banks like Kotak. So how do you put all of that together in the near term for the financial services space, especially private banks? How would you play it?
Yeah, so, Ritu, we like the BFSI space in general. And the reason we like it is two. One is, credit growth, as you know, has been quite strong. And that will help, earnings for these people. And second is, NIMs will start to normalize. So last year, NIMs came under pressure basically because, interest rates were going up. So interest rates were falling. So deposits, take a long time to fall, whereas the loans fell immediately. This year, we'll see the repricing of the deposits lower, and that will start helping NIMs in the banking space. So in general, we like the space. These are at attractive valuations. So when we look at, 10-year valuations for every sector, banks is one of the most attractively placed at discount to 10-year valuations. Of course, now what we've seen over the last few days is it's not just the banks, it's the NBFCs also. There've been quite a spate of change of personnel. And I call it a bit of merry-go-round because, somebody lost the CFO, somebody else hired from another bank, so they had to go and hire from a third bank. And so we are seeing that thing happening. Obviously, you want stability at the key managerial personnel. But some of these are, which happen, like people said, it is because they want, better prospects.
So in light of that, you're right, the financial services space, Jyoti, as you mentioned. What about pharma? Everybody started to warm up to pharma as of now, and the sector itself has done well. It did well last week. It is continuing to do well over the last couple of days as well. And almost every possible expert that we spoke to highlighted their own various preferences. Some were betting on the generic players, some were betting on the CDMO players. Where are you placed in this?
So almost, as you know, pharma has been one of our favorite sectors. So even when we look at the time we have run our fund, pharma has been the most alpha generating sector for us. So, we owned a couple of spaces here and we continue to own them. One is, we own a stock which is in the US generic space. And so we like the US generics more because we think, a lot of the price erosion we saw over the last 7-8 years are easing out, and now prices are starting to plateau and go down at a very small pace. The second space we like is the CDMO because that has a long runway for growth. You can see very visible growth over there. The Biosecure Act, everything which we'll see is there'll be more and more outsourcing from China to India. So in some sense, the growth visibility in the CDMO space is very, very good. Obviously, they are not hurt by all these oil prices or, the monsoon failing and all. So that becomes an added advantage for it. There are, in the CDMO especially, I would say there are some valuations which, we get a little worried about. So we have to hunt our space and find areas where valuations are not as extreme. But overall, pharma is a space which we've liked for a long time and we continue to like it.
Okay, continue to like pharma, continue to like, financials. But Jyoti Vardhan, IT now, that's had contrarian views in the market, but more specifically because of this concern about the hit from the, the AI developments. The spate of acquisitions we've seen, whether that was Coforge to now Persistent more recently, do you think that will help offset some of the concerns as these IT players get more aggressive on making these acquisitions?
So, Ritu, IT, we've been out of IT for 3.5 years now. So we don't have a single IT stock in our portfolio. There has been some temptation to add it now because, we've just been so underweight and all the concerns of AI now are very, very consensus. At the same time, we've not really found anything very, very compelling to add. There are a few smaller names which we are looking at, which are in niche segment, probably, catering to the auto segment, catering to, the changes in auto which are happening. But so far, we've not added it. A lot of these acquisitions are, in some sense reflecting the slowdown, right? So what you're trying to do is, I can't grow, so let me acquire something so that at least, my growth profile improves and I'm able to grow. Historically, my thought has been whenever big acquisitions happen, they take a long time to, consummate because cultural differences are there. So not just a simple addition of numbers, but the fact that you have to get those two cultures to align. So they take longer than what we initially anticipated to be. And, so probably all these will work out, but it may take a little longer than what we are thinking at the moment.
You mentioned IT, the auto-focused smaller IT names, Jyoti, but there is a lot of negative developments with regards to a lot of these European automakers as well, with whether it be Volkswagen, whether it be BMW, and most of these companies are major clients of a lot of these players that you are highlighting as well. And if I may add, if that also brings in a company like Samvardhana Motherson as well, of course not technically IT, but also linked to these European automakers, you're still looking at them. What's prompting you to take a look?
Okay, so if you look at just the IT space, we are looking at it because we think these will be structurally, they'll start getting more and more share because more and more of cars will become, I call it cars will become computers rather than cars. But coming to the auto ancillary pack, so we've generally had, two themes when we bought auto ancillaries, and that's another segment which we like quite a bit. One is we are focused on things which are more domestic rather than international. And second is we are focused on people who do things which are not ICE engines. Because, anything related to ICE engines, even if they take a long time for, the sales to slow down, at least, de-rating happens quite quickly. And so that's been our general theme. Most of the auto stocks we have are, focused on these couple of things. What we're also starting to see in a lot of the auto ancillary names is they're going beyond autos. Because, all of them are good at forgings or they're good at casting and, the new defense space, aerospace, a lot of them are, entering those areas, which may become future growth drivers for them. So for us, it is we keep that future upside more as a icing on the cake. If the core business looks good, we buy that. So that's really been our theme on the auto ancillary space.
Got that, Jyoti Vardhan. Appreciate your time here and thanks very much for that chat today. We'll zip into a short break on that note, but up next we'll get you all of the bond market action with Manisha Gupta. Welcome back, and as promised, let's get you all of the bond market action with Manisha Gupta. Manisha, the yields holding steady despite that constant oversupply pressure. Now with states also borrowing more.
Oh, well, absolutely. It's trading very, very steady, by the way, with some of the reports also suggesting that if we see a 6.75% of a break on the lower side, we could be heading to 6.68 as well. But as you said, it's a steady market that we are looking at. There is a bit of an uncertainty that we are looking at in sense of US-Iran peace talks. The focus, though, is going to be on the result of the auction of state government securities. 5 states are scheduled to raise a total of around $136 billion therein. And the focus also is going to be on the US labor market data that comes in this week itself. Markets also are looking at the $340 billion auction of the new 6.94% 2036 bond. Well, that happens on Friday therein. But apart from that, there also are a lot of private issuances that are yet again looking at being bid today, and that's a list of that on your screens therein. The Bajaj Housing Finance is planning to raise nearly $25 billion via 4-year bonds, inviting bids today. L&T Finance also is in the market, and they are looking to raise nearly $3.8 billion. They are doing this via 10-year bonds. And then you have Viriti Capital, which is looking to raise $2 billion. They are doing this via 2 bonds. There is Monedo Financial Services. They are looking to raise $400 million therein, and their bonds are maturing in 2027 October. And then you have Tata Capital, which is okayed up to nearly $360 billion via NCDs in this current financial year. ONGC Petro, we've been talking about that. That's a subsidiary of ONGC that has seen an approval of a proposal to raise nearly $44.7 billion. This is via NCDs for this financial year. Union Bank of India is going to be into the market as well, raising $50 billion via Tier 1, Tier 2 bonds therein. And then you have IRFC, which is looking to raise $1 billion via 5-year dollar bonds by end of this month. The last date is today, so the final numbers will come in by the evening today. And then SBI board is okayed on a long-term fundraising for bonds up to $2 billion in overall FY27. And IRDA has been into the market as well. We're looking at those bids coming in on every weekly basis as well. They're looking to raise $400 billion in FY27 too.
Manisha, thank you for those updates there. By the way, the markets have recovered now from the lows of the day. The Nifty is almost heading back into positive territory. Get you a quick chart check and some trading ideas on the other side of this short break with Vinay Rajani from HDFC Securities. That's the state of the market as of now. Is a sharp recovery from the lows of the day. Start of the show with the Nifty being around 60 to 70 points lower. Now the index has started to move back into the green. The Nifty Bank has now moved 60 points higher, and that has been the key contributor as well to the Nifty, the recent Nifty outperformance and whatever little resilience that the index has shown as well. Of course, it was an underperformer in yesterday's trade, but today the Nifty Bank is now starting to move back towards that 58,000 mark on the upside, a proper expiry trade that's playing out. Of course, it was a very busy evening for Ritu yesterday, and almost possibly every bank that she could think of had a leadership musical chair that was undergoing, be it HDFC Bank, be it Axis, Bandhan, all of them. Explain this quagmire to us, Ritu.
You know, Hormaz, we've been jokingly calling it musical chairs, but it's also the question of, the talent availability in banking. So we also need to look at that. But yes, big leadership moves at HDFC Bank overnight. One, of course, that closes the chapter on months of governance uncertainty, and another one that's triggered what you are calling the musical chairs among the top banking CFOs. First up, HDFC Bank has named seasoned bureaucrat, former finance secretary, the ex-chief election commissioner Rajiv Kumar as its new part-time chairman for a 3-year period, subject to RBI's approval. By the way, he also overlapped with the former chairman Atanu Chakravarti at the finance ministry during his stint. Of course, he's been appointed as an additional independent director as well for a 4-year period, and that will be subject to shareholder approval. Now, the appointment is significant because, with this chairman appointment now in place, and if you recall that clean sheet from the external legal review on the allegations that were made by Atanu Chakravarti, that governance overhang on the HDFC Bank stock hopefully goes away to an extent. And more importantly, the path for the reappointment of CEO Sashidhar Jagdishan becomes clearer, and that is expected to be taken up in the coming days, as we've been reporting here on CNBC TV 18. Now, separately, HDFC Bank has also confirmed another news break. It has appointed Axis Bank's outgoing CFO Puneet Sharma as the new CFO. Puneet Sharma, remember, has been at Axis Bank, their CFO since 2020. Before that, he was a group CFO at Tata Capital, so plenty experience in the field. And as we reported first here on CNBC TV 18, he is now going to be the CFO designate at HDFC Bank starting September, and then officially take charge from December as the full-time CFO after the incumbent Srinivasan Vaidyanathan retires in October. So now that leaves us with a question as to who replaces him at Axis Bank. Now, that's where this musical chair has been set off. Our sources indicating that Bandhan Bank's outgoing CFO, Rajiv Mantri, who, by the way, also announced his resignation just yesterday, brings more than 25 years of experience across Bandhan City, Stancy and whatnot. He is set to join Axis Bank as their new CFO to replace Puneet Sharma, who in turn is heading to HDFC Bank, completing that 3-bank CEO shuffle, with Bandhan Bank, of course, still left to hunt for a new CFO. So watch out for that one as well.
Well, lots is happening in the banking sector. There is a lot happening in the market as well. We just highlighted, just as we came back from the break, that the Nifty is about to move into the positive territory. It has not only done so, it is now 50 points higher is where the index currently stands, on the cusp of 24,000. Again, a very sharp spike that you have seen in just the last few minutes, and we are nearing those opening levels as well of around 24,030. Just pull up Maruti before we go to Vinay Rajani. That has now extended its gains almost 5% higher now as we speak, continuing to extend the gains. There is Maruti Suzuki. There you can see almost 4.75% after that upgrade that has come in from Jefferies. There's been a steady one-way up move that Maruti has seen, back above the mark of 14,000. Vinay Rajani now from HDFC Securities is joining in for a quick chart check and some trading ideas as well. Well, Vinay, we are back at 24,000, at least as of now. Do you believe that the expiry happens above that level? And if so, what are the levels that you're watching on the index for the July series going forward, and your stock ideas as well for the morning?
Yeah, good morning. So from the lower level, Nifty has risen by 150 points. So nice recovery, and today's low was exactly at its 50 days exponential moving average. So 50 days EMA was placed at 23,850, and more importantly, 20 days EMA is also coinciding with the 50 days EMA. So Nifty is finding support on 20 and 50 days EMA. However, on the upside, we can see that the consolidation is still continuing. On the upside, there is a strong resistance between 24,150 to 24,200. So we are waiting for that breakout to come. But the way rotation is happening in the market, some sectors are, even if market falls, some sectors are keep on performing. So we feel that the breakout should come on the upside only. So 24,150 is the immediate resistance, above which we are expecting that Nifty should extend this rally, and it should be up to 24,600 also if we were to take the July month's view. So we are a bit bullish on the market. Financial stocks are looking good to us. Pharma space is also performing well. So we are bullish and we are expecting breakout about 24,150. And once that is taken on, 400 to 500 points upside could be there. And stop loss that we are suggesting to our client is 23,780. That should be kept as a stop loss on the closing basis. As far as the trading ideas are concerned, today I have one pick from the NBFC space, the L&T Finance. So this stock has given a fresh breakout. For last two sessions, this stock was not able to sustain at higher level, but today there is a sector strength, and I think the breakout which came previously is now resuming its uptrend. So 304 is the entry price, 298 should be the stop loss. On the upside, I'm expecting a target of 314. The second stock I would pick from the FMCG space, that is the leader of the pack, I think Marico, which is not that trading that far from its all-time high. So 837 should be the recommended price. The 824 should be the trading stop loss. On the upside, immediate upside should be 860, at least for 2 to 3 trading sessions. So we are bullish on L&T Finance and Marico from trading perspective.
All right, Vinay, thank you very much for joining in with that. Let's now go across to Mangalam Malu, who joins in with the latest on the F&O trends. Mangalam.
Well, it is June series expiry, so you obviously expect some sort of volatility to, come back in the market in the last hour in particular. But the way this series and the last one series has been, the market's been largely range-bound, and that's exactly what's playing out right now as well. Though today it's a lot better than what one would have thought over the last few trading sessions, and there's a reason for that. The Nifty is range-bound, but if you look at the Nifty Bank, that's the one which is actually powering ahead. So that's an outperformance that is coming by. The Nifty is actually buoyed lower by the IT index and the Reliance stock. If there is any sort of recovery in these two counters, the market is likely to move higher from here on as well. And over the last week and even yesterday, we made the point that the mid-caps weren't doing too well. Well, today they've come back in form, and look at the small cap index. That too is up nearly 1%. So that tells you that in the broader market, the mood is a lot better, which is again reflective in the advanced decline as well. So while there is consolidation from the frontline end, the internals of the market look a lot stronger in today's trading session than the last few trading sessions. And I'll be very interested to see what happens to the 24,000 call writers, because these are calls that expire today. 24,050 or 24,060 thereabouts is where these guys are expecting some sort of supply to come by. If the market holds above the 24,000 mark for a while, which it is approaching right now, then all these 3.5 crore call writers will have to run for cover, and that may cause the market to move higher. But on the lower level, 23,900 put writers are equally active. So let's see where that goes as well. We are expecting some sort of support around 23,875 thereabouts. So at a lower level, there is strong support. At higher level, if the market does go higher, we can see a bit of a melt up, particularly in the last hour of trade.
Indeed, Mangalam, thank you for setting that up for us from the F&O desk. Take a short break. Back with the management of Jupiter Wagons on the other side. Stay tuned. Welcome back. Now, the Railways has rolled out a major policy reform aimed at boosting efficiency and innovation in freight transportation. Now, in a significant move, industries will now be allowed to design freight wagons tailored to their specific operational requirement. We are now being joined by Vivek Lohia, who is the managing director at Jupiter Wagons, who, as they have very recently bagged orders from JSW Rail. Vivek, good morning. Thank you for taking out time. Firstly, if you could tell us more about this order from JSW, the execution timelines, how margin accretive is it, when does it start accruing for you, and of course on this new policy as well, what is the kind of what is the kind of impact that you see as a result of this reform?
Good morning. The JSW order is basically in continuation of the private order book which we are building up. As you're aware, Jupiter, if you look at order books, about more than 50% of our order book is on the private side. And this order, we have to execute it in this financial year itself. And we expect further orders from JSW. So they're expanding their steel portfolio. So in that lines, they're going to build up further on their transportation portfolio. So we expect further orders down the line. And as you rightly said, this move by Indian Railways to allow us to bring in our own designs, this is something which the industry has been pushing for a long time. Because unlike in the past, where the industry wasn't that focused, so it was like one product fits all kind of a thing. But now, as you see more and more private sector participation and more private players directly procuring wagons, and that population has shot up dramatically in the last 3 to 4 years. Close to about 1 lakh wagons have been procured by the private sector, and which the percentage is going steadily. So I think this will go a long way in bringing in more private participation and more sectors. Now you can bring into the fold of the railway freight transportation. Recently, we, along with GATX, we designed a completely new wagon for carrying auto cars, which was itself a revolution, and that has resulted in Maruti giving us a sizable order. And now we are in the process of developing 3, 4 more designs. And I think this is going to be a transformative move for the sector. And we have to thank the railway minister for his vision. And the honorable prime minister has been very clear under his Gati Shakti scheme that railway has to be a key driver in the logistics sector.
Vivek, since you mentioned that recently you've also entered into a strategic partnership as well, right, with this global rolling stock player to enter into this passenger and the metro rail segment as well. What's the status of this partnership? When do you start bidding, or have you already bid for a few metro or Vande Bharat projects?
So this partnership is we are going to be firming up very shortly. So it's by the end of the year only itself, we'll start bidding for the projects. But in the meantime, we are also exploring the export markets, and we believe we have a strong belief that before the end of the year, because of this partnership, we will be developing a lot of products, especially on the coaching side, for the global market. Because they have a huge order book, and for them it's a huge challenge right now in terms of delivering. So I think that is something which we are definitely looking forward to, because compared to the Indian market, if you look at the global market, it's much more revenue accretive. So that is where more of our focus is.
Vivek, you spoke about the JSW order, the Maruti order, and the fact that these private orders are making a larger portion of your book. Does that also mean, a better revenue, a higher margin for the year? If you could give us a guidance on that, and that's on the private front. Also on, the Indian Railways, the wagon tenders for FY27 being floated. Have you heard, and what kind of market share are you targeting on that segment?
See, the private orders do make up a sizable pool, and definitely compared to the Indian Railway orders, they are much more revenue accretive. And the GSW order is also in line with the EBITDA numbers which we have been delivering. But definitely the key driver will be the Indian Railway tenders, which we are expecting this year. As you're aware, the last major tender was in 2022. So post that, there has not been any sizable tender which has come out from Indian Railways. And this year we expect the sizable tender to come out, because again, as per the policy decision, the tenders are again going to be structured for supplies which they need over the next 3 years, so that the industry gets the visibility and can plan accordingly. So definitely we expect a big order book, and Jupiter being one of the leading players, definitely we are going to get one of the biggest shares in that tender pie.
Vivek, so just to sum up for FY27, if you could give us your guidance on what the order book could look like, the opportunity from, this new policy, and, what kind of higher margins could you target?
So, overall, in terms of the guidance, it's, it also depends a lot on the timing of the tender. We expect the railway tender to be, maybe before the end of next quarter, we can expect the tender to come. If and when the railway tender comes as per expectation, I think we are going to close the year on a very, very strong note. On the private side, the order book is quite strong. We have an order book of close to 3,000 odd crores there. And we expect, the margins to be in line of what we are delivering. And as and when the railway order book comes, definitely you will see a big uptake on the margins, because we'll be able to utilize our infrastructure much better. And beyond that also, in terms of the diversification which we are doing within the railway portfolio, our wheel and axle facility which we are setting up in Orissa will be online next year. There itself, we have entered into an agreement with Tata, which is the biggest player in the European market, where they have committed to lifting about close to half the capacity which we are going to be setting up. So as a group, next 2-3 years, it's going to be quite diversified, and we are going to be quite integrated, both backward and now with our own designs. With future wagons, it'll be a very strong backward and forward integration.
Vivek, pleasure having you today. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. Let's get you the macro signal for the markets holding below that 23,000, 24,000 mark now at about 23,928 as we speak. And the bank Nifty still in the red. It's trading with cuts and almost flattish. And the IT pack really pulling the markets lower today. But oil prices, they continue to trend lower as the vol premium is also coming off. So Brent crude prices, they're hovering around $72 a barrel. That's down about 1.2%, over the trading session. And WTI crude prices as well, also around that $70 a barrel mark. So it's been a significant retreat of more than 10% since last week. Investors, of course, now looking out to the outcome of these potential US-Iran talks in Doha amid the weekend missile fire from both sides, which had tested that interim ceasefire. The rupee, though, that's trading slightly lower today, now at about 94.62 against the dollar. It's pressured by the month-end dollar demand, despite, that decline in oil prices that generally tends to help the rupee. The primary pressure, of course, coming from the fact that importers, corporates typically buy these dollars at the end of the month and the quarter to meet the payment obligation. So that's exerting some downward pressure. The 10-year GSEC yields, meanwhile, holding steady, trading lower, now at about 6.72%. The decline, of course, being helped by the cool-off in the global crude oil prices and the foreign investment flows as well in the debt market. So now yields have fallen for 4 straight sessions, lowest levels in the last 13 weeks. And market participants are also going to be focusing on the fresh government debt auctions that are scheduled for later and any further developments in the West Asia war talks and the US payroll report as well. All of that is going to influence sentiment. For now, we'll slip into a short break. But before that, let's get you this big milestone we're celebrating today. cnbc TV 18 has crossed 100 million views on YouTube this month. And that number belongs to you, our viewers. So a big and heartfelt thank you to all of our viewers who've tuned in, shared, subscribed, and stayed with us through the highs and the lows of the market. So here's to many more milestones together and to telling India's growth story the way only cnbc TV 18 can.
Welcome back. Now, flight and hotel bookings have seen a surge during mega events like the ongoing FIFA World Cup and for travel tech companies like RateGain. Now, this is the kind of demand that spike their platforms of what they are built for. But there are bigger questions here now around AI, disintermediation, softening distribution business, and $1 billion revenue target by FY31 as well. Now, let's discuss all of this with the founder and the managing director of RateGain, Mr. Bhanu Chopra, who is now joining in. Mr. Chopra, good morning. Thank you for taking out time. A simple question to start off with, right? How much of this FIFA tailwind is already in your numbers, and are these structural headwinds real? Because have you seen, firstly, a spike in on your platforms as a result of the World Cup?
Yes, so absolutely, we are big beneficiaries of this FIFA event in the US, especially. As you can imagine, all the big host cities are keen to attract travelers. So given the fact that we work with the leading destination management companies or tourism boards of these states in the US, we've been big beneficiaries of them trying to attract and promote around FIFA. We are seeing good growth in our distribution as well as a result of this. Overall ADRs have gone up, and our MarTech business is linked to as a percentage because it's pay for performance. So we are beneficiaries of increased rates as well.
Bhanu, before I get to my question, which team are you supporting this World Cup? A lot of the favorites are already out.
Well, I'm really enjoying watching all the teams, so I don't have necessarily a favorite. But from what the predictions are saying, it's going to be France. So it's all the top teams matches I'm keenly observing and watching.
Well, also a quick question, Bhanu. You've been upping your stake in the company, buying from the open market. That's been happening for a few months now. What's the end game here? How much are you looking to increase your stake to further, if at all?
Yeah, so look, I feel like our, the current robustness in the business and the trajectory that we see here basis that the stock seems pretty undervalued. So it makes sense for me to continue to up the stake. I'm very, very bullish on where we stand today. We've never been a stronger company given the platform of customers that we have, given the new AI innovations and the products that we are launching. So I think you've seen it in our numbers as well. We had almost 65% growth last year. We're projecting 70% growth this year. Our margins are expected to expand to 21%. That's what we've guided. So we've guided a 70% growth and a 21% margin. But I'm happy to report basis Q1 numbers also. We're seeing, we should be beating those numbers. So I'm quite bullish on where we are, and given the strength that I see, I feel very comfortable continuing to up the stake. And as you know, I still own a significant stake in the company for a new age company compared to other peers. But I feel that there is huge headway for growth, and that's why we went out and have taken this audacious target of $1 billion in revenue in the next 5 years.
Well, I guess as long as RateGain benefits from the World Cup, I don't think Bhanu cares who wins. So that's possibly the bottom line. But Bhanu, the distribution business has been a bit of has seen some weakness because of the fact that hotels are also pushing harder for direct bookings, and therefore the fact that the brings down the OTA commissions as well, and therefore the third-party distribution volumes that you manage or you help manage. Is this a trend that is accelerating, or has it plateaued out and you still continue to see that the distribution business will strengthen going forward?
So look, the big reason actually for us seeing softness in the distribution business was there was a consolidation at a very large OTA, and they decided to sunset one of their subsidiary brands, which was a big generator of bookings for us. So that's why we saw the decline over the last year or so. But given all the new AI offerings that we have launched in our distribution business around Rate IQ and Agentic ARI, basically what they do is They're leveraging AI to create more of a real-time sync between the hotel systems and the OTAs. We are optimizing the pairings. It's able to sequence how we do the updates and how the hotels receive the bookings information, how we remove potentially rate leakages. So we're seeing some, very, very good traction. And then in our distribution business, we've launched an AI agent called Viva, which is again seeing great traction. So we're quite hopeful that we'll see that reversal of trend in that line of business here.
All right, we'll keep a close eye on that. Bhanu, thanks very much for joining us here today. Pleasure speaking with you. And on that note, we'll also wrap up this edition of Trading Hour. Hormaz and I take your leave. But stay with us. More news and updates will continue right here. And Halftime Report will take all the action forward.
Stocks trade soft as uncertainty over US-Iran talks casts a shadow on recent optimism around preceding crude prices. IT and FMCG are the big drags, while chemicals and consumer durables eke out some gains.
Former Department of Finance Secretary and former Chief Election Commissioner R. Rajiv Kumar has been named the new part-time chairman of HDFC Bank. A decision on extension of term for the CEO is now next on the agenda.
Axis Bank CFO Puneet Sharma has resigned and is slated to join HDFC Bank, while Rajiv Mantri from Bandhan Bank will move into his role. Sources confirmed to cnbc TV 18 the shuffle comes in the wake of HDFC Bank's CFO retiring in the month of October.
And Delhi government clears the state's EV policy, mandating that only electric three-wheeler vehicles will be registered from 1st of Jan 2027 and only electric two-wheelers from 1st of April 2028. It also offers incentives for electric four-wheeler purchases. The jury is still out on how this might disrupt the industry.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala and Ekta Batra. Girls, good afternoon. Well, it is the expiry day. Nifty has come off from the highs of the day, but still it is somewhere flat for now on the Nifty, 15 points lower as we speak. The mid-caps, they are outperforming today though, 0.4% higher on that one, 276 points higher on the mid-caps, and the advance decline ratio in favor of the advances as we speak. Again, it could be very volatile in the last couple of hours in trade today because it's the monthly expiry. So that is something that you should keep an eye out on. For now, Dixon, of course, is in focus because sources are suggesting that Dixon Vivo JV is inching closer to securing the final government nod. That would be big for this company. We'll, of course, get in more details. But for now, it's consolidating for now. Could be volatile later.
Absolutely, consolidating for now. Could be volatile. We'll watch out for that in the second half of the trading session. And like Sonal mentioned, look at Dixon, right? Trading almost near the day's highest point. Could be big for the company, so we'll watch out for that. Realty is also something that has been buzzing in trade today. So pull up the Nifty Realty as well. We're seeing that up almost 1.3%. Autos managing to hold on to gains, as well as Pharma is something that is seeing good gains. Obviously, broader end of the market doing much better, and a lot of individual names also from the broader end of the market like Ola Electric, Maruti, Suzuki, Eicher Energy are some of the names that are managing to hold on to good gains. Good afternoon.
Hi girls. Well, good to be back on the show after a while. Well, for the markets, definitely turning out to be a day of consolidation at this point in time. But if you look at it on a month-to-date basis, remember that, the end of June, we're sitting at the end of June. And if you look at it, the Nifty is, in fact, not done too badly. It's up around 1.6% on a month-to-date basis. The mid-cap index is absolutely flat, while the small-cap index has done better with a gain of around 3.8%. What stands out on a month-to-date basis is definitely the India VIX, which is basically the volatility index, which has crashed around 17%. The Nifty IT index, which is down around 8.8% this month, along with the Nifty Metals index, which has lost around 7% as well. Nifty Banks has done well, so it's up 6.5% this month, along with the BSE Healthcare index, which is not done too badly, up around 5%. So that's basically what the markets have stacked up to be on a month-to-date basis. But let's tell you what we have on the show today. Park MediWorld, the management will join in to talk as the company expands 100 beds at their Park Hospital in Gurugram. We'll also focus on buzzing stocks and big movers in trade today, so stay tuned for that. And in our What's Trending segment, we will be focusing on the defense sector. Later on, we will be connecting with Amit Anwani of PL Capital Group to talk about the key trends there as well. Rahul Mirchandani of Aries Agro will join in to talk about the impact of the monsoon on the agri space.
Okay, on that note, let's also bring on board Vivek, who's here to take us through the stocks that are moving around in the trading session. Good afternoon, Vivek.
Well, good afternoon. It's quite a smart recovery, especially in the broader end of the markets, and advance decline ratio has moved favorably, especially when you're looking in terms of the advances. In terms of individual names that we're tracking, well, Maruti clearly stands out, a sharp or a strong upgrade coming in as far as Jefferies is concerned. They've upgraded the stock to a buy rating, stock higher by almost 5% today. The entire EV pack, names like Ola Electric, Eicher Energy, all of these names in focus on account of the Delhi EV policy. Both of the stocks, Ola now extending its gains now up over 10%. Look at Balaji Amines, this particular name stands out in the small cap space on very strong volumes, up almost 4.5% today. And pharma names, last couple of trading sessions, they've been a bit of outperformer. Today, the gains continue in select names, Gland Pharma, Alchem, Mankind, all of these stocks up anywhere between 1.5% to 4.5%. And lastly, GMR Airports, a clear outperformer in the month gone by, today has gone ahead and extended gains by another 3%. Remember, they've gone ahead and added the Nagpur airport to their portfolio. On the other hand, quite a few laggards as well. Genus Power, very high volumes. There's a large block deal. We understand from our sources that GIC was one of the sellers, selling their stake to a clutch of H&I buyers. Eicher Motors brokerages have gone ahead and highlighted risk from the Delhi EV policy, and on the back of that, that particular stock down over 4% today. IT stocks continue to remain under pressure. Today, it's mainly the mid-cap IT names that are seeing more pressure. Look at names like Birlasoft, LTM, and lastly, RR Kabul, this particular name, the top NSE 500 laggard in the session.
Okay, all right. Thank you so much, Vivek, for joining us. So those are some buzzing stocks that we have on our radar. For the markets, it continues to consolidate, but we do have some names in the broader markets which continue to surge. Of course, we've been talking about Maruti Suzuki, that big upgrade that has come in, and that is something which is up around 5%. But Dixon Tech is the one that we are tracking very closely. Ashmit has some updates on the Dixon Vivo JV. Ashmit, over to you.
Well, an important development, what we're picking up, important information, that the Dixon Vivo JV that was signed in December of 2024 is finally inching closer as far as securing the final node is concerned. Bear in mind, it was just earlier this month that the interministerial panel had granted its sanction for this JV to go ahead. That is the procedure as prescribed under the press note 3 for this JV to be granted. It's not Dixon, of course, having the controlling stake of 51%. Now, while the IMG had granted its it was not the final seal of approval. There are still procedures to be followed before the final issuance of an approval letter. Now, we spoke to sources within the government, and what they're telling us is that this process is moving ahead, that all the formalities are being ironed out, all the formalities are being crashed out, that we're only days away now from securing the final approval letter, and that we are in the final stages. So that's the big takeaway that government officials are telling us, is that the Dixon Vivo JV approval process is well and truly underway. It's in the final stages, and that it could be secured just days away from now from the issuance of the final approval letter.
Okay, all right, Ashwin. Thanks very much for bringing us all of those details. So Dixon Technologies, that stock is holding up with a gain of around 2% in focus on account of that source-based piece of news. But let's talk about one particular company, Park Medi World is the first management on the show today. The stock is up nearly 99% in 2026 so far. The company has announced a 100-bed expansion at its Gurugram facility. We have Sudesh Sharma, who's the CFO at Park Medi, who's joining in to discuss the developments in the company. Thank you very much for joining in, Mr. Sudesh. If you could just start by giving us an idea about this new hospital, this 100-bed expansion that you've planned in one of your Gurugram flagship hospitals which already exist. Just tell us about how much you're deploying in terms of capital there, and what is the key differentiator of this 100-bed hospital as compared to the others?
First things first, always a delight to be on your channel. Let me extend warm greetings and good afternoon wishes to any audience. We are very thrilled to have made a very important announcement today morning concerning significant augmentation of capacity for Park in a very critically, strategically important micro market of Palam Vihar, Gurgaon. Palam Vihar, for the benefit of all your audience, Palam Vihar is one of the oldest townships of Gurgaon, dates back more than 3.5 decades, by virtue of which it also boasts of one of the best civic infrastructures in Gurgaon. People say that Gurgaon has an urban population of nearly 12 lakh, of which roughly 55,000-60,000 is accounted for by Palam Vihar. In Palam Vihar, we run a very, very successful hospital, which is a 225-bed facility, which we commissioned way back early part of calendar year 2021. This hospital is till date the most important hospital in the micro market of.
Sure. Mr. Sharma, we are aware of these details. So if you could just give us more details about the current expansion of this 100-bed facility that you've planned. What is the kind of occupancy that you're looking at? What are the kind of capex deployment that you're looking at? And when does it come on stream? And what is the key differentiator from the rest?
We have positioned this capacity augmentation of 100 beds as an extension of our existing unit. It is christened as a Park Hospital Platinum. This hospital, in spirit of how Park has approached its capital allocation, is highly capex efficient. We have provisioned a capex of 25 crore only
for commissioning this facility of 100 beds by November 2026 in this calendar year. In this calendar year, including this capacity, we would end up this calendar year by commissioning nearly 1,600 beds of capacity, both organic and inorganic combined. This hospital will significantly advance our agenda in the critical micro market of Palam Vihar. We run high occupancy in our existing facility in Palam Vihar. In this new capacity addition that we are doing, we believe we will not just be running, hitting the ground running, but we will be literally probably very close to full house from day one.
Okay.
Yes.
Okay. Full house from day one. When do you have you basically by when do you start operations completely? Since you're talking about full occupancy from day one itself, and 25 crore capex for this particular facility, you do have cash reserves, so I'm assuming you will be funding it via that. But what is the plan for capex for the entire year? What kind of investments are you looking at making, both organic and in an inorganic way?
We have estimated a 25 crore capex at a 25 lakh operating bed basis for this new 100 bed facility. We are hoping to commission this facility November. So this facility will have 4 months of runway in the financial year 2027. Other than this, we have a capex plan of nearly 500 CR for FY27 and FY28, which will take our operating bed capacity by end of FY28 to approximately 5,600 operating beds.
What is the split between organic and inorganic in that?
Of the capacity that is coming up, how do I say? We have two assets which we technically acquired where we are undergoing capacity augmentation. So you can call it greenfield in our acquired asset. We will be commissioning 150 beds in our Mohali existing facility of 350 beds in September 2027. We will also be commissioning 200 beds in our existing acquired facility in Ambala by October 2027. And the rest of our developments are greenfield and acquired. We will be commissioning greenfield facility 250 beds in Rohtak January of 2028. We have acquired a facility in Delhi, North Delhi, Narela, under provisions of IBC, which will be commissioning the latter part of this calendar year, which is a 200 bed facility. We will have one asset in between, which is under asset light configuration, 400 bed strategically important location, important unit in a place called Gorakhpur, eastern part of UP, which will commission in May or June of 2027 calendar year. So it's a mix of greenfield and inorganic developments.
A mix of greenfield, organic, inorganic is what I've planned. Mr. Sharma, you said 4 months this will be, this hospital or, these 100 beds will come in place, right? So what is the additional revenue expecting? You had a target of around 2,080 for FY27 in terms of revenue. Should we expect a further upside from that? And what is the overall occupancy for FY27 we could expect? 64% approximately?
We had blended capacity occupancy as of FY26 of 64%. I believe FY27, our estimate of about 62 to 63% will be met. So far as this particular 100-bed expansion project in Palam Vihar is concerned, we believe on a conservative basis that considering 4 months as runway, this unit will have in FY27. We will have a revenue of about 20 CR coming in from this unit. In the financial year FY28, we believe this unit will be contributing revenue at a rate of about 5.5 CR on a monthly basis. At EBITDA slightly higher or in line with the EBITDA that we have traditionally realized, which is in the band of 26 to 27%.
Okay. All right. Sudesh, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from Park Medi. The stock is just about higher by around 3.6%. Remember, a lot of the hospital stocks have been doing well, so it's a part and parcel in terms of the movement that we're seeing within that space. We'll take a short break on that note, but up next, we will focus on our What's Trending segment today on Halftime Report. Sonal will be talking about the performance on the defense funds. Later on, we will be connecting with Amit Anbani of PL Capital Group to talk about the key trends within that sector as well.
Welcome back to Halftime Report on cnbc TV 18. Markets are not much of a move that we're seeing coming in there, right? Still a bit of a consolidating phase continuing for the markets. 23,922 around that mark, what the Nifty continues to trade at. But let's focus and now put the spotlight in our What's Trending segment. We're going to be actually tracking the defense sector and fund performances. Sonal will tell us more details on this one, how these funds have performed as well. And Sonal, there's so much that comes in terms of focus on the defense side. What are the funds being doing?
Defense funds, of course, are sectoral funds, and these are funds which usually investors who've been in the market for a long time should look at. But if we talk about Nifty Defense, it is up 1.1% today. In the last 3 years, it's up 255%. So that's the kind of gain that we've seen in last 1 year. Not so much. It's up just 5%, but that's been the market mood as well, right? We do have a couple of funds. Most of them are in the passive category, some of them in the active category, and some of them have been launched actually very recently. They're not even 3 years old, some of them. HDFC Defence Fund is the biggest one with an AUM of around 9,700 crore rupees. Then we have MOSL Nifty Defence Fund, which is again a passive fund, an index fund, which is around 4,800 crore rupees. Then we have Aditya Birla Sun Life Nifty India Defence Fund, 1166 crore rupees, followed by the ETF that Grow Nifty India Defence has around 133 crore rupees. Let's look at the performance now, because as I said, some of them have not been around even for a 3-year period, but their performance has been decent if we compare it with the index itself. HDFC Defence Fund has done well for the investors, 43% higher in last 3 years. That's the kind of returns that we've seen. The 1-year return also has been strong, 17% higher on this one, followed by something like an Aditya Birla Fund, which is up 8.2%. We have Grow Nifty ETF, which is up 8%. MOSL is up around 6.2%. These are recent funds. They're not even 3 years old. But again, as I said, these are all sectoral funds, most of them passive funds. Important to understand that these funds have a wave. They go higher when the cycle is doing well. So just keep an eye out on these and invest only if you're very sure about these funds and have the research in place as well. But they have done well for the investors.
Yes, absolutely. Definitely a theme which a lot of investors are bullish about. And to discuss more on this, we have Amit Anwani, who's the research analyst at PL Capital, who joins in now. Amit, hi, welcome to the show. Well, defense seems to really be the flavor, and y'all did hold a defense conference as well, where it seems as though your post-conference notes are indicative of the fact that there's a lot of enthusiasm and positivity coming into this space. So just tell us what exactly were the top 3 key takeaways from the conference, and how are you applying it to the stocks that you're picking right now and recommending to investors?
Hi, thank you for having me today. I think, broadly in our conference, we did got the opportunity to host companies across the diverse universe, including the PSUs, system integrators, and a lot of young defense electronic companies. I think the key takeaway broadly, we understood the earlier decade was a decade of reform for the, I would say, system integrators and getting the supply chains in line. But probably the next wave, which will also be aligned with the modern warfare, the way things are shaping, including a lot of consumption of missiles, drones, UAVs, will be at the center stage in terms of government supporting with a lot of R&D to young Indian private companies in that space. And also there was a lot of focus in terms of R&D. So for instance, many companies, including Bharat Electronics, highlighted about how they're going to sustainably increase the R&D spending on the new modern warfare products which are going to require, including drones, and even the upcoming missiles will require higher proportionate value of the defense electronics. So what we understood broadly is that probably for me, the defense electronics space proportionately is going to increase for the kind of maneuverability and the component of electronics which is going to increase. For instance, in drone, probably it is more than 30-40%, and missiles also, because of the guided missiles and the way things are getting consumed and evolving. There also the electronics proportion will increase. So I think that was at the center. And second, probably the next wave will be a lot of orderings getting cleared out in the shipbuilding. So there was a discussion on a very strong pipeline for the shipbuilding space, especially the defense for the DPSUs, including more than 1.5 lakh crore pipeline, including the LPD orders and the submarine orders. And equally importantly, a lot of policies from the government to incentivize for the commercial shipbuilding. I think collectively, the pipeline is more than 2 lakhs in this space, and this also seems interesting to me and was a key takeaway. Yeah.
Okay, thanks for that, Amit. Shipbuilding surely seems to be interesting as well, and a lot that's happening on the defense side. Amit, recently India, France, there was a defense pact that was signed as well. Plus, you're talking a lot more in terms of the takeaways that I'm reading, that, companies that would genuinely focus a lot more in terms of IP-led would see more benefits versus the manufacturing side, right? The large manufacturers. So one, who would be the beneficiaries of this, given that there are so many tie-ups coming in globally with India as well? If you could start with that.
Right. So, as you rightly said, we have seen a way where, as I said, there was a focus on getting the manufacturing suppliers, vendors right. I think IP-led is important and critical in a way that we have seen challenges with a lot of platforms where there was issue with the access code and we lack a lot of technologies, including, for instance, engines in aircrafts where we're trying for TOT, but the progress has been slow. I think IP-led is also equally important for the modern warfare, for instance, drone and many other technologies which are coming. Now, many private companies in the past have done the offset contracts whenever there was a government-to-government deal, including few companies like Paras, Apollo, Data Patterns. They have highlighted this in the past. And I think I would say especially equally on the defense electronics, that's why I highlighted that in the first place, where a lot of collaboration is expected to happen because, as I said, the modern warfare, which is focused on UAVs, missiles, drones, where the unmanned things are required, and these are also getting consumed because of the multi-front war outside. There's a lot of export opportunity, which is equally strong. Yeah.
So in that case, whatever you explained to us in terms of industry dynamics, if you had to name some stocks which look attractive, which you do have a buy on, are your top picks, and attractive from a valuation perspective as well. And generally, what do you make of valuation since these stocks have run up quite a bit?
That's correct. So I believe that probably this space, as I said, the percentage of R&D is increasing, might still be commanding more than 35, 40, 50x multiples. Even for next 2-3 years, which I believe probably there may be better growing companies than the system integrators or OEM, for instance. And second, I think currently my preference is Bharat Electronics, which highlighted 15% CAGR and very strong pipeline still in terms of the base order growing, and also QRSAM is also on the anvil, though it is delayed. So that is one. Second, a lot of private companies not under coverage, but they seems to be very growing at a very strong pace, including the Paras defense, which highlighted about very strong exports. I think the stock has had a good runway and probably trading at more than 55x, but they were getting almost 35-40% growth. One stock may not have visited a conference, but which I prefer that probably are also beneficial in the consumable space in defense, is solar industries, which I find attractive. Again, their minimum 25% to 30% PAT CAGR is expected for next 2-3 years. And they've really won good Pinaka and a few other big orders. They're focusing on UAV side, where they might get some conversion of orders there. So I think I would place my bet on more electronics, where Bharat Electronics is a preference in the coverage.
Okay, all right, Amit, we're going to leave it on that note. Thanks very much for joining in and giving us all of those insights on the defense space. We need to take a short break with the news that the markets are absolutely flat. The mid-caps, however, are picking up pace, so up around 0.5% currently for the mid-cap index. And we have the advanced decline ratio, which is holding steady on the advancing side. We'll do one thing, take a short break, but Sachidanand Uttekar of Trade Bulls will join in with some trading calls and technical strategies on the other side. Stay tuned. Welcome back. Well, for the markets, it's holding just about consolidating, but there are a lot of specific stocks which are making a lot of moves. So from the healthcare space, I want to point out Metropolis, which is doing well. So that stock is up around 3.8% at this point in time. Remember, it's rallied around 12.5%, 13% this year. And giving it company from the hospital space is again Narayana. So that stock is close to around 2,000 rupees per share. It's up around 3% at this point in time. The other space which is doing well in today's trading session are the silver ETFs. So for example, Nippon India Silver ETF is up around 2.5%. So you're seeing some amount of traction coming back into that, as well as the Tata Silver ETF, which is up around 2.5%. But on the downside, just watch out for a couple of these broader market banks. So Central Bank of India, Bank of Maharashtra, Yes Bank, all of these stocks, even IDBI Bank for that matter, are all down anywhere between 1.5% to 2.5%. But let's get talking about the technicals. We have Sachidanand Utekar joining in to tell us what he's tracking today. Sachidanand, quiet day. What's your call?
Good afternoon, Ekta. Clearly, I think the market is taking a pause. But if you look at the last 3 weeks' performance, the Nifty has been oscillating within this band of 24,000, 24,100 on the highest side. And it has been forming a meaningful base at around 23,800. Now, if you look at both the levels, they are coinciding with the 20-week exponential moving average as a resistance, which is placed at 24,040 levels, and the 5-week exponential moving average, which is placed at 23,860. So I think it is just consolidating, taking a brief pause after the rally that we have seen in the April series. So we are expecting that this particular momentum will be triggered in the coming series itself. If you look at the seasonality score, July as a series has only witnessed 2 negative years. One in 2025 and one in 2019. In the last 10 years, we've already seen of good positive traction. So we are expecting that there could be a kind of a swift movement which could be witnessed in the month of July, and hence our bias on the market remains positive. At least from trading perspective, for the day, we expect that the 23,840 level would be defended. And we may see a closing somewhere close to around 23,960, 24,040 within this particular range. When we look at Nifty Bank as well, even here the range is well defined. We don't expect Nifty Bank to close below that 57,600 mark. And on the higher side, it does have some resistance at 57,900, 930 cluster. But eventually, from a positional perspective, we expect that the high top, high bottom sequence, which has been progressing, we expect this particular move to extend towards 60,300 in the coming July series. So yes, we are seeing some range-bound movement. At least for the day, we may see that particular movement getting continued. But going forward for the July series, we expect some swift moves both in Nifty Bank and Nifty as well.
Okay, all right. What about individual names? We are seeing markets come off from the highs. We do have the expiry as well. Any trades that you have?
Good afternoon, Sonal. We are expecting good traction in capital goods and energy pockets. What we have recommended to our clients is a long call in ABB, wherein a triple bottom kind of formation is evident on its 60 minutes chart. We're expecting a move towards 7,200, which would be unfolded in the coming series. So we are recommending building fresh long positions in the July series counter, ABB. The stop loss for the trade can be placed at around 69.30 on closing basis, and one may expect a move towards 7,200. The other stock that we have recommended is buy call on GSW Energy. Even here, we have seen 3 weeks of consolidation. The stock is maintaining its base well above its 5-week exponential moving average support. We are expecting a breakout to be witnessed in this particular counter and a swift move towards 602, followed by a positional target around 630. The stop loss for the trade can be placed at around 579 on closing basis. The other pocket of strength, which has been real estate, I think that this particular space should do well. And within this space, there's a good high top, high bottom sequence progressing in Oberoi Realty. Even here, there's a flag pattern breakout which has been witnessed in the last week. We are expecting a good follow-through action to unfold soon. So we are expecting a move towards 1820 followed by 1900, which is the flag pattern target. One can keep a stop loss at 1740 on closing basis and deploy long positions here.
Okay, point taken there. Sachidanand, thank you so much for joining us this afternoon, talking to us about individual names as well as the markets. Thanks so much for that. On that note, we're going to step into a very short break. After the break, Manisha Gupta will join us, who's going to be in conversation with Rahul Mirchandani of Aries Agro. Stay tuned in, and they'll be decoding the West Asia impact, the tensions that were going on. How is the fertilizer sector being impacted? Stay tuned in for that.
Welcome back. Joining us on the show now is Rahul Mirchandani. He's Chairman and Managing Director at Aries Agro. Rahul, hi. Thank you so much for joining in. First of all, your sense really on the West Asia conflict and the impact it already has had on fertilizer. A peace deal is in place now. Of course, the 60 days for a final resolution onto this one. But the Strait of Hormuz is open. And how is India looking at that in sense of supplies?
Well, thanks, Manisha. I think the fertilizer sector has been one of the most affected, considering that a lot of inflows of fertilizers come in from the Strait. As far as we are concerned, our fertilizer stocks our fertilizer stocks across the entire industry seem to be fairly robust, considering we had, built up stocks during the off season. But as of now, I think with the delayed monsoon, the higher rates of the dollar as well as the fertilizer availability issues, I think there's an availability crisis, and more importantly, everybody is waiting for the monsoons to really see how demand plays out in this particular season. But as of now, yes, it's a wait and watch game. The Strait of Hormuz is open, not open. It kind of keeps changing on a day-to-day basis. But as far as micronutrients, the area that we are in specifically, we did stock up significantly during the season. We're also a Make in India manufacturer. So I think Make in India companies who are making a lot of the alternative substitutes to these fertilizers, especially water solubles and micronutrients, we should be fine in terms of availability scenario. But of course, pricing is a big concern with almost a 30-40% jump during the first quarter itself.
Oh, absolutely. And the input costs have gone up as well. I was comparing the prices as compared to last year to this year. That's a cost to you as well. You talked about monsoons, and with the 43% efficiency is what we're looking at for the month of June. July, first half is anticipated good, second half not so much, but that is something that we'll watch out for. What are the calculations that you're doing in regard to monsoons and the requirement?
See, I think many of us have done the off-season placement. I think that is true of most of us companies. Right now, the end of June, it's about a 20-day delay at the moment on average. This 20-day delay is not as worrisome as long as it picks up now. And I think the indications are that the season is picking up. The monsoons clouds have actually come back onto the subcontinent. And as long as the next 15-20 days show some good showers and cover some of the monsoon deficits, and July gives a good kind of a spread of monsoon across the country, then I think we should be fine in terms of the Kharif season. As far as later monsoon is concerned, frankly, there was way too much monsoon last year, at times later in the season when frankly it's not required. So as long as the season picks up now and for the next about a month, if we get a good spread of monsoon across the country, I think the demand scenario should be fine. Irrigation definitely is going to help. I think the significant amount of investment that the country has done on irrigation does definitely show that the irrigated pockets with good groundwater conditions will tide over the wave of any rain-fed areas having a deficit monsoon. But I think in a mix of both, I think the next 20 days are very, very crucial. The monsoon and the season seems to be picking up. Most of us have stocks available in terms of fertilizer availability. So I think except for the price issues, I think more or less Indian-made manufacturers would be able to supply farmers in India with very, very adequate amounts of fertilizer.
That point is well taken. Rahul, you also have been championing fast-track refund on when it comes to the inverted duty structure. You've been talking about that for a very, very long time. It also is about the GST benefits to micronutrients. How close are we to all of these policy changes that you have been pushing for?
Well, I think what we are pushing for is that any fertilizer covered under the fertilizer control order should actually have a common duty structure of 5%. This has been our common claim. What we're looking at is there are a particular schedule, Schedule 1G, that too for manufactured items, made in India items, only the 5% duty is available. This does leave an inverted duty structure. So as of now, we've had multiple meetings, not only at the Ministry of Agriculture, but also looking at follow-up meetings with the Niti Aayog as well as the Finance Ministry in order to ensure that every fertilizer controlled under the fertilizer control order should come under a common duty structure of 5%. This will ensure price parity, duty parity in terms of all the elements, and more importantly, the inverted duty structure will get reformed. Many of us who are, some of us who are registered under the central GST, for us, the refunds are definitely in terms of better in terms of speed. But in terms of those registered in various states, I think there is definitely a cause for concern that many of them are not getting their refunds as fast as they are expecting them to be. But I think if the government looks at uniform GST on any fertilizer under the fertilizer control order, I think this will more or less get covered up, and multiple meetings are happening not only at the company level but also at the level of the Indian Microfertilizers Manufacturer Association, which also I'm the president of. So I think in general, we are having a good amount of discussions with the government at various levels, various ministries, and we're quite hopeful that they will take this up as a reform measure in the not too distant future.
Rahul, that point is well taken. Thank you so much for joining in. So that really is the cue coming in from, unless you are under the state, there are issues, but under the common central government, when it comes to dues, etc., is getting done very, very quickly. And as Rahul says, Make in India is the way to go forward, and that is where we are looking at most micronutrient manufacturers actually do quite well. But with that, we'll go for a very short break. When we come back, we'll talk more about the stock specifics and markets after this break.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is back about the 23,940 mark, right? So we'll watch out for that in the trading session as well. Flip-flopping between the red and the green will be key to see where the markets actually end in today's trading session. But let's move on, talk about KEC International. That's the one in focus today, managing to hold on to more than 2% of gains. And why? Relief that came in for KEC International, as Power Grid actually had revoked its exclusion order on the company ahead of schedule, 2 months ahead of schedule. We spoke to Vimal Kejriwal, the spokesperson of the company as well, and he discussed the plans in terms of their bids for the HVDC projects and in terms for Power Grid. How does this revocation actually mean in terms of order pipeline for them as well, and what does it mean for the future outlook of the company? Listen in.
I think the bidding is happening next Monday, if I'm not wrong. So once the bid happens, then maybe a month or two, unless the prices are wavered, then the government may take time to decide. If the prices are normal, it's on a fast track. So I don't think it will be months. It will probably be weeks when it gets decided. There are two players on the converter side. Okay, transmission side, there are a lot more players, obviously. And also what will happen is on the bidding side, we are seeing a lot more interest. It will at least be 50 to 60%.
Welcome back. Green looking screen for now. The Nifty has come back into the green. Absolutely flat though. That's the same case with Sensex as well. Mid-caps are outperforming and there is some recovery on the bank Nifty. The big question of course is what happens towards the last 1 hour of trade, considering it's the expiry and guys, June is officially over with that. So I'm looking forward to July. With that, it's a wrap on this edition of Halftime Report, but Business Lunch will take all the action ahead.
Stocks trade soft as uncertainty over US-Iran talks cast a shadow on recent optimism around receding crude prices. IT and FMCG are the big drags, while chemicals and consumer durables eke out gains.
Former Department of Finance Secretary and former Chief Election Commissioner Rajiv Kumar has been named the new part-time chairman of HDFC Bank. A decision on the extension of the term for the new CEO is now next on the agenda.
Axis Bank CFO Puneet Sharma has resigned and is slated to join HDFC Bank, while Rajiv Mantri from Bandhan Bank will move into his role, sources confirmed to CNBC TV 18. The shuffle comes in the wake of HDFC Bank CFO retiring in October.
The Delhi government clears the state's electric vehicle policy, mandating that only electric three-wheelers will be registered from the 1st of January 2027 and only electric two-wheelers from the 1st of April 2028. It also offers incentives for electric four-wheeler purchases. The jury is still out on how this might disrupt the industry.
India has comfortable rice stocks and hence deficient Kharif output will not push up prices, but oilseeds, edible oils and millets can push up inflation even beyond 6% in some months. Ramesh Chand, former Niti Aayog member, tells CNBC TV 18. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Harmaz Patakia. Harmaz, good afternoon. You know, the market's flitting between red and green. It is expiry day. The Nifty and Sensex now absolutely flat. Nifty's near that 23,950 mark, right below that point.
Well, good afternoon to you as well, Arundhati. And you know, the markets have done, well, precious little as of now. It's a proper expiry trade that has been playing out. We opened gap up, could not sustain that gap, fell to a low of 23,850. We managed to defend that level, and since then we have just managed to meander around that flat line for a better part of the last couple of hours now. And of course, the last hour of trade is going to be the more important one when the expiry trade actually plays out, because today is the monthly expiry as well. So we might see some moves on either side. The bulls, of course, would be hoping that on the positive side, they would defend and reclaim and close above the mark of 24,000, but also ensure that in case there is any downside, the 23,800 level at least is protected on a closing basis. So that is the two important levels that you're watching out on the index. There's a proper tug of war that has been going on between the Nifty Bank and the Nifty IT. The Nifty Bank has not fallen as much as the Nifty IT has, and that's what is ensuring that the Nifty is still managing to stay around about the flat line. But IT continues to remain the big underperformer, and it's been a very forgettable first half for all of the frontline IT names.
Absolutely. And if you take a look at the sectoral performance, leading the market higher is the realty index. It's gained over 1% in trade today. Phoenix, Godrej, Prestige, all of them gaining between 1 and 3% in trade as we speak. Auto seeing a big recovery today. That index also gaining about 0.5%. We've got Maruti that's up 4%, nearly 5%. Tata Motors PV up over 2%, and Bajaj Auto higher by 0.5%. And as Harmaz pointed out, it's those IT names that are, making the market fall a little bit. That index is down a percent right now. And if you take a look, Infosys, TCS, HCL Tech, all of them under pressure, over 2% in the red. So that's how the markets are shaping up this afternoon. We are at the halfway point of 2026, and it's not been a good year for the market, right? Now, with the benchmark delivering a negative return of over 8%. However, it is not all doom and gloom, as the broader market has outperformed. Harmaz, you've been tracking this and you have this mid-year report card for the stock market, right? So if you could take us through what's been playing out.
It's been a very forgettable first half of the year that the markets have had. The Nifty is down around 8.5% as of now. And we've made the highs of the year as well. We made a record high right at the start of the year. Then we made a low for the year as well, which was around 22,182. And since then, we've been struggling around that 23,000 to 24,000 range. So an 8.5% downtick is what the index has seen on the first half of the year. But take a look at the trend of the last 10 years. And I'm talking of the last 10 years is because of the fact that the Nifty has delivered positive annual returns every single year since the start of 2016. Now, in the 2017, of course, was the proper large cap rally. The index did very well. And if you take a look at the other next 3 years as well, it was in 2020 when the index fell 15%. Of course, that was the height of the COVID pandemic. And then see the rebound that you saw in the second half of the year. And so there is no definitive trend that emerges. But in more often than not, the second half of the year has been fairly better as compared to the first half. At least I can't say the same over the last 3 years, but at least prior to that, it's been fairly okay. But the index, that's the index picture. It'll be interesting to see whether there is any returns or any reversal that you see in the second half. But take a look at, as we're talking about the IT names, right, the forgettable returns that you've seen. Infosys is the worst performer on the Nifty. As of now, for the first half of the year, it's down close to 38%. The last time it fell so was during the global financial crisis of 2008 when the stock was down 37%. Take a look at ITC. ITC is down 28.5% in the first half of the year. Never before in the last 3 decades has the stock declined so much, even in a calendar year, let alone in the first 6 months. Now take a look at HDFC Bank as well. HDFC Bank is also one name that has delivered positive annual returns every single year for the last decade. This is on the last 30 years. This is the third worst year that HDFC Bank has had. The first half down 19%. The last time the stock fell so much was back in 2008 when the stock was down 42%. And the worst such performance came in 1998 when the stock was down 30%. So these are the only 3 double-digit losses that HDFC Bank has seen in the last 3 decades. Now look at the broader markets. The midcap index has turned positive for the year, but look at Hitachi Energy. That is the best performing stock that we have had so far. For the year, so far the stock is up around 89%, and every single year that the stock has been as a public company, it has delivered positive returns. Look at the flip side, KPIT Tech. The midcap IT had this has possibly been the worst underperformer on the midcap index, down 42% so far in the first 6 months. Last year too, it was down around 20%, and in 2024 it was down 3%. This is the only 3 negative years that the stock has delivered as a public company. The standout name in the broader markets though is BHEL. Now look at the period from 2010 to 2020. It was only 2 years that the stock had delivered positive returns. Since then, since 2020, every single year the stock has delivered positive returns. This is the 6th straight year, and even in the first half of this year, the stock is up 45%. So that's a standout name for BHEL. The small caps is even better. The small caps, the BSE small cap index, 27 stocks so far have delivered returns of 100% or more. A standout name here is Sterlite Tech. Of course, the stock is up 500%. We've done a very big deep dive on this on our Unpacked segment with Rima. The 500% up move on Sterlite Tech. A similar performance from Bliss GVS Pharma as well. That stock is up around 230%. It's turned out to be the best returns for the stock since 2007. And back then, that calendar year, the stock was up 900%. Of course, that is from 3 rupees to 35 rupees. This is on a much larger base. But a big underperformer in the small cap space is CE Infosystems, or MapMyIndia as it's popularly known as. There's a record high back in 2024. The stock had hit close to 3,000 rupees. This is of course split adjusted. Now currently trading at 800 rupees, and for the first half of the year it's down around 50%. So on an index level, yes, it's been a forgettable start to the year, but there have been outperformers that have come in the first half, outsized returns as well, more so in the broader markets.
So more so in the broader markets is where you're seeing that outperformance. All right, Harmas, thank you for taking us through those details. Now, there is a bit of musical chairs underway at the big banks, with HDFC Bank, Axis Bank and Bandhan Bank all involved. Ritu Singh is here to tell us about this musical chairs that's going on. Ritu?
Well, thanks for that. Big leadership moves at HDFC Bank overnight. One that closes the chapter on months of governance uncertainty, and another that's triggered a game of musical chairs among top banking CFOs. First up, HDFC Bank has named seasoned bureaucrat, the former DFS secretary, and the ex-chief election commissioner Rajiv Kumar as its new part-time chairman for a 3-year period, subject to RBI's approval. And he's also been appointed an additional independent director on the board for 4 years, with shareholders set to vote on his appointment on the 5th of August at the AGM. Now, with the chairman's appointment in place and that clean sheet from the external legal review on the allegations that were made by former chairman Atanu Chakravarti, some of that governance overhang on the HDFC Bank stock hopefully goes away. And importantly, this also now clears the path for the reappointment of CEO Sashidhar Jagdishan, which is expected to be taken up in the coming days, as we've been reporting right here on CNBC TV 18. Now, separately, HDFC Bank has confirmed another news break. It has appointed Axis Bank's outgoing CFO Puneet Sharma as its new CFO. Puneet Sharma, of course, has been at Axis Bank, their CFO since 2020, before which he was also the group CFO at Tata Capital. And now, as we reported first here on CNBC TV 18, He's set to take over as the CFO designate first at HDFC Bank starting September and then formally take charge as a full-time CFO in December after the incumbent CFO Srinivasan Vaidyanathan retires from HDFC Bank in October. So the question is, who replaces Puneet Sharma then at Axis Bank? And that's the question, and that's where this game of musical chairs has been set off. Our sources indicate that Bandhan Bank's outgoing CFO Rajiv Mantri, who again announced his resignation at the bank just yesterday, brings more than 25 years of experience across Bandhan, Citi, Stancy, etc., is all set to join Axis Bank as its new CFO to replace Puneet Sharma, who in turn will be headed to HDFC Bank, completing this three-bank CFO reshuffle, with Bandhan Bank, of course, still left to hunt for a new CFO.
Ritu, thank you for that update there on the entire banking sector, the musical chairs, as we've been calling it. Well, the Delhi cabinet has approved the new electric vehicle policy of 2026 last evening, and Sudarshan is now joining in with the analyst views on the impact of this policy on the entire sector. Sudarshan.
So finally, the EV policy of Delhi has got the green light, and the expectation is that it will be implemented from tomorrow. If you talk about the details, all the details of the newly announced EV policy are the same that the government had released in its draft in the month of April 2026. So talking about some of the highlights, first, Delhi government's target is that of the entire fleet, 30% has to be electric by 2030, and from January 1, 2027, no three-wheelers will be apart from electric. So no CNG, no petrol electric three-wheelers from Jan 1, 2027. And it will be the same for electric two-wheelers, but the date would be Jan 1, 2028. And if you're planning to buy an electric car and it should be registered in Delhi, then there would be no road tax and no registration charges as far as the private electric cars are concerned if the price is up to rupees 30 lakh. Now coming to the impact on the stock. So one parameter that I have selected is the EV contribution to total volume. So the top Nifty loser today is Eicher Motor, because there is no electric vehicle contribution to their total volume. Next comes is Hero Motor. For them, the contribution is in the range of 2 to 3%. TVS Motor and Bajaj Auto are looking better placed, because Bajaj Auto, comprising of both two-wheelers and three-wheelers, the contribution is in the range of 8 to 10%. As far as TVS Motor is concerned, the contribution is 6 to 7%. Ather is up almost 5%. Ola Electric is up almost 9%. The reason? They are 100% electric vehicle players. That's the reason they are in the focus and they are buzzing in the trade. Coming to passenger vehicle space, for Mahindra & Mahindra, contribution of electric vehicle to total volume is in the range of 6 to 7%. And for Tata Motors passenger vehicle, which holds market share in the electric vehicle space, that's the range of 40 to 42%, and to total volumes, electric vehicles contribution is in the range of 12 to 13%. That's the reason Tata Motors passenger vehicle is one of the top Nifty gainers today. But bottom line is, till the time it's just in Delhi, the impact would not be that much, because the contribution to total volumes is in low single digit. If the neighboring states like Uttar Pradesh and Haryana also go for similar policy, then the impact can be large.
All right, Sudarshan, many thanks for taking us through those details. On that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
Welcome back. On to updates from West Asia. Then US President Donald Trump claims Iran has requested a meeting following the exchange of strikes last week and says that it will take place in Doha later today. When speaking to reporters, he added that the meeting may or may not be an important one. Listen in.
There'll be a meeting on that tomorrow in Doha, and to go into Qatar. I think they've already left, or they're just about getting ready to leave. So we'll see how that goes. But we're doing very well on that front. But the meeting in Doha is going to be perhaps important, perhaps not. We're going to find out. But we're winning militarily. It's almost won militarily, I would say. And it's really very simple. It's the denuclearization of Iran. We don't want them to have a nuclear weapon, and they're not going to have a nuclear weapon. And they've agreed to that, in all fairness.
On the other hand, Iran's foreign ministry says there are no planned meetings at any level with the United States in the coming days, but it says an Iranian expert delegation will be dispatched to Doha this week to follow up on the implementation of the Memorandum of Understanding signed on June 17th, including the release of frozen Iranian assets. Elsewhere, Iran's president slammed the US unreasonable boasting and unfounded threats and says Tehran will fulfill its obligations under the MOU if Washington adheres to it.
Time for a short break then. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. It's time to get you the latest updates from the world of tech, and we have Rachna Dhanrajani joining us now with all of those updates. Rachna?
Well, first up is WhatsApp, because for 16 years, identity on WhatsApp has meant one thing: a phone number. To add someone, message them, drop them in a group, the number was the key here. But that is now changing, because WhatsApp has started rolling out usernames, which will be a unique handle, like the ones we already use on Instagram or on X, that lets people connect and message without the phone number ever showing. The format is set from 3 to 35 characters, lowercase letters, numbers, full stops, and underscores. And once live, a first-time contact sees only the handle name. The number stays hidden, locked to the account for login and verification, but no longer the thing handed out to strangers. And WhatsApp has built this differently, because there will be no directory to scroll through, no suggested profiles. Reaching someone means knowing their exact username. There's even an optional second lock, which is a username key, a 4-digit code a new contact must enter before that first message lands. Spam and unwanted contact blocked at the root here, which is also the concern when the update first came out. Now, reservations opened this week. The handle can be logged in now. The feature switches on over the coming months, country by country, and it is optional. Skip it and WhatsApp works exactly as it does today. This is in fact the first move under Kunal Shah as he takes over the CEO of WhatsApp. And in a Twitter post, he said that he's joined in early to lock in that username for himself.
That's of course the big announcement on WhatsApp. But stay on, because also tell us about the data leaks at Tata Electronics, which has reportedly resulted in some secrets of the iPhone 18 being leaked.
Yes, as we had reported, there was a data breach at Tata Electronics, and now Apple is concerned. And when a company that guards its secrets as tightly as Apple uses that word, it definitely matters, because the reason is a data breach, like I said, at Tata Electronics, which is one of Apple's most important manufacturing partners in India. And what has leaked is not the usual design render. According to Reuters, at least 6 files are now circulating on dark web, map specific iPhone 18 Pro components to the exact supplier that makes them. Chips on the main circuit board, battery parts, camera modules, all of it. And that is information that Apple has guarded tightly and has never disclosed publicly with any iPhone ever. The folder even holds photographs of prototype iPhones going through drop tests at the Tata plant. The unreleased Pro models due this September are in this data leak. So the real worry here is not just the design, but it is the whole supply chain map, which vendor supplies what and where, Apple leans on a single source, all of it. And it exposes its bargaining leverage, and it weakens the point to rivals. Now, the data sits inside the cache of more than 200,000 files, around 630 gigabytes, dumped by a ransomware group called World Leaks. Tata has confirmed the incident to cnbc TV 18. It said that restricted access to sensitive systems and brought in a global consultant for a forensic audit. And the timing cuts deep at this point, because Tata is central to Apple's bet on India, a country that's on track to make 26% of the world's iPhones this year, up from just 6% 4 years ago. So a breach like this strikes at the trust holding that partnership together. And this is also not the first time a data breach has happened at Tata in the last 1 year. The last we saw was JLR. That definitely was cutting deep through the UK's economy when it happened at JLR.
All right, Rachna, many thanks for taking us through those details. Now on to updates from the FIFA World Cup. The round of 32 has lived up to the hype, delivering a series of dramatic upsets. Morocco stunned the Netherlands, winning 3-2 in a penalty shootout after the match ended level in regulation and extra time. There was more penalty drama as Paraguay edged past Germany, prevailing 4-3 in the shootout after another fiercely contested encounter. Brazil left it late against Japan, just when the match looked destined for extra time. Gabriel Martinelli struck a dramatic last-gasp winner to send the 5-time champions into the round of 16. The result also means there are now no Asian teams remaining in the tournament.
And with that, we take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Eicher. Absolutely flat on the Nifty. That's what we are starting the show with, and that's been the case since the start of the trading session. Consolidating at that 23,900 mark for now, but we've been discussing it's the expiry day, so there's a lot of action which is expected in the second half.
That's right, a lot of action expected in the second half. And the good part is, the broader end of the market is clearly outperforming today. Advance decline ratio there is doing very well and clearly in favor of the advances. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks trade soft as uncertainty over US-Iran talks cast a shadow on recent optimism around receding crude prices. IT and FMCG are the big drags, while chemicals and consumer durables eke out gains. Mid-caps outperform.
Unimech Aerospace and Manufacturing zooms in trade after company signs long-term supply agreement with FACC operations.
Delhi's cabinet passes the EV policy targeting 30% of the total fleet being electric by 2030. Stocks of Ola Electric, Ather and TVS rise, while Eicher slumps due to the lack of electric offerings.
Genus Power tanks in trade after a big block deal worth 267 crore rupees. Sources tell CNBC TV 18 GIC is the likely seller in today's block.
And sources tell money control global private equity major General Atlantic is interested in buying PAG's stake in Nuvama Wealth Management. The stock up nearly 2% today.
Okay, those are the top headlines that we are tracking for now. As we said, it's the broader end of the markets which continues to do really well. Nifty is consolidating at these levels. Realty index is the one which is an outperformer in today's trading session. A lot of movers in the broader markets considering, on the upside actually, considering that the advance decline ratio is in the favor of advances as we speak. We'll discuss all that and a lot more, but this is our special segment, Midcap Movers. Ria is joining us now to take us through the midcaps that are moving around in trade. Ria.
Well, yes, let's take a look at all the stocks that are moving around in today's trading session. Starting off with the gainers first, we have Ola Electric up nearly 9.5% today after the Delhi cabinet clears the new EV policy. Capri Global also performing well in today's trading session. In fact, the stock is up nearly 50% just in the last 4 months. Canfin Homes also seeing strong gains today on the back of strong volumes as well, trading on 6 times the 30-day average volumes traded today. 5-Star Bus also seeing strong gains today, although the stock is down nearly 33% in the last 1 year. And Ather Energy continues its strong rally, up nearly 3.4 times just in the last 1 year. Also looking at some of the stocks that have hit their 52-week highs today, there's Gland Pharma, Capri Global as well as Ipca Labs in this list, and Ather Energy as well as Kim's have hit their 52-week high as well as their all-time high today. On the flip side, looking at some of the losers in today's trading session, there's Schneider Electric taking a big cut today. RR Kabel also down in today's trading session, although the stock is up nearly 90% just in the last 3 months. KPIT Technologies as well as Latent View taking a hit today, and both of these stocks down nearly 40% on a year-to-date basis. And lastly, Birla Soft also taking a knock today, and the stock is also down nearly 30% in the last 1 year.
Well, thank you so much, Ria, for joining us and giving us a neat wrap of all the top movers as far as the broader end of the markets are concerned. Well, it's now a good time to get a quick technical check on the market. Saumil Mehta from Mirae Asset Sharekhan joins us. Saumil, good afternoon and thank you so much for joining us. Well, what are you making of the Nifty at current levels? Flat as flat can be. Do you see any upside or downside triggers?
Good afternoon to everyone. See, overall, the bias remains positive. That's the most important part here. The markets has taken support at 23,000, 23,100 and started making higher tops, higher bottom formations. Nifty is trading about 20 and 40 daily moving average. That is again a positive sign for the markets. Now the hurdle is around 24,200 and 24,400, which is 200 daily, very close to 200 daily exponential moving average and the upper end of the Bollinger Band. Now, once we cross this level, I think the next level on the upside in the medium term outlook would be 25,100. So that is what my target is in the medium term. But in the very short term, I'll be expecting markets to still consolidate around this area and break this consolidation on the upside. So yes, a halt, a pause for a couple of days, and I think that will break on the upside. The bias remains positive, and buy on decline should be the strategy.
Okay, all right. What about individual names then, Saumil? What would you recommend?
The first stock I've chosen is from the banking side, private banking side, the smaller bank, ITFC First Bank. The stock has already been in the uptrend, high top, high bottom formations in the monthly, weekly, daily charts, all time frames, trading about 20, 40, 200 daily moving average. Right now, it is being, forming a small triangular pattern, and I'll be expecting this to break on the upside. So the stop loss would be 77, and my target is 84 for IDFC First Bank. The second one is HAL. I'm preempting this stock because there is, good momentum in defense pack, and I'll be expecting the stock to perform well. It has taken support at 20, 40, 200 daily moving average altogether, and given a good positive close today, good positive candle today. So my targets would be around 4,650, and my stop loss would be 4,320.
Okay, thank you so much for joining us, as well as giving us your view on the markets and your individual trading calls as well. Well, we'll now slip into a short break. Up next, we'll be joined by Pranav Bansal of Bansal Wire Industries to discuss the promoter stake sale and also the business outlook going forward. Welcome back to Midcap Radar. Well, Bansal Wire Industries is in focus as the promoter group member recently sold a 2.99% stake. To discuss this as well as the FY27 outlook, we are joined by Pranav Bansal, MD and CEO at the company. Thank you so much, Pranav, for joining us. Well, was this particular stake sale largely an exercise to reduce the promoter stake below the SEBI MPS norms? Or what was the reason for the stake sale, and what will the promoter use the funds that have been raised for?
Yeah, so the main purpose for to do this was to get below the 75% mark, as is required by the SEBI for any new company that goes public. So we were touching towards the end of that margin, so we did not wait for that long. And also we have had very good interest from investors. So I thought it's the right time for us to do this. Why to have this overhang for such a long time?
Point. So that was largely regulatory. But Pranav, just confirming, there are no further plans for promoters to sell further stake. This is it, right?
Yeah, not as of now.
Oh, not as of now. It is a possibility in the future?
Yeah, I mean, we have always had very good interest from investors. So if any time we feel that it is good to bring a new investor on board, a good name on board, that will help us. We would definitely look at it. But as overall, the company does not require a lot of funds, so we do not see anything happening in the near future.
Okay, Pranav, before we go, to how exactly the current business environment is, between the last time we spoke and currently, there's been a lot that's changed, especially as far as supply chain disruption is concerned. At the end of Q4, you had given a volume growth guidance of 20%, an absolute EBITDA guidance of 20% growth for FY27, and you said that you would be adding close to 1.2 lakh ton at the Dadra facility. Are all of these numbers on track?
Yeah, so as a company, we aspire to grow at 20%, so that will still be our target. Of course, there has been some disruption in Q1, so we will have to discount maybe the Q1 numbers. And the good thing is that by the end of Q1, we are also back on track. So I think from Q2 to the rest of the year, I think we should still see the 20% kind of a growth. That's still our target.
Okay, so Pranav, you're saying the target remains at 20%. Has the disruption in availability of natural gas resolved? Of course, there have been some changes and relaxation that has been announced by the government for petrol and diesel. How has the gas situation been? How has Q1 panned out so far when it comes to supplies and demand on ground?
So Q1 has been a difficult quarter for us. We started with about 35% less availability of gas, so we were operating at about 65% from the starting of the quarter. But towards the end, I think every month has been better. May we had better availability of gas, and June we were almost back to normal by the end of June. So I expect Q2 to be under normal level.
Do you want to quantify the impact on the EBITDA margins that we can see?
On EBITDA front, as a company, we took a call not to increase any prices on our committed orders. And we have about 35 to 40 days of order book. So that order book, we definitely took a hit. That was a conscious decision on our part. We wanted to support our customers who've been with us for such a long time. So we did not increase any prices. But we have a cost plus model. So any new increase, any new prices or any new order that we have taken on the additional increase. But there was definitely a 4 to 5 rupee a kg overall impact because of the gas supply. So that will remain on the first 35-40 days of order book.
Okay, Pranav, get that completely. Pranav, at the end of FY26, you had said that, as far as the steel tire cord business is concerned, you were awaiting to do a product sample as far as one large tire manufacturer is concerned. June 12th, you've given an update saying that you've received the sample order. What is the status on that? What is the feedback that you've received? Can you name the tire company that you're supplying to? And, what will be the kind of margins you can enjoy on this product?
Yeah, so I can't definitely name the tire company, but yes, it is definitely one of the main companies that we've been focusing on. And this has been a very good breakthrough on our end that we've gotten this trial order ahead of our schedule. And we are set to release this within this month. And hopefully, we'll see some good numbers coming in. Once this trial is done. And because of this, another good thing that has happened is the tier 2 companies in India have also shown a lot of interest because they see that this product is doing well. So we see a lot of interest from the tier 2 companies also in this product now.
So you are saying it will, you'll start seeing results. What is the anticipation in terms of revenues? What is the big opportunity that you are talking about? And if you're saying there's more interest that has come by, would that impact pricing in some way? Will it increase more competition? There could be, price cuts for market share gains. Is that a possibility as well, considering that you're saying this is a product giving you higher margins as well?
Yeah, so this is, So we expect this product to give us about 150 crores of revenue. 300 crores of revenue once we utilize the 20,000 ton pilot capacity. So this will definitely help us there. And because of this increase, we have already set a target of 2 lakh tons from the current 20,000 tons level. So in the future, maybe 5 to 7 years from now in total, we would want to set up a 2 lakh ton facility, which with a revenue potential of about 3,000 crores.
1,000 crore rupees. And on what margins would that be? And Pranav, the second part of the question is, would the increase in competition impact pricing? And in that case, does that 3,000 crore rupee revenue target remain? Because maybe volumes would increase, but not the pricing.
So if we are able to do about 3,000 crore of revenue and looking at today's market price, our EBITDA percentage here would be between 20%, would be around 20%.
Okay.
That should remain on track. It is too early today to comment, whether this will help us increase our margins or help us increase our volumes today. But yeah, as soon as we get an approval, we will have more.
Are these players mostly tier 2 players, or are you seeing that coming in from a big player as well, interest in this product? Is there anything from the listed space who are you seeing are getting into this particular product as well?
Yeah, these are the top main 4 or 5 companies in the country, which take about 80% of the total volume in this industry, and we are looking at only those companies today to get this product rolling.
Okay, thank you so much, Pranav, for joining us, giving us a sense of, giving us an idea that there could sometime in the future be some further promoter stake sale depending on the interest, and some good results coming by as far as the large tire companies' order book is concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Absolutely flat on the Nifty, but there's a lot of action that's happening in the broader markets. The midcap index is outperforming, and we do have a couple of names which are buzzing on the upside. SP Apparels, for instance, continues its up move since the time the UK India FTA, the date has been announced. It's up around 9%. We do have Arvind Limited, which is doing well as well. And the other one on our radar is Gland Pharma. The stock is up around 5.5% in trade as we speak. But there is some update coming in on Nuvama Wealth as well. The stock is higher in trade. Let's go across to Money Control's Hamsini, who's joining us with more details. Hamsini, what are you picking up?
That's right. There could be a deal in the making is what I gather from sources. And the name that's coming out is a large US-based private equity, General Atlantic. Well, for context, General Atlantic once upon a time used to be an investor in 361. And if the talks do go through, which is the direction it's sort of headed towards, it could be GA's largest acquisition once again in the wealth space. Let me take you through a little bit of details there. A few rounds of conversations have happened thus far, right? And General Atlantic, as we speak, seems to be the only interested investor in the transaction. Morgan Stanley and JP Morgan both are advisors on the transaction. They're working with Nuvama to find a buyer there. And the reason for GA to have shown interest is because this would help it give access to one of India's top 5 wealth management outfits. It's a homegrown outfit. At one point in time, it used to be with Edelweiss. PAG, which has been an investor for about 5 years now, a Hong Kong-based private equity again, focused on Asian funds. They've been invested in the fund for 5 years and they've been looking for an exit. The first time they started the process of exit was last year, but that was also the time when these are news reports, unconfirmed, but Nuvama is said to have had a reasonable exposure to Jane Street, which was barred from dealing with Indian equities at that point in time, post which the transaction talks, which PAG had with then suitors, was brought to a halt. So this is a second attempt by PAG to sort of find a buyer for its stake. It's a very meaty stake that we're talking about, around 54%, of which about a little over 60% is also pledged or encumbered. So therefore, for PAG, it becomes very critical that this round of conversation does go through very well. And the other thing, the important thing here is that it is all dependent on valuations, right? Because Nuvama, as we know, is a listed entity. Stocks have risen up by about 21% in the last 6 months, although not so much when we look at it from a 1-year time frame. If valuations proves to be a hurdle, which I'm told by my sources may not be so much versus what it was last time, then the deal could go through. But let me just caveat it once again by saying that the deal closure is totally dependent on how valuations pan out.
See, one quick question. Given the fact that it's an over 53% stake, in case the entire stake gets sold, reasonable to assume that there will be an open offer that gets triggered?
That's what SEBI norms require a company to do, an acquirer to do. So there could be an open offer trigger in case the transaction goes through. But let's walk it one step at a time. For now, let's just hope that the deal does go through. Both parties are in agreement on the valuation, which is, I'm told, that the make or break factor as far as the deal is concerned.
Well, thank you so much, Hamsini, for joining us, giving us all of those details on that exclusive stock higher by over 2% on the back of that particular development that you've broken on the Money Control platform. Thank you once again. Well, when you're looking at the markets, the mid-cap and small-cap index continue to outperform. A name like Cochin Shipyard up almost 5% in the session. But with that, it's all the time we have on this edition of Mid-Cap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always, Vinny Motiwala. Vinny, good afternoon. Vinny, the last time we spoke to our guests and we answered some of the viewer queries, a lot of it was about flexi-cap funds and how do they really measure against multi-cap asset, that category in particular. And we thought let's take a deep dive into that, and that's exactly what we're going to do today.
Absolutely, that's exactly what we're going to do today, Sonal, right? Flexi-cap versus multi-cap, that's what our viewers asked us for, and that's what we'll explain it to them as well. Now, in terms of flexi-cap, flexi-cap is India's largest equity mutual fund category. When you look at the AUM as of May, it was around 5.6 lakh crores in terms of assets, and it's the highest in terms of the equity category. Multi-cap on the other side is around a 2 lakh crore market size. 2.32 lakh crores is the AUM as of May, half the size in terms for the category. But what's interesting when you keep an eye out on is the returns. When you look at the returns, obviously last year returns were not that great for the flexi cap. It was a negative return, while in terms of multi-cap, it was just 1% return. 3 years, 5 years, multi-cap has given better returns versus a flexi-cap fund. So what's the main difference when you talk about it, or where does the difference actually come in terms for the fund manager side? For the flexi-cap, you see that the fund manager has a complete freedom that they can put all their money in large caps or mid caps or small caps according to their will. The timing and the risk will matter. Multi-cap, there's a mandate by SEBI that 25% for each of the categories. So no matter what time or which time, if small cap is underperforming, still they would have to use 25%. Large cap is underperforming, still they would have to have 25%. So let's discuss more of this in terms what does this mean for an investor strategy point of view. To discuss all of that, let's bring on board Varun Fatehpuria, founder as well as CEO of Daulat Finvest, joining us right now. Varun, good afternoon. Thank you so much for joining us on the show. Let's start by talking about the sort of investors who should look at flexi cap and who should look at multi-cap, given that there are different mandates in terms of the holdings that they could have for different caps, right? Large cap, mid cap and small cap.
Good afternoon, Vinny. Good afternoon, Sonal. So I think both flexi cap and multi-cap as the category is fairly well suited for most of the equity investors in our country today. But I think the distinction really comes down to, as you correctly pointed out, is the level of discretion the fund manager has over the portfolio. So if I look at the flexi cap category in general, SEBI mandates that the fund manager needs to have 65% of the holdings invested into equity and equity-related instruments. It does not really mention whether it needs to be invested into large, mid, small. So the fund manager really has the complete playground ahead of himself to invest where he or she is finding relative value. So if they find large caps to be more attractive at any given point in time, they could be invested in that. If they find small and mid cap, they could be invested in that. So there is no really guardrails from that perspective. Multi-cap, on the other hand, I would say follows a more rule-based approach. So a quarter of the assets needs to be invested each in large, mid, and small cap. So let's say you're an investor who does not really want to take market cap calls, are not tracking the markets on a daily basis. For you, flexi cap as a category could be very well suited because you're giving fund managers the complete freedom to go out there and choose the stocks on your behalf. Whether, on the other hand, if you like a more rule-based approach, you want to be invested into small cap, mid cap at any given point in time, then I think for those investors, multi-cap tend to be a slightly more favorable category. And that's also seen in the kind of performance numbers that you brought it up on the screen just a short while back.
Okay. You know, one part of the puzzle is that how flexi-cap has been the category which people are looking at currently in the last couple of years as well. But when we talk about market volatility, Varun, which is a better bet to manage that, maybe for a first-time investor, maybe even for seasoned investor, is there a one answer that fits everybody approach that we can use here?
So I would say in general, flexi-cap we have seen tend to have a slightly lower volatility just by definition because they can move between large, mid, and small. So let's say if the fund manager is not finding the valuations of small and mid cap attractive, they could completely shift out of that and move into a flexi cap or the larger cap stock, sorry. But let's say in a multi-cap scheme, given by definition, you need to be invested 50% in small mid. So you would obviously have a relatively higher amount of volatility as compared to a flexi cap scheme. And we have seen that over the last year and a half too, where let's say flexi cap funds, and we have seen most flexi caps being large cap oriented, where the volatility has slightly been on the lower side. But Sonal, it also works on the flip side. If there is going to be a sharp recovery in the market, then we have seen obviously multi-cap funds tend to outperform flexi-cap due to the weightage in small and mid-cap stocks.
Maybe that is the reason, right? Because when I'm looking at the 3-year or 5-year, a bit on the longer side in terms of returns, multi-cap returns have been better versus flexi-cap, right? Correct me if I'm wrong. Is that the case so far?
Yes, we have seen. I mean, generally over a 3 or 5 year period, multi-cap have tended to outperform flexi-cap funds.
Okay, Varun, just more in terms for this as well, right? Flexi-cap, everything rides on your manager, right? Because you're trusting the manager and you're investing on that and depending on their judgment. Now, if the manager leaves or if there's an underperformance which continues for such a fund, what should an investor do? How quick should they make the changes? Is there a need to make the changes? What are the factors they should consider here?
I would say obviously the first thing is not to make any knee-jerk reaction, Vinny, right? There's a tendency for investors today to over-index on a certain amount of fund manager or a fund house. And given that if the fund manager tends to leave, there is still a good cohort and a bench that the fund house tend to have if they want to replace the fund manager who is going out of the fund, right? So there are 2-3 things I would say investors typically tend to need to follow. If you're having a new fund manager coming into the fund house or managing the scheme, I would say give them 3-4 quarters to really understand what kind of style of investing they tend to follow. If they're coming from within the fund house, there is a very high likelihood that they will continue to follow the same investment philosophy. But if they are coming outside of the fund house, and that is in contrast to how the fund house typically tends to manage the fund, so I think that's something that you could look at. Second, there needs to be a consistency in the investment philosophy. So there is usually tends to be a higher likelihood that if the fund manager tends to move, the fund house, at least for a certain period of time, would want the fund to be run in a certain manner. And that's the mandate that they would also give to the fund manager itself. And thirdly, tend to look at, I would say, the performance, not just in isolation, but compare it to the category average, compare it to the benchmark and see how that's performing. If there is significant amount of underperformance compared to the average, compared to the benchmark, then I would say that could be a good time to actually, look at changing your flexi-cap fund.
Okay, so in that case, Varun, see somebody already owns a flexi-cap fund. They want to expand the portfolio, add one more equity fund, just equity fund, not any other category for now. What do you think they should add? Should it be a multi-cap to complement this, something else? Sometimes people tend to have 2 funds of the same category. Do you advise that ever?
I would say usually the answer tends to be no, because there tends to be a significantly higher amount of overlap, right? So if you're holding the same amount of 40 and 50 stocks in both of the flexi-cap schemes, I think it does not really make so much of the sense for investor to be invested in multiple flexi-cap schemes. Yes, if the strategy is completely different, one is more of a benchmark hugging index plus strategy. The other is a true flexi-cap fund which moves across market caps and is very flexible. I think only at that point in time you could consider having another flexi-cap scheme. But I think in general, if you're looking at complementing your portfolio, then multi-cap in fact could be a very good strategy in addition to the flexi-cap fund that you're holding. Given that about 50% of the assets are in small and mid-cap, and if you're not holding, Sonal, I would say a lot of small and mid-cap funds in your portfolio, then multi-cap tends to be a very good complementary value add in that regard.
Varun, I just want to understand one more thing, right? Sometimes in flexi-cap, given that the fund manager has the flexibility to move around between caps, right? At certain points of time, there is a higher exposure, obviously, that comes into the large cap side. So then, isn't it sort of overlapping maybe a large cap fund that you're already holding or a Nifty fund that you may be holding on that side? So then how does an investor actually wade through this?
Absolutely, Vinny. I think you correctly pointed out what we have seen. There's a tendency for, I would say, flexi-cap funds with a slightly higher AUM to end up becoming more benchmark hugging. And as you pointed out, following a more like a large cap plus strategy. And then if you already have an index fund or a large cap fund with a flexi cap fund, which is gyrated more towards large cap, then perhaps it could not be a very well idea. The key point I would say investors to note is for their fund manager and how they are evaluating is, are they truly flexible? Are they truly moving across market caps when the valuations in one particular segment of the market tends to be more attractive? So let's say in September 2024, when small and mid cap obviously had become a lot more expensive, you could look at the portfolio allocation from that point in time to see if your flexi cap fund manager actually tended to move out from that and move into large cap and vice versa. If that's what your flexi cap fund manager is doing, then I think it's worth the proof of the pudding.
Okay, take that point. A lot more questions on this, but we have to take a quick commercial break. When we come back, we'll continue our discussion, discuss the flexi cap versus multi-cap scenario on the other side with Varun. Welcome back. You're still tuned in to MF Corner. We still have with us Varun Fatehpuria, founder and CEO at Daulat Finvest. We are trying to understand what works better for investors, flexi cap versus multi-cap, especially in a volatile situation. Varun, let's talk about a person who's been investing very regularly, an SIP investor putting, say, 10,000 a month over 10 years. This is a long-term perspective that we have here. Does the choice between a flexi cap and multi-cap actually matter that much, given rupee cost averaging smoothens the market cap timing risk?
Sonal, I would say yes, it does matter in the sense that if you're, let's say, putting money through an SIP over a 10-year period, whether into a flexi cap fund or a multi-cap fund, what SIP essentially does is eliminates the timing risk and it averages out your buying cost over a period of time. But what you're fundamentally still owning in a flexi cap or a multi-cap fund still materially differs, right? So what I would advise investors is not to look at either this or that. Both could have a complementary exposure in your portfolio, because even in a multi-cap fund, given that it has exposure to small and mid cap over a 10-year period, it will still have its own share of volatility. So for that specific fund, yes, through an SIP, you would be probably be able to have a rupee cost averaging. But let's say if I compare that to a flexi cap fund, which tends to be slightly more conservative in nature, whether I'm putting it through an SIP in that as well, I think the volatility by design will be lower given the portfolio construct, right? So whether you're doing an SIP in a flexi cap fund or a multi-cap fund over a 5-year, 10-year period, you will still have your own share of volatility for each of the funds. Obviously, the magnitude would matter given the underlying holding tends to be different in both a flexi cap or a multi-cap. So that's what I would say. I would advise investors to look at it from an SIP perspective.
And what about Varun, SIP versus a lump sum, right? Monthly SIP, if someone is doing that versus a lump sum, then how should one be picking between a flexi cap and multi cap? Is there a right time to maybe look at these funds then?
Yes, I would say when you're considering putting in a chunky amount of capital at any given point in time, then the timing essentially ends up mattering more in a multi-cap fund, given that it has obviously a higher amount of exposure to SMIDs. So let's say if you would have invested at the top of the market in September 2024, right, you could still possibly be looking at a year and a half of negative returns, given that you invested at the top. So lump sum investment in a multi-cap fund obviously is recommended given where the markets are to be staggered over a period of time. But let's say in a flexi cap fund, we typically like to think of that as an all-weather fund. So whether the markets are at an all-time high or it's probably just starting to recover, I think you could probably put in lump sum with a lot more confidence, given that you're giving that discretion to the fund manager that they would move between market caps given where the relative value is. So lump sum matters more in multi-cap compared to flexi cap, but for an SIP, I would say both of them are broadly the same.
Okay, so in that case, Varun, when we talk about the core portfolio versus the satellite portfolio, I believe flexi-cap or multi-cap can be a part of the portfolio. If not, why would you say that?
I would say yes, definitely. If someone is looking at constructing their mutual fund portfolio, and if they not have an overlap of a lot of small cap and mid cap schemes, then a good part of your core portfolio could be something like an index fund plus a flexi plus a multi-cap fund, because what's that doing is giving you an index exposure. It's giving you, let's say, a more flexible exposure across market caps and a dedicated exposure to small and mid cap, right? So that could become a very good part of your core portfolio. And to that extent, yes, we usually recommend how investors actually go about constructing and looking at their mutual fund portfolio in that manner.
Varun, you know what I want to also understand, when I'm picking up funds or when an investor is picking up a fund, right? Sometimes when you look at some of the multi-cap funds, they may have a lot of stocks in their portfolio versus a flexi-cap fund, which may not have that much, right? So in terms of the number of stocks that are held in each of these portfolios, how should a retail investor be looking at that? Wide diversification, is that a concern? Or when you're picking up multi-cap versus flexi-cap or overall in any of these caps, how should you look at it?
I would say, Vinny, the reason why flexi-cap could, let's say, have a slightly more concentrated holdings if the fund manager is more gravitated towards large caps is primarily due to liquidity. See, mutual fund at the end of the day is a retail vehicle. It is a T+1 liquidity vehicle. So if you are putting your fund out there for the entire public, and a flexi cap fund in that regard, they could very well manage with a smaller amount of holdings if they have a larger proportion towards large cap stocks, given that tends to be more liquid compared to small and mid cap. And that is the reason why, let's say, in a multi-cap fund, the tail range of the entire stock universe could be slightly higher, given that they could be investing into, let's say, less liquid stocks in the small cap and the mid cap universe. And that is the reason why we have typically seen in a multi-cap scheme, the number of stocks tends to be slightly higher. But again, I would not recommend investors to over-index on the number of stocks that you have and do a direct comparison. Ultimately, at the end of the day, look at, I would say, the track record of the fund and how they have delivered on a risk-adjusted basis. I think that's more critical compared to looking at just the number of stocks in a flexi-cap or a multi-cap scheme.
it's interesting you said that, Varun, because, you know, the other, I would not say myth, but an understanding that investors usually have is the moment the AUM increases a lot or goes above that 1 lakh crore mark, or you become a leader in that category, you do not really give returns, you underperform. What do you make of that? At a certain AUM size, say for PPFAS, FlexiCap Fund, which has been a darling of investors for such a long time, has underperformed. There are continuous debates on this one. Do you think any manager can truly be flexible at that size? You're talking about a size more than 1 lakh crore rupees. Does the fund become too big to do what it promises, or do you think the size really doesn't matter in this case?
No, I would say, I think, again, Sonal, given the depth of the Indian equity market, size definitely matters. If you are at a certain amount of threshold, no matter what you say, I think you're still managing for liquidity. So if you are at 1 lakh crore of AUM or 50,000, 70,000 crores of AUM, in no well regard you'd be able to pick up, I would say, stocks that the, let's say, smaller size market caps, right? Given just, I would say, the AUM acts as a big bottleneck for you, and you'll not be able to pick up meaningful positions. And that's the reason, I would say, more than anything else, why we as a wealth firm tend to have a slightly higher preference towards flexi-cap schemes with a smaller sized AUMs, given they tend to be flexible and true towards nature. And we have seen that in the performance as well, right? Once you obviously cross a certain amount of threshold, just by the nature of the fund size, you're not able to even take on bets that you want to. So definitely, yes, I would say size does matter in that regard.
Okay. Varun, just a quick one. If today an investor comes to you for advice, flexi-cap versus multi-cap in today's current situation, what would you be advising them?
I would say if you're looking at deploying in fresh capital, probably multi-cap is a better bet, given obviously valuations have both price and time corrected over a 18-month, 20-month period. And what we have seen from the lows of, let's say, April 2026, when the index hit 22,000, the rally in mid and small has been significantly higher, right? So anyone who would have participated at that point in time would have taken advantage of the upswing. But even as we speak today, I think valuations definitely are more on the attractive side. And if you're looking at putting in capital relative to, let's say, a flexi-cap fund, then my bet would be on a multi-cap scheme.
Take that point, Varun. Thank you so much for joining us at your thoughts. The debate continues, though, flexi-cap versus multi-cap. But thank you so much for your comprehensive take on this one. With that, we'll do one thing. We'll slip into a short break. Actually, we'll take a leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Like a bit of a mixed opening is what we could say for the Asian markets, right?
Meeting in Doha is going to be perhaps important, perhaps not. We're going to find out.
And it's a question mark because Trump essentially claimed that Iran requested for a meeting. Iran essentially says that nothing is planned.
It's going to be positive for companies like Bajaj Auto and Mahindra Last Mile Mobility.
Also, what will happen is on the bidding side, we are seeing a lot more interest.
The investors were very receptive to the kind of premium that is there.
So 24,000 odd on the Nifty.
See, as of now, all assets are open.
Well, it's been a topsy-turvy start for the markets.
Big leadership moves at HDFC Bank overnight.
It's finally inching closer as far as securing the final node is concerned.
But 8.5% downtick is what the index has seen on the first half of the year.
Absolutely flat on the Nifty. That's what we are starting the show with, and that's been the case since the start of the trading session.
Okay, there's a grand total of 13 points this Tuesday afternoon, and the Nifty is not doing very much. It's all about individual names, and there is traction there. This is Closing Bell. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, Rima, hi.
Hi, just as we speak, there has been a lift in the market. So we were hovering around 23,900. Now it's moved up close to about 50 odd points. But the story is also in the broader markets. The midcap index is up close to about 0.7%. The advanced decline ratio is firmly in favor of the gaining side. So we've got about 3 stocks advancing for 2 in the red. Lots of big movers on the way up in the large cap space. You've got a Maruti, Suzuki, many Tata Group companies, whether it's Titan, Tata Motors, passenger vehicles, higher in trade, Bharti Airtel. There is that Jefferies note, so that's pushing the stock higher. And on the way down, you've got Eicher Motors, and across the board, IT is selling off. So TCS, Infi, Wipro, Tech Mahindra down between 2 to 3%.
Well, you're right. And this order at the bottom of the screen, as we just sort of come into the program, transformers and rectifiers get a bagging on order over 1,000 odd crores from Power Grid. Power industrial is really the area where there has been so much activity. Look at the stock. Big spike. It's $10 since that news has hit the screen. So 342 on transformers and rectifiers at this stage. Well, let's just get in Mitesh, who's with us, with what he'd want you to do as far as trades go. Mitesh, good afternoon. Welcome back. Off the lows, but absolutely flat. What do you reckon? What's the trade?
Good afternoon, Prashant. I think, the market, and I've said this since yesterday, that the market is now showing signs of a sideways activity because, one, I think the declining indicators have been arrested, but the strength needed to get past 24,300 is missing. So this looks like a market which might just be in this range and not do much. And therefore, I think trading should be stock specific, or you would want to trade once the market is near the ranges, the edges, which is 24,300 on the upside or 23,800 on the downside. Having said that, the stocks are like Alchem is breaking out nicely, so that's a buy of the stock at 55.30. Look for targets of around 56.70 to about 5,700. And Torrent Pharma is another one which also is showing some continuation signals, so that's a buy. Keep a stop below levels of around 46.10. We look for targets of around 4,800.
Thank you. The only good part today, as you said, the range is still firmly intact. The low today was 23,850. So pretty much respecting the lower bounds. The 20-day exponential moving average on the Nifty has been 23,830. So markets have been holding on to that level. And as Mitesh said, till we are in this range, I guess markets will continue to consolidate. Mitesh, we'll come back to you. Let's talk about the top gainer on the Nifty, and that is Maruti, and it's got an upgrade from Jefferies. Sudarshan joins in to tell us more.
So positive brokerage note coming in for Maruti, and that is Jefferies has upgraded the stock to buy from hold, and target price is increased to rupees 16,500 from earlier target of rupees 13,800 per share. As far as demand is concerned, Jefferies says that PV demand in first half of this calendar year, say 2026, has been largely stable. Now, in the last few days, what has worked for not only for Maruti, for the entire sector, is West Asia tensions have eased, and because of that, there is a sharp correction in crude prices, and also metal prices have seen a sharp fall in the last few weeks, and that has allayed the demand concerns and also the concerns related to margin that these companies had. Most of the companies, remember, that have already announced price increase to make sure that to offset the impact of increase in the metal prices that they were seeing earlier. But now, over the last few weeks, those prices have come down. Jefferies has upgraded FY27-29 EPS estimates of Maruti in the range of 2 to 4%, now expects 16% EPS CAGR over FY26-29. Remember, even after 5% increase in the stock price today, Maruti is still down around 15 to 16% 2026. And on the valuation part, Jefferies finds very reasonable because it's 24 times FY27 estimate P. That's what Maruti is trading at, and it's very reasonable as far as Jefferies is concerned.
Sud, with regards to the electrification angle, no sort of concern from two-wheelers to four-wheelers? That's a broader question, not about Maruti, but does that come up?
Not really a major concern at this point as far as the EV policy is concerned, if you are asking about Delhi's EV policy.
Yeah.
Because the impact, if you talk about the EV contribution to the total volumes of all the companies you talk about, is very negligible. It's in the low single digit. So the only problem is if the same thing gets extended, that as you are talking about in the bazaar, that if other neighboring states like UP and Haryana go ahead and announce similar measures, then the impact can be huge, because most of the cars or bikes ply on Delhi roads come largely from neighboring states like UP and Haryana.
Okay, so let's just talk about the Delhi EV policy then, right? So what goes into effect when, and the impact then?
So first, I'll tell you that yesterday Delhi's cabinet has come out and approved the electric vehicle policy, and that would be effective from 2026 to 2030, and government is planning to implement this policy from tomorrow, that is July 1. Remember, in the month of April 2026, government had come out with a draft, and now the details they have in the final policy are almost the same. So if you talk about some of the details, first, by 2030, they believe that of the entire fleet, 30% has to be electric. Now, two segments, three-wheelers and two-wheelers. So for three-wheelers, all the three-wheelers have to be electric from January 1 of 2027. If you have any petrol and CNG three-wheelers, they will not be registered. For two-wheelers, it's the same, but the date is different, and that is Jan 1 of 2028. Now, if you talk about the incentives, if you are going for registration of electric three-wheelers in the first year, incentive is up to rupees 50,000. If you are going for the registration for two-wheelers, the incentive is up to rupees 30,000 in the first year. If you are planning to buy electric cars, that's basically private electric cars, and the price is up to rupees 30 lakh. Now you won't have to pay road tax, and the registration charges also would be waived. Now I have just taken one parameter to make sure that what can be the impact. Now, if you talk about the EV volumes contribution to the total volumes, now Eicher Motor does not have any EV. They had announced a flying flea, but they are yet to start the selling. So the contribution is nil. That's the reason this stock is sharply under pressure. Now come to Hero Moto. They have contribution in the range of 2 to 3%. That's the reason this stock too has seen a fall. Two stocks that are better placed amongst two-wheelers are Bajaj Auto and TVS Motor. For Bajaj Auto, comprising both two-wheelers and three-wheelers, contribution is in the range of 6 to 7%. That's the reason this stock has seen a sharp recovery from day's low. And same goes for TVS Motor. Their contribution is also in the range of 7 to 8%. Two stocks that are buzzing in the trade that are sharply higher are Ola Electric and Ather Energy, because they are 100% pure EV players. That's the reason they are higher. Coming to passenger vehicle, one stock that is market leader in this segment is Tata Motors passenger vehicle. They have the market share as far as electric vehicle is concerned of more than 40%. And if you talk about the contribution of EV to total volume, that's in the range of 12 to 13%. That's the reason this stock too has gained. As far as M&M is concerned, their contribution is in the range of 6 to 7%. So this stock is trading with a flat line.
Thank you very much for that. That plate is very useful. The contribution of EV to the company's portfolio for Eicher Motors is nil, and that's why that stock is bearing the brunt of the selling pressure today. It's down nearly 4%. Dharmesh Kant, head of research at Chola Securities, is now joining in. Dharmesh, lots happening, and in a bit we'll get to Sudarshan to talk about the auto sales numbers which start trickling in, and finally oil prices have eased, so that too on the sidelines is a positive. But a quick comment. Let's begin with Maruti Suzuki and the upgrade that we've seen, which has lifted the stock up 5.5%.
Yeah, normally this is a phenomena when MNC brokerage does a upgrade, the stock prices do go up. But I think second half would be challenging for most of the OEM manufacturers, both in the four-wheeler space as well as the two-wheeler space, because the base effect would be very high on the volume side. So how that is getting negotiated, the guidance is 5 to 7% kind of a volume growth. If that is the case, then I don't think there's much upside left from here. As far as input price and operating margin is concerned, maybe Q3 onwards it will stabilize in favor of these companies because price hikes they've already been taken, and there won't be any rollback. So I'm more of a neutral to a negative kind of bias for entire automobile space going into second half of FY27. And the reason is very simple: the base effect would be very high because that time from October till March it was a 20% kind of a volume growth. So to top that up this year would be a challenge, and most of the corporates are suggesting single-digit kind of a volume growth.
What about Eicher Motors? When we asked Tahir Badshah earlier about Eicher Motors, and he basically said that niche categories that they continue to execute. So even a company, say like Eicher, zero presence in EV, but they've got a very strong brand and a niche presence in the commercial two-wheeler space, premium. Do you think, now that this EV trend seems to be structural, is Eicher at a disadvantage, or do you think it will have its place? What is the portfolio call on Eicher now?
Eicher has his own brand recall. So somebody who wants to buy a Bullet will buy a Bullet irrespective of its being a EV rise. In fact, EV people will not prefer buying a Bullet motorcycle because it's known for its own value and the sound, the engine sound and all. So, but they have a passionate followers, and those people will buy it. So I don't think it's going to impact any ways as far as the volume growth is concerned. And EV and ICE is more of a cannibalization. I mean, people who has to buy a vehicle buy only one vehicle. So either they had an option of EV or ICE. So I think that will be played out across the companies. As far as present market share, the revenue sharing is concerned, that's not the right metrics to look at because today it may be 2-3%. But tomorrow, if their EV rollouts are fine, it may go to 10, 12, and 15%. That's the future. Eventually, most of vehicles will migrate to that. So I think the state of Delhi, the announcement which has come by, will be the norm pan India going say 5 years down the line. And there, the bus manufacturer should be looked into. More than 1 lakh of buses will be replaced by EVs. That is state transport buses and the local like municipal corporation buses like BEST does that. So that's a huge opportunity out there. We are still very low on the transition side. And maybe a JBM Auto kind of a company, Electra Green Tech, Tata Motors, these are the companies, CV side. And the PV, they're already the market leader. They are the ones who are, ahead of the race right now. And in two-wheeler side, I think Bajaj Auto and TVS Motor is a better bet than Ola Electric. There is, right now as we speak, the monthly run rate is more than 3x of what Electra does. So, go for better place and net, whether you buy EV or ICE, you have to buy one vehicle, and the volume growth is what one has to look into.
No call on Eicher, right, Dharmesh?
Eicher Industries has done pretty well. The valuation is the only discomfort out there. They have been getting market traction.
It's done
so I think
well.
the better way is play with Hero MotoCorp if you want to have a stake both ways.
I see. Got it. Fair enough. By the way, transformers and rectifiers, that order was flashing. The stock has seen an outsized move. It's a 1,000 crore order. Stock's up 7% now. So it's gone up straight. That's what I'm talking about. I've not looked at growth rate comparisons, etc., compared to other transformer companies like, the CG Power, and there is, of course, the bigger MNC guys, Hitachi and others, which are essentially in a different segment. But if you just run a simple screen, transformers and rectifiers is the cheapest name. There's no doubt about that. I think about 28, 29 times. The last I looked at it, it does come up as a relatively inexpensive name in a sector which is pretty expensive across the board. So there is Transformers there, about 5.5 higher. The other news which we got earlier was Dixon Tech's joint venture with Vivo, which may be approved soon. And this is all sources. Ashmit is joining in with details. Ashmit, take it away.
Well, this has been one key stock that a lot of people have been watching out for. Dixon Vivo JV. Bear in mind, this was signed back in December of 2024, and it seems to be inching closer as far as a final approval is concerned. Bear in mind, it was just earlier this month that the interministerial panel that is required under Press Note 3 approved this JV where Dixon has a controlling stake of 51%. Now, importantly, we were given to understand, we spoke to senior government officials. What they told us is that while the interministerial panel is required, it is not the final stage of approval. There is substantial paperwork that remains after that. There is still a final letter of approval that is to be issued. On the positive side, what we're picking up is that that final stage is only a few days away now, that the approval is in the final stages. It's only a matter of just a few final documents that need to be cleared that before the clearance of the issuance of the final approval letter. So clearly inching closer, the Dixon Vivo JV. It's been pending for a while now. December 2024 is when they signed it, but only days away now, the final approval from the government as far as this JV is concerned.
Thank you very much for that, Dharmesh. If it comes through and it's imminent, what will be the immediate impact on Dixon financially?
This was the very reason why we have selected that in a high conviction mid-cap portfolio a month back, assuming that this deal will go through. Post the con call, the management has indicated if the Vivo deal is not through, then 12 to 15% kind of a top line growth was that they were expecting. Mobile being stagnant, no growth out there, and margins more or less stable. It's the new electronic appliances, be it refrigerator and washing machines and the others where the growth will be coming down. But if Vivo JV deal happens this year with HKT synergies playing out in Q3 and Q4, they would land up anywhere between 25 to 35% kind of a top line growth, with price hikes being into place and input prices now as the seen is coming down. So that would be helping it. Margins may improve slightly earlier, but higher, synergies when play out in FY28, we will see a better margin improvement. So we are of the opinion, assuming that this deal is through, 14,500 to 15,000 was the price target we were expecting on Dixon, and that's the reason around 11,000 or 10,800, I don't remember it rightly, is the price we have recommended. So it's a big, good deal for Dixon in the present circumstances.
If I remember the last numbers, Vivo currently sells about 35 million smartphones in India. And with this JV, with Dixon is likely to manufacture 60 to 70% of Vivo's overall volumes, and even pricing. Vivo's portfolio is at a premium of about 20% higher than Dixon's current portfolio. And considering that in the last few months we've seen smartphone sales slow down, this approval will be a shot in the arm when it comes to Dixon Technology, awaited for a very, very long time. Any other interesting stocks, Dharmesh, that come to your mind that you've been discussing, engaging with your clients with?
Sorry, well, right now, no new ideas. The last one was Dixon, LG Electronics, Majgaon Dock, and Aadhar Housing Finance. We are looking for some stability. Maybe Q1 numbers will start rolling very soon. And based on how the bounces are panning out, we'll figure out that. As of now, it's more of a status quo.
Yeah, got that. The other story that we just want to highlight is what the IRDAI chairman, the insurance regulator, said. This was at an event. He spoke about multiple regulatory issues, including progress on the Bima Sugam program. And of course, listing of insurance companies. Yash is here with, just the highlights of what was said. Yash, take it away.
Well, Prashant, it was an important address from the IRDAI chairman, Ajay Seth. The core of his address today was how over the next 5 years, over the next 10 years, trust can be built in the insurance sector, which is going to be the moat for everything in terms of the penetration, in terms of density, so on and so forth. The first point that he spoke about is to make the important people in an insurance company equal stakeholders when it comes to creating that trust. Here, he said that a part of the remuneration which the KMPs of insurance companies get should be linked to three important things: products, claims, and the grievance redressal performance. If these three are impressive, then of course the remuneration should be in accordance in terms of the performance of the insurance company on these three parameters. The next one was on the all-important subject of Bima Sugam, the insurance marketplace, which promises to make insurance affordable, bring down the commission costs behind insurance. Here, the chairman said that the program for Bima Sugam is running little behind schedule, but he's confident of launching products, that is motor, health and term life on Bima Sugam by July end. So that's by September end, I'm sorry. So that's going to be an important timeline when it comes to Bima Sugam, that is September end. The another important subject were the distribution regulations, which possibly everybody associated in the insurance sector, has their eyes on. The distributors, insurance companies, policyholders, of course, distribution regulations talk about bringing down commissions, talking about the overall distribution landscape in the country. Here, an important timeline came from the IRDAI chairman. He said that the distribution regulations, the consultation paper on the distribution regulation should be out by July end. That consultation paper, before it comes out, is expected to be approved by the Insurance Advisory Committee. Finally, an important point that the chairman mentioned is that, insurance companies or distributors taking personal details of potential policyholders and endlessly calling them to, conclude those sales could be considered as dark pattern and can create friction. This will be very important because a large part of sales do happen through persistent calling from call centers of distributors as well as insurance companies. That the regulator feels could be considered as dark pattern and create friction as far as the sector itself is concerned. Finally, so far the insurance regulator has maintained that insurance companies which grow to a certain size and have spent certain amount of time in the industry need to make themselves publicly listed. Here the regulator said, taking a different stand, that for transparency, listing is definitely not required, and a listing is only required if these companies require capital.
Yash, quickly, from what the chairman, what we heard from the chairman, anything in terms of stock implications? I mean, is there anything which comes to mind straight up, directionally?
Well, distribution regulations, of course, is an important one when it comes to distributors, the listed distributors. Now there are two in that space, PB Fintech and Turtle Mint. So important for both of them, and that timeline of July end will be very crucial, which both those companies will have their eyes on. Apart from that, I think very interestingly, the point on taking personal details and calling them persistently for concluding sales was an important point. The chairman not being happy with that process, and that could be considered as dark pattern, could impact sales for some players here as well.
Got it. We are awaiting those, norms, and we'll see what happens. Yash, thanks very much for that. By the way, let's just look at Turtle Mint as well, which is the recent listing, right? Listed yesterday. And from the issue price, I think on day one, of course, it ended about 10% lower. Turtle Mint is what I'm talking about. PB Fintech, of course, is, I guess, 10 times larger. Is absolutely flat, 136 or so on this one. Dharmesh, any thoughts here, this space?
I mean, Prashant, the space is interesting and a lot of activities happening out there. Yes, what talked about right now is more of a structural and operational aspects of the insurance distribution and the marketing part. So that is good. I mean, it's coming. But essentially, what the field which we are getting is it will be cheaper for the consumers, you and me, going forward, and it will be a more beneficial for the people. I mean, the companies who are into the product business. So life insurance companies, GICs and the others will be more benefit from the structural reforms which are coming. Let it come through, but fintech players, they have to adapt to the game, and the agent-based, policy distribution will be under scanner, because if you look at new generations, they are more comfortable with using technology than interacting with in person. So that's a paradigm shift which we are seeing on the volume base, and these things will smoothen that out. So structurally, we are positive on life insurance companies more than general insurance companies. And there, I think Life Insurance Corporation of India, for us, it's a topic out there. Largest market share, one for the valuation multiples of other, and the new value of new business premium and the margins, the gap is narrowing between LIC and the private players. So growth is almost the same, 14-15% kind of growth. So a lot of value in LIC. The only overhang is heavy, Government of India holding. That's the only overhang out there.
Dhamesh, great chatting with you. Thank you very much for joining in. We will get into a break. On the other side, we've got Mithun Aswath of Kiva Advisors joining in. Stay tuned. Welcome back. Let's put the spotlight now on the top movers in the market. Hormis now joins in for more. Hormis.
The index may be quiet, but there is plenty of activity that is happening in the broader markets, and leading that charge is Ola Electric today. The top gainer on the Nifty 500, up almost 10%, snapped a 3-day losing streak today. Has stock has been an underperformer recently, declining in 8 out of the last 11 trading sessions. The stock has had 40 crore shares being traded so far, which is 3x its 20-day average. 17% of those shares have been marked for delivery. In fact, it is now the second most traded stock on the Nifty 500 today. The next important trigger for the stock comes as early as tomorrow when the auto sales numbers start being reported. And very recently, the stock had made a record low of 22 rupees. From those levels, the stock has doubled, of course, still significantly lower from its issue price of 76 rupees and its post-listing high, which was 157. KPIT Tech, of course, among the underperformers today, down well over 5%. The second worst on the Nifty 500. Similar as Ola, it has declined in 8 out of the last 11 sessions. On the premiums on the 680 put option for the July series is up 10% in today's session. Now, the volumes are the highest in nearly 2 months. We're at 43 lakh shares that have been traded today. The 20-day average is just 10 lakh shares, and a third of those are marked for delivery. And the stock this year itself is down 42%, and from its 52-week high, which is well over 1330, the stock has halved from those levels. And lastly, Eicher Motors, not among the top Nifty losers in today's session, not having a very good day. In fact, the stock was down in yesterday's trade as well, so down around 7% in the last 2 sessions, has declined in 4 out of the last 5. The premiums on the 7,000 put option for the July series have more than doubled in value in today's session, up 133% today. The close to 19 lakh shares have been traded. The 20-day average is just 3.5 lakh shares, and nearly half of those are marked for delivery. And from its 52-week high, well over 8,200 rupees, the stock is down around 15% from those levels.
Thank you very much for that. Mithun Aswath, Managing Partner, Kiva Advisors, is now joining in on the show. Mithun, afternoon and thanks for joining in. In the past, you've said that you find value in the large cap IT space while acknowledging that it is going through a challenging time. Have you had a look at the recent acquisition done by Persistent, Nagarro, the Munich-based digital engineering company, because stock got smashed yesterday?
Hi, Rima. I think on the particular acquisition you talked about, I think we saw similar reactions after Coforge's acquisition as well. So I think the market is just taking some time to kind of digest that news. And you also saw Coforge correct and then again rally back up from those lower levels. So I think more will be revealed maybe once the quarter results are over and the management talks about how they're going to execute this acquisition and how it's going to be accretive. As far as what I've read, I think it is going to be kind of neutral in the first year and then maybe EPS accretive in, going forward.
So do you have a recommendation or it's wait and watch till the company executes on it?
We did hold, in our client portfolios, but we had booked profit and exit out of Persistent. It was, a very good performer in our client portfolios earlier, but we don't have anything right now.
Mithun, very often when you've come, you've shared one idea, one theme that you like. So I remember TVS Holdings, in the past, you've spoken about the battery space. Any new ideas that you're pitching to clients?
Rima, I think currently one space where we are seeing that this trend could kind of continue is maybe the electrical vehicle space itself. Yesterday's announcement by the Delhi government about slashing taxes for passenger vehicles up to 30 lakh rupees, as well as making two-wheeler EVs compulsory from, I think, Jan 1st of 2028. These kind of measures definitely bode well. So I think that's a space where, even the pure play, electric vehicle manufacturers, you've seen them kind of rally. I think Eicher has outperformed. Unfortunately, we've not captured that opportunity, but TVS Holdings continues to be something that we hold and advise to clients. The other company that we've held and we continue to be quite positive is Tata Motors passenger vehicles. Post the demerger, I think the stock corrected substantially post the announcement of the JLR guidance in the analyst meet. However, if you look at the market cap of 1.3 lakh crores, and how the domestic passenger vehicle growth is shaping up for Tata Motors, I think this could definitely be one to look out for. Obviously, JLR is a large proportion of its revenues and profits, and hence the market gets spooked whenever there's talk about a slowdown in the luxury car market.
Okay. Vedanta was also a stock that you've liked in the past. It provided dividend yield. Now you've got 5 companies to play from that conglomerate. Which one are you betting on?
Obviously, we've advised clients earlier to have hold this company, and we've obviously got these 5 listed entities right now. We have not added to any of our positions at the moment or advised clients to do so. We are actually monitoring how metal prices are likely to behave, because you're seeing quite a lot of noise from the US where the new Fed chairman is talking about rate hikes. At the same time, you've seen oil kind of come off a cliff. So we need to get a little bit more guidance there because you've seen quite a lot of metal prices correct. However, amongst the companies that have got listed, I think Vedanta itself is maybe a play to, is kind of like a holding company for Hindustan Zinc. So it would definitely, it determines its price based on silver and zinc prices. While maybe Vedanta Aluminium is kind of the a larger company and maybe its flagship. And that would be kind of getting you the upside from the aluminium prices and their expansion plan. So I think obviously the price of aluminium also will determine upsides. But I think these two would be the ones where I think most institutional investors would have their eye on.
Yeah, 444, I think felt about 430, under 430 yesterday. It sort of came up about 10 rupees yesterday from the lows. Mithun, we had the management of KEC International with us, right? EPC company, operates in transmission towers, got a leg in the railway segment and a couple of other areas as well, but these two are the larger ones. I was just looking, available at about 22 times trailing earnings, FY26 earnings. It's in the right space, so as to speak, with everything which is happening with power. And, we spoke with him in the morning about what's lined up in terms of tenders, etc. So it looks like a pretty healthy overall order book. Guidance has always been for about 15-20% kind of growth on the top line. Any thoughts here?
Yeah, I think Prashant, obviously, I think the power space is something which is kind of a secular trend over the next 5 to 10 years, considering the government's investment as well as the private sector companies, what they've talked about. And then you have drivers for power in terms of data center build out across the country. And obviously, KEC is more like an EPC player in the space. And I think the only concerns happen here is the working capital and the execution. And that's what really matters when of these EPC companies you're looking at. The order books could be quite healthy, but how do you kind of convert those orders into profitable revenue and margins as well as cash flows? Because we've seen in the past, a lot of the infrastructure companies have struggled in India to do that consistently.
Got that. Just looking at a bunch of names, right? I mean, if you can have these year-to-date changes for these stocks, I mean, the point is what has done well has done so phenomenally well, and what has lagged has just been sort of out of flavor completely. Let's look at Inox India, which is the specialized gas company, and it's up 70%. Although bulk of the gains have come through since March. March, the stock was about $1,100. It's about almost 2,000 rupees right now. We are seeing a pretty big move. I think Shilpa Medicare is a big mover. It's up 90% this year. That's what I'm saying. It's been phenomenal for things which are doing well. They've continued to do well. Thangamile, for example, is another doubler this year. And they're all, by the way, coming up on top of the leaderboard. If you look at the NSE 500 list today, so that is another one. Cochin Shipyard, of course, not very much. Solar Industries is another one, another 50% this year. Last year, I think, was a 50% year as well. So much of this. look at Para's defense. And I'm not sort of, running the screen for the top gainers on a YTD basis. I'm looking at the top gainers today. It just so happens that these are also stocks where there has been momentum through the course of this year. Para's defense is up another 9%. For the year, it's up 90%. So just incredible with some of these names. Eicher is up another 50%. Eicher is the second largest volume-led gainer today. So that's where things are at. Ramco Systems is up 45%. Yesterday was a pretty large day for Ramco, and it's up another 4.5% today as well. Mithun, we leave it there. Thank you very much for joining us. Good speaking with you. What we're going to do is take a quick commercial break here. We'll come back. We'll get you a quick sense of what's happening in dealing rooms with Nimesh on D Street Chatter. And then, of course, we will move on to some trading ideas and further conversations. Okay, welcome back. Well, let's talk about what's happening in dealing rooms on D Street Chatter with Nimesh. Nimesh, take it away. What are you picking up?
high pressure and extremely volatile day of trade, and it's actually all over the place, right? There is the monthly expiry which is happening today, the quarterly closure is happening today. So, it's all over the place. It's really difficult to justify the moves in some of the stocks and names in today's market. Having said that, flow is again mixed in today's market, but there is a big change or a big up move in many of the select PSU names, PSU stocks today. And one of the reasons could be, and this is a very interesting feedback that I picked up, that maybe in the entire June series, the PSUs were under pressure, largely on back of selling from one of the biggest insurance companies. That seems to be getting over, and hence we're seeing a bit of an up move or a short covering rally in some of those PSU names in today's trade. IT, though, has been down another 2%, IT index, and a lot of individual names are under pressure as well. For IT, I think the Q1 is going to be quite important to track, but the expectation is that it's going to be a soft to a muted quarter. Not big surprises are likely, except for one or two names like Coforge and Persistent. So again, not much to watch out for in terms of IT earnings. So that's the index which is under pressure. But the most interesting feedback was there has been a pullback in the defense names because the selling is over, and that's going to be a case for many other names as well. Because now for at least for the companies, there will be a cool-off period. So the blocks will not happen. Large supply will not come in, at least in the earnings season. So that's a bit of a reason why you're seeing a bit of an up move in many of the stocks which have underperformed in the June series.
Thank you. What about any chatter that you've picked up on individual stocks?
So the first stock in my list is RR Cable. If you look at the 3-month chart, it's been a vertical up move from the March lows. The stock has actually doubled from 1,200 to almost 2,400. And now the buzz is that maybe you're going to see a large block deal in RR Cable very soon. The promoter entry is going to be likely seller. So if it has to happen, it has to happen before the cool-off period starts for all these corporates. So that's the first name. The second name is Maruti Industries. That's been buzzing in trade, up 4% in today's market. I believe the company is very close to raising funds via QIP. And at least one large domestic AIF is an anchor investor, and there is very strong demand as well. So hence, we're seeing been up move in that name today. The third name is Capri Global. It's coming to my chatter list again. Big move on that name as well on very strong buy flows. I understand one leading long only fund is an aggressive buyer. That same fund bought nearly 1% in the block deal as well last week. So and that's the reason why Capri Global is almost at a 50-week high in today's market. And the last is ASM Technologies, a thinly traded stock, but again close to 50-week highs. And I believe even in ASM Technologies, the momentum is largely because there is an anticipation that post Q1 earnings, there's going to be fundraising in ASM Tech as well.
All right. Thank you very much for that. Back to getting some last-minute trades, some BTST calls. Mitesh, what do you have for us?
Yeah. So I think the markets, are slightly on the negative side. We have been trading majority on the buy side, so we'll take some sell side calls. 361, that's the stock. It's at about 1100. It's at about 1075. So that's a STBT with a stop at 1086. Look for targets of around 1050 on the downside. That could be a 1-2 day kind of a call. And the other one is actually more on the crude kind of a thing. Goes cooled off, but the charts of Asian paints have turned weak. So that's an STBT with a stop at 2646 for targets of around 2600.
Thank you very much for that. Very, very volatile for the markets. There's been a sudden dip in the markets. When we started the show at 2:30, the Nifty was closer to 23,950, and now as we speak, nearly 100 points gone. I guess this is the volatility associated with the Nifty monthly expiry today, even the quarter or half-yearly rebalancing which takes place in some of the portfolios. In fact, this is the perfect time then to get a sense of how half the year has gone by. The broader market performance, individual names. Hormus is here with a report card for the mid-year.
Well, on the index level, it's a pretty forgettable first half of 2026. At the start of the year, we saw a record high, and within a couple of months, we ended up seeing a low for the year as well. 26,373 on the 5th of January, and then in April, we ended up going down all the way to 22,182, and now we are struggling to where we are right now within this very narrow range. So an 8.5% downtick on the Nifty over the first 6 months of 2026. We'll take a look at the historical trend as well, right? I'm looking at the last 10 years because It's the last decade that the Nifty has delivered positive returns every single year. This 2017 was one year when the first half and the second half both saw double-digit returns. You take a look at the 2020 period as well. There's the first half of the COVID period when the index was down and then saw a very sharp rebound as well. In general, the second half here has been better than the first half, but then you can't necessarily say that over the last 3 years when the first half has generally been a better one in comparison to the second half, starting 2023 onwards. So no definitive directional trend that the market takes either in the first half or on the second half of a calendar year. But if you take a look at the best performers or the worst performers actually, take a look at IT, no surprises for guessing here, no prizes for guessing. Look at Infosys down 37% in 2008. In the first half of the year, it's down 38%. So it's a decline more than what it did during the global financial crisis. ITC is down 28.5% so far in the first half of the year. Never before in the last 3 decades it has declined to such an extent. HDFC Bank, this is the third worst year that the stock has had in the last 3 decades. Now, if you take a look at the price performance as well, it's down 19% in the first half of this year. The last time the stock fell double digits was in 2008, and before that, it was all the way back in 1998. You look at the broader markets, and Hitachi Energy is the best performer on the midcap index, and every single year of it being a public company, it has delivered positive returns. It's up 90% this year in the first half as well. We just spoke about KPIT a few minutes back, and it is the third straight year when the stock has delivered negative returns, already down 42% in the first half of the year. The one stock that stands out though is BHEL. Between 2010 and 2020, only 2 years of positive returns, and now 6 straight years of positive returns. The first half of this calendar year as well, the stock is up 45%. The small cap index is better. 27 stocks on the BSE small cap index, which has returns of 100% or more. And the standout performer here is Sterlite Tech. We've discussed this in great detail with Rima as well on the Unpacked series. 500% higher in the first 6 months of the year. Bliss GVS Pharma has had a similar return as well. 231% in the first 6 months, the best since 2007. But the one underperformer is CE Infosystems, a record high of close to 2750, currently at 800 rupees, down 50% in the first 6 months of the year. So on an index level, we may have not gone anywhere. Plenty of opportunities in the broader markets and the positive side as well.
Thank you very much for that. Jay Bala of cashthechaos.com is now joining in. We've got about 12 minutes to go to wrap up today's trading session. Jay, we've been consolidating in this trading range for a very long time. Are you sensing a breakout? Because it's frustrating many people.
Hi, Rima. The markets needs to do just one small thing. Probably a final dip towards 23,600, 23,500. Once that's done, I would anticipate this market to take out the recent high of 24,250. And if it does that, it's going to be extremely bullish. And the markets are probably waiting for a trigger to come through, either from Reliance or IT to see its selling climax, or some kind of trigger is likely to come from one of these. So the very short-term structure is still a bit ambivalent, but the medium-term structure is very bullish, and I'm expecting fresh all-time highs to come through in the next couple of months.
That's Nifty, is it, Jay?
That's right, Prashant.
I see. And so I mean, the trade is what? Go long here?
Yes, I would position myself long around 23,600. And if you want to be more conservative, it's better off for the markets to cross 24,250. That way, you're not preempting the markets and you're going with the trend. That's that cross of 24,250 with 260, which is the recent high. It'll tell you that the markets are clocking higher highs, and within the Elliott wave balance, that will signal the start of the third wave.
What will lead this? You think this move higher? What names? What sectors?
I think the leader will still remain the capital goods space and the defense space, but you're going to get the underperforming Reliance and IT stocks will probably stop selling. Once that happens, we'll probably get lift up from the rest of the space. The IT stocks just need to stop falling. The recent break of the May low for Nifty IT, that was a bit of a disappointment. That was not anticipated, but. 26,235, that is one level that the Nifty IT can hold. Otherwise, it's going to go to 24,500. So, so once the selling exhaustion is over, the rest of the large caps can start moving. I would anticipate Reliance to be the trigger. And once Reliance crosses 1340, 1370, that will be lifting the markets higher.
We have a Nifty Defense Index. Or
Yeah, we do.
We do, right?
Yeah, we do.
Brain freeze. I can't find it. I said, but when you said capital goods and defense, right, Jay? These are the two indices, sectors which largely should continue to do well into this up move.
That's right.
Yeah, so we can talk about some stocks in a bit. But, tomorrow we'll also have auto sales numbers. And yeah, that's the Nifty Defense Index, which was up on your screen. And I'll just come back to defense in a bit. But Sud is standing by with the auto sales expectations for the month gone by. Sud, take it away.
So, Prashant, if you remember last week, we were talking about the retail registration data and how June month is panning out. So, if I can update you with the registration numbers so far, the total registration is up more than 20%. And this is going to be the first year where each month of the year so far has seen total registration of more than 23 lakh units. And if the current trend holds, obviously it will hold. June 2026 is going to be the best June ever that we have seen. Now, coming to the wholesale data expectations. So, like retail data, wholesale data are also looking very strong. And on the back of that, passenger vehicle segment is seen growing by 26%. For two-wheelers, growth can be as high as 18%. For commercial vehicle, growth can be 12%. And tractor segment can see a growth of 7 to 8%. Talking company-wise, in the two-wheeler space, two companies that are going to outperform are Bajaj Auto and TVS Motor. For both these companies, growth can be in the range of 25 to 26%. Royal Enfield can see a growth up to 20%. And Hero Moto can underperform, and here it can be flat YOY. In the passenger vehicle space, the one company that is going to outperform by a huge margin is Tata Motors passenger vehicle. Growth can be as high as 71%. Followed by Mahindra & Mahindra Auto, for which growth can be 30%. For Maruti, growth can be more than 20%. And one company that is going to underperform is Hyundai, and that can see a decline of as much as 30% YOY. In the commercial vehicle space, Tata Motors commercial vehicle is going to outperform. Growth can be as high as 26%. For Ashok Leyland, growth can be around 16% or say 10%. And in tractor segment, for Mahindra & Mahindra tractor segment, growth can be 5%. So overall, like retail data, wholesale data is expected to be strong as well for the month of June 2026.
Okay, thank you very much for that. Get into a break. We'll come back with more. Welcome back. Counting down to today's trading session. Looks like a close below the 23,900 mark. A little disappointing considering that we've come off sharply from the day's high. But the key is we're still managing to hold on to the important support level of 23,830 or 800 broadly. So that's holding on. In conversation right now with Jay. Jay, any more ideas that you'd like to share as markets hopefully make their march towards all-time high levels?
I'm very bullish on the pharma space, but pharma is a lightweight within the large cap, so it may not contribute that much. But stocks-wise, Alembic Pharma is breaking out of the inverse head and shoulders pattern, and so it's the medium term looks a little bit doubtful, but it's presenting a very, very bullish picture. But I don't want to commit to it right now. But the short term is clearly bullish. A stop loss of about 710, and I'm expecting this to reach at least 1,000 in the short term. The other one I have for today is Maruti. Maruti is consolidating, has been consolidating sideways the last few days, and it's breaking out. Stop is about 12,700, possibly fresh all-time high, so 18,000 and change.
Got it. Anything in the automotive pack? You've got Maruti on one end of the Nifty gainers list and Eicher Motors at the other.
Yeah, I mean, I like Excite also within that space. I'm expecting it to complete its long-term structure and head to fresh all-time highs. I mentioned this a couple of weeks back. And I've been bullish on Motherson Sumi, so I still expect it to touch somewhere about 160. So the upsides are getting limited here. Yeah, and I would still watch out for secondary plays within the auto space, not the front line. Front line like Maruti will be the opportunities I believe will be far and few.
So what are the secondary plays other than Excite?
Yeah, you look at ancillaries like Excite and even Amara Raja batteries, and I would look at EV related plays like Eicher. Eicher is still already at fresh all-time highs, so you would have more legs to it even from current levels, but the risk rewards aren't great at current levels.
Would you buy any IT name? A lot of mid-cap IT stocks are sharply lower. KPIT Tech, Tata Tech, Birla Soft, LTM, Tata Elxsi. These are all seeing cuts anywhere between 4 to 6% today.
Best IT, in my opinion, is Tata Technologies, and that's doing what other IT stocks aren't doing. Even there, I would wait for a pullback. But the rest of the names, I won't touch it yet. But I'm also watching the smaller IT name like Newgen. So I'm waiting for Newgen to close above 537. If it closes above 537, I'll get very bullish on it.
Thank you. Jay, the bell has gone and the Nifty's closed at the 23,918. A slight downtick of about 27 points, 80 points lower on the Sensex. A very volatile session as the Nifty monthly expiry, the quarterly and the half-yearly rebalance played out. On the way down, it was Eicher Motors negatively impacted by the Delhi EV push and the IT names. So TCS, Infosys, Wipro, HCL Tech under pressure. Consumer names like HUL, ITC, Tata Consumer also sold off. On the way up, you had Maruti Suzuki, clearly the top gainer, 5.5% after the Jefferies upgrade, and strength seen in Titan, Adani Enterprises, Bajaj Finance, Eternal, Adani Ports. So these were some of the big movers. What's the heartening part about today's trading session is the support of 23,800 holds on, and secondly, the mid-cap index and the small-cap index outperform. Mid-cap index ending with a gain of half. We're going to take your leave and closing bell. Thank you very much for watching. Don't go anywhere. Markets forward on the other side.
India's private banking space is seeing a big talent churn. In fact, there is a musical chairs of sorts playing out at the CFO's desk of some of India's top private banks. Axis Bank's loss is HDFC Bank's gain, with Puneet Sharma being appointed as CFO. On the same day, Bandhan Bank announced the resignation of its CFO Rajiv Mantri, who is likely to fill the vacant CFO slot at Axis Bank. This is, of course, yet to be made official. These two exits are only the latest in the leadership churn at India's banks. And it's not just CFOs, by the way. HDFC Bank has named former Finance Secretary and the former Chief Election Commissioner Rajiv Kumar as the next part-time chairman after the controversial exit of former chairman Atanu Chakrabarti, who resigned citing differences in values and ethics. HDFC Bank has the added uncertainty of CEO Sasi Jagdishan's reappointment, which is yet to be finalized. In another surprise move, Kotak Mahindra Bank has said its CEO Ashok Vaswani will not seek a second term, and the search for his successor is currently underway. So what is behind this big bank churn, and will more follow? What will the next set of leaders have to shoulder in terms of growth priorities coming off a Goldilocks period of strong profitability, healthy balance sheets? What will need to be the recipe to grow in a competitive and challenging environment? Well, those are the questions that our editors will answer on the playbook today. Joining me is, of course, our banking expert who had a breaking and a banking evening yesterday, Ritu Singh. She joins us from Bangalore. We're disrupting the boys club today. And of course, also with us, Prashant, Nimesh and Sriram. Yes. Guys, thanks very much for joining us. Well, musical chairs, no musical chairs, at least in our studio today. But let's decode the CFO chair that Indian banks are more important. HDF.
We should also do a musical chair.
Are we doing it or not doing it? What are we doing?
Not doing it. So let's do this.
Okay. Our own version of musical chairs going on.
Now you decide who the question was.
So Ritu, as the boys settle into their new roles, let's decode the changes that we've seen. HDFC Bank choosing yet another bureaucrat to lead its board.
Yeah, and I hope, our boys have left one chair empty for poor Bandhan Bank that still doesn't have a CFO appointed. But, actually, Shireen, I think there are three. Okay, there is space on the table.
But not enough bureaucrats left.
Okay, yeah, I think there are three different stories that are playing out here simultaneously. And, together, I think they fit together quite beautifully. I mean, one, of course, is governance. That is the HDFC Bank story playing out. The second is the question of succession planning. There you have your Kotak Mahindra Bank. And the third is this scarcity of proven leadership talent. And that explains that CFO musical chairs we've been seeing, across Nimesh, Prashant, Sriram, and in the banking system, of course. But let's start with the CFOs, because I think that is actually a talent story. The right question to really ask, Shireen, is why are banks just going around hiding from each other, not looking outside? And I think the answer is because there's very few experienced bank CFOs that fit the bill today. A modern banking CFO is not your accountant. I mean, their role is just across, capital, liquidity management, your Basel norms, your investor relations, looking at treasury with all that's happening, interfacing with RBI, looking at audit and supervision, technology investments, even M&A, and I can go on and on. I mean, effectively, they're the CEO's co-pilot, and there are very few executives in the country with that breadth of experience. So, banks largely hiring from each other because talent pool, I believe, is limited. Now, coming to HDFC Bank, your question on the choice of Rajiv Kumar as chairman, and I think it's quite interesting, opting once again for this seasoned bureaucrat as chairman rather than, someone from banking or corporate, as many in the market had expected. But look at Rajiv Kumar. I mean, he understands government, of course. He's been in the finance ministry intimately. Regulation, he served on the RBI board. Banking, he was the DFS secretary. He was on SBI's board. Governance, of course, and having overseen all of these big banking policy changes during his time at the finance ministry. So, yeah, on paper, he checks all the boxes and pretty much what HDFC Bank needs today. But then, of course, there's this other school of thought. If you had such problems with a bureaucrat like Atanu Chakrabarti, why bringing in another one? Interestingly, let me also point out, Rajiv Kumar and Atanu Chakrabarti, by the way, were contemporaries in finance ministries, I think around 1920 or so. Both were serving at the same time. Rajiv Kumar as Finance Secretary and Atanu as the Economic Affairs Secretary. I just want to add that, governance also seems to have become a valuation issue, which was probably not the case 10 years ago so much. But now governance directly impacts your market cap. I mean, look at Yes Bank, look at IndusInd or RBL Bank, and now HDFC Bank, even Kotak with their embargo. So markets price governance almost like NPAs. So appointments are very, very significant.
No, you're absolutely right, Ritu, and many important issues that you brought up there. And I think the talent issue that you brought up in terms of why we're seeing actually this musical chairs playing out is an important one, because it's not just being reflected at the CFO desk. It's also being reflected at the CEO desk. And we'll come to that in just a bit, because that's the other big issue. And that's the other leadership change that we are going to have to contend with. Shashi Jagdishan's reappointment, of course, is still a pending issue. And then, of course, you have a whole slew of other banks that are slated to see leadership changes in 27, well into 2028. And of course, the big one that's coming up again in the private sector space is Kotak Mahindra Bank, that surprise decision of Ashok Vaswani not to seek a second term. But, we'll address that in just a second. But Nimesh, let's also look at it from a valuation point of view, because Ritu was pointing out that we've actually seen all of this being reflected in the stock performance as well. But let's change the lens and the color a little bit. We're talking about private sector bank leadership changes. Let's look at the market performance now. Stock performance of private sector banks versus public sector banks. And that story is actually interesting, because it's the public sector banks that have the edge.
Oh, absolutely, Shirin. So I just looked at the last 5-year return CAGR for PSUs versus the private banks, and it is shocking. Hands down, PSU banks have outperformed the private banks, and the chart will come up. All the PSU banks in the last 5 years have minimum given, 15, 20, 30% CAGR returns. This is a stock price movement in the last 5 years. And if you compare that to the private banks, it's been a rank underperformance from the private banks. Imagine HDFC Bank has given virtually zero returns in the last 5 years. Kotak Bank, hardly any returns. There were some banks which have given negative returns as well. This is a list of PSU banks, all in double digits. And look at private banks. Axis Bank and ICICI Bank, the only ones who have given 10 to 15% returns. The rest all are either negative or flat. So, that speaks for the volume that in the last 5 years, and it's not only the stock market returns, even in terms of performance, if you look at the PSU bank's performances, it's been much, much better, and they've improved on all metrics in the last 5 years. So again, from a performance point of view, of course, PSUs have outperformed. But the big question now is, which I keep asking to a lot of investors as well, is the best of PSU priced in, and is the worst of private banks priced in? You're seeing a lot of churn in the private banks. It looks like they're all now, coming to the terms of taking the right person and starting to deliver. So from a valuation point of view, it looks like the worst of private is priced in and the best of PSU is priced in.
Shirin, I looked at, just to amplify Nimesh's point,
yeah.
I looked at the Nifty, there's a private bank index, there's a PSU bank index. So Nimesh talked about all these stocks, right? But if you just take the index close as of 2020, and today's close, today intraday rate, not very different from the close. The private bank index CAGR is 10%.
Yeah.
That is from 2020 to today. The PSU bank index CAGR is 37 point something. 10, 37 is humongous difference.
In the private banks, if HDFC Bank and ICICI Bank don't perform, it's going to show up in the Nifty index as well. So it clearly shows up that PSU banks have massively outperformed the private banks.
Yeah, but Prashant, let's just take that conversation forward, and we'll get Ritu to chip in as well. Nimesh raising a very interesting point there, which kind of also takes me back to the conversation that I had with Uday Kotak, and he said, the era of lazy banking is over, and we're all going to have to fight for our business. We're all going to have to fight for relevance and market share and growth and profitability as well. So to Nimesh's point, is the best of public sector banks behind them, and is the worst of private sector banks behind them? Things stabilizing now as far as IndusInd Bank is concerned with the leadership change. The hope is that will, there will be certainty now with the chairman being appointed at HDFC Bank, with the reappointment of the CEO as well. What's the street penciling in there, Prashant?
Shireen, I was thinking where to begin, right? Should we begin in 2014, 2015? I mean, I think we should begin in 2015, right? This is when the famous AQR, Asset Quality Review, started. But the point is, we did not, and of course, these PSU banks have been doing this in a way. The program itself ended, but they've been kind of, on the mend, so to speak, fixing their books, recoveries, etc. for the last, actually since that time, since 2015. And I'll come to why that is also, the recoveries part is also a big portion of why PSU bank earnings have grown much faster. 2017-18 was, of course, ILN affairs, then there was COVID. And it was not as if by that time the PSU banks had fixed all their problems. I mean, the AQR, etc. was still going on. And then there was recapitalization. Then the interest rate cycle turned sometime in 2021, 2022. And of course, we all know what has happened since. If you just sort of distill it through three things, why the PSU banks have done so well compared to compared to private sector banks, it's three areas. Market share gains. This is a point where which many have made forcefully, and I think it's well acknowledged. People like Sridhar Sivaram has been making that point on our channel, and others as well. That if you look at home loans, if you look, retail assets, basically, there has been 10 to 15% swing in market share between what was with private, which has now gone to PSU. That is number one. Number two, credit costs was this problem, right? When there were phone banking and NPAs, and just go back 10 years. It's now completely changed. Yeah. Actually, if you look at credit costs, they are across PSU banks, they are comparable to what we see with private sector banks. And the third, which is return ratios. If you look at return on assets, it's like almost, it's incredible. Any PSU bank, and we speak with so many PSU banks on every quarter, right? The 1% number is almost universal now. Most PSU banks are at 1%, getting to 1% or above 1%, right? So I think these are the three areas. And the ROA point is important because it kind of conveyed to the market that the PSU sort of model is sustainable and it is profitable, it is doing well. And I think these are the three areas why they kind of outperformed in such a large way. Now to the question, right, is the outperformance here to stay? I'll just make a couple of points, which is not anti-PSU, but maybe, this is, the better way to put it is, everything in markets is at some level cyclical. So is the cyclical, is that going to play out here between PSUs and private sector, and maybe private sector rotates back into the limelight once again? So 3 or 4 points. PSU banks funded the credit growth, the market share gains that we were talking about, right? Where did that come from? So one argument is that PSU banks funded these incremental credit growth by drawing down on SLR buffers, right? Which is essentially, government bonds, which they have to hold on their books by law. So if you look at the PSU bank SLR levels, in FY22, that number was 25%. It's close to 20% now, which is they can't go very much below that number, 20%. So that buffer of funding credit growth through these cheaper SLR deposits is no longer exists. Yeah. Number two, the ROA, headline ROA, 1%, great. But if you look at this, the composition of PSU and private bank earnings, the PSU bank earnings are a much larger proportion of these PSU bank earnings is treasury profits and recoveries, which they have been undertaking from written off assets, etc., right? So the core ROA, if you compare private and PSU, while the PSU is still 1%, but the core ROA is, some would argue, is structurally better. It's not dependent on, the movement in GSECs, government security, GSEC yields, GSEC prices, or recoveries, etc. Number 3, PSU banks operate at a much higher leverage, 12 to 17 times, which means that a small increase in credit costs can have an outsized impact on the return on equity, return on assets, etc. And of course, the last point is pretty clear, which I think Nimesh has been making as well, which is valuations now. PSU banks, compared to their own history, which is 10, 15-year history, they're about 1 standard deviation above their, that mean. And the private bank index is, of course, now almost 1 standard deviation below the 10, 15-year mean, so to speak. So I think, as I said, this is not to say that this is, the era of PSU bank outperformance is over, but maybe
I think we should also remind that it's not always just a binary of PSU versus private, because there are now umpteen new sources of credit. NBFCs are there, so many other. Ritu's story from a couple of weeks ago, I think 3 out of 4 personal loans are coming from NBFCs.
The financial landscape has changed in the last 15 years. I think the data will come up.
You said it last week, right? The branch is not a moat.
No, exactly. The branch, that is still done now. It's over. But the amount of NBFCs which have gone up in the last 15 years from 30 to 130, that's the kind of, landscape has changed. So,
and also, if you look at NBFCs, right? 10 years back, maybe 15 years back, 10 years back even, most NBFCs were like single segment NBFCs, right?
Absolutely.
There was Shriram Transport doing truck financing, Shriram City Union, which did, other kinds of loans. There was Chola. There was
only doing gold.
There were sector champions, sector specicialists. Now everyone is doing everything. Everybody's
like
chasing
all of
gold
us.
loans. Everybody's chasing,
much like all of us.
I would just add to this, PSU versus private debate. I think even COVID, you brought up the AQR, and that cleaned up this corporate banking stress for the system as a whole. And I think following that, the COVID period, I think it brought some sort of leveling across these two banks. I mean, for instance, if you look at it, private banks, during that phase, very focused on retail banking, heavily focused on retail banking. Of course, there were niche banks like IDFC, etc., that were looking at corporate. And for public sector banks, the advantage, to my belief, has also been a wider base, so to speak. So when we saw that cycle of unsecured stress, for instance, playing out, the MSME stress playing out, private banks were, disproportionately hit. And that's why you're seeing some leveling coming in there. And while you say the branch banking method is probably dead, I disagree. I mean, the fact that public sector banks have this wide reach into every nook and corner of the country, the private banks today cannot really compete with fintech or no fintech, reach. That's helping in the CASA mobilization story. So the deposit competition is very much alive in the system. Feet on street, all of that is also making the case for these PSU banks come back. And of course, the pressure on margins.
That's where I want to take the conversation, Ritu. And that's an important point. That's where I want to take the conversation that, as we see this talent churn, as we see this leadership change taking place at India's private sector banks, what will the leadership challenge really be? What will they need to prioritize? We've talked about the competitive landscape changing. We've talked about the rise of NBFCs, the emergence and dominance now of fintechs and so on and so forth, the fight for deposits, the financialization as far as, assets are concerned. What will the priorities need to be as these new leaders get down to business?
Well, exactly as Uday Kotak said, right? The days of lazy banking are over. It's not going to be that branch strategy and the deposit strategy alone that's going to get them there. I mean, look at payments, for example. That's been completely taken away from banks. I mean, not only do they lag behind, I mean, it's been cornered by players like PhonePe, like GPay, like Paytm. I mean, banks are nowhere in the picture in the top UPI players and the top payment players. So, the days of lazy banking, yes, they're over. And I think technology, that's the biggest moat is, people like KV Kamath have repeatedly ad nauseum been saying, if you're not going to innovate with the times, I mean, you can forget about being the stars of the yesteryears. So, I think the expectation of these new CEOs is very much changed. And that also gets us to the point of how, the kind of transition we're seeing in what was the face of banking. I mean, for almost 20 years, if you look at it, from the HDFC banking giants, Aditya Puri, Deepak Parekh, your Uday Kotak at Kotak Mahindra Bank, Chanda Kochar at ICICI Bank, then Sandeep Bakshi later, Shikhar Sharma at Axis Bank. I mean, there was very little movement for, more than a decade or so. And now almost every large bank is looking at changing leadership, suddenly. Kotak Mahindra Bank, that's one we're talking about in the midst of that CEO churn. Axis Bank, Amitabh Chaudhary's term ends in December 2027. IDFC First Bank, B. Vaidyanathan, again, his current term will end in December 2027. ICICI Bank, Sandeep Bakshi goes away in 2028. And of course, Sashidhar Jagdishan, he's up for renewal in October. So all of them face CEO renewal discussions. And, PSU banks have always had to deal with this challenge, of very short 3-year, 4-year CEO tenures. But for private banks, I think this is unprecedented churn. So, for 2 decades, you had this sector defined by these iconic founders and iconic banks, the Puris and the Kotaks of the world. But, I think a Big Four story has moved on. I think Lata very beautifully, just to wrap this, captured it beautifully in her piece. She said these HDFCs, Kotaks and Axis, they're seeing their dominance dilute because performance, because governance issues and succession, all of that is weighing on valuations. And increasingly in brokerage notes, as Nimesh will also point out, you're seeing, these new names emerge. Federal, RBL, CSB. These are the next winners. These are the names that Dalal Street is looking at and betting on as favorites.
No, just to add to what Ritu is saying, Shireen, the other thing
and just before you come in, Nimesh, I think that point is often underappreciated. The fact that at public sector banks, like all government organizations, you have a leadership change every 3 or 4 years. So it's inbuilt into your DNA, and there is no one person who kind of becomes the glue that holds everything together. You have the system learns to move on, and perhaps that has been the advantage and the disadvantage, both as far as the public sector is concerned, but clearly as far as the private sector, across sectors, not just banking, but succession has been a challenge, for Indian corporates, Indian corporations, and that seems to be playing out even as far as the private banking story is concerned. Yes, wrap-up comments from each of you. Nimesh, I'll start with you.
Shireen, the other point which we haven't discussed, but that's going to be a big challenge, is the fact that in the last 1 year, we've seen massive FDI inflows into the Indian financial sector. Now, RBL is sitting on, Etihad is sitting on RBL Bank, basically Emirates. There is, Shriram Finance sitting on $4.4 billion of FDI capital. And that's going to be another challenge for the private banks, right? So, again, my point is, when we look at it from a market perspective, forget those days of four times price to book for HDFC Bank, 9 times price to book for Bajaj Finance. Those days are over. That's history now. At best, what they can do is from 1 to 1.3, they can go to 2x or 2.5 times price to book. So that is something which investors have to keep in mind, that those glory days of 4x, 5x price to book is done with. And there's going to be massive competition in the financial sector from here on.
Shireen, I was talking to one of the entities which got money off the thing. And I said, well, you've got money. And there was one leg of re-rating which happened. I said, what next? He said, ab bada mushkil hai yahan se. Ab time lagega. Because, and the basic reason was, they said, bahut competition hai. So it's not going to be easy.
It's not going to be easy. Look at the landscape now. The entire landscape has changed so much. I mean, there are so much of listed entities, small finance bank, NBFCs, housing finance companies, fintech companies.
Yeah.
There's so much of choice. Investors are spoiled for choice now in the financial space, Shireen.
But
one more googly.
That's what separates. That's what separates the winners, right? When it's never easy, to actually get going, I think that's what separates the winners. Yeah, you were saying, Prashant?
No, I was just on a lighter note. Ritu was listing all the names, right, from the yesteryears, and of course, they're all active now. But I remember this is. A friend who's now pretty senior at one of the banks, he once told me long back, he said, bank CEO should be the banks which do well, you will notice the CEOs are always Punjabi. So I asked him why. No doubt he was a Punjabi himself. So he said, you need that aggression. You need to go out in the market, sell. Of course, he was talking to South Indians, so I took that point.
But that is the problem that a lot of people are also citing, right? Like bringing these bureaucrats on board one by one. I mean, there's nothing. I personally don't think anything wrong with it, except that they will probably ask for 3 Xerox copies of everything. Beyond that, I think but there is one problem in the message that it is sending, that there is enough room for subjective sort of, interpretation of the regulations, so much so that only a person who has the contacts and the context can navigate this, right? Somebody cannot grow into that position and be able to navigate the regulations. I think that's not a great message to send, because if bank after bank is hiring a bureaucrat, a former bureaucrat, I think that's not a great message to send. We need to have more transparent, regulations. And second thing that Ritu also hinted at, right, the CFO nomination, the hirings, right, trying to hire from everywhere else. We really need this. Grooming should be a part of it, because you need to have, I think, Sridharan, banking veteran.
I'll just tell you one thing, Shriyam. In HDFC Bank's case, right, it's not as if this is not a new. By the way, the current the new chairman was a financial services.
No, I agree. What I'm saying is,
in his early years, it had Shamala Gopinath as.
But like we have been discussing, the landscape is changing so fast. You have your Jupiter and your FI money, etc., coming out with products which like absolutely reimagining the finance as an industry. At that point, like I said, we can avoid with 3 Xerox copies for everything.
No, and I think that links back to the point, the first point that Ritu made, that you may perhaps have to look at talent very differently as this landscape changes. I mean, and I go back to that point that Uday Kotak was making. He said, look, why should you consider only banks as your competition? Why do you not consider an Apple Pay or a Phone Pay or a Google Pay equally as your competitor, as your competition? So perhaps we need to change the lens, and maybe that, the point about regulation, etc., comes in there as well, and maybe get people who are not necessarily bankers, to play with this ecosystem as well and be a part of this ecosystem as well. But all of that is up for discussion and debate. But I can tell you, the last 24 hours, it felt like fast and furious. There was breaking news. There was plenty of changes that we had to deal with. All of that in real time, and I'm glad that we broke it first, courtesy Ritu here on
back to our own.
Yeah, I know.
And of course, you heard,
We all should be back.
Yeah, actually, let's do that. Let's go back to our places. Yeah.
And okay, fine. They're swapping, places.
We will see you next week from these
started
positions.
with musical chairs. We'll end with musical chairs. No musical chairs on CNBC TV 18. We're all pretty much still here and have been for many, many years. But for all of us, for now, thanks very much for watching. Stay tuned. Join us again on another episode of Editor's Playbook. We'll see you then. Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening: a big talent churn across India's private banks. HDFC Bank names former Finance Secretary and former Chief Election Commissioner Rajiv Kumar as the new part-time chairman. A decision on extending the tenure of CEO Shashidhar Jagdishan is next on the agenda. Axis Bank's losses, HDFC Bank's gain. Puneet Sharma appointed the new CFO from October. Bandhan Bank CFO Rajiv Mantri set to fill the vacant CFO slot at Axis Bank. The Sensex and the Nifty end in the red after a volatile session. The Nifty down more than 8% in the first half of 2026, despite gaining 7% in the April to June quarter. Negotiators from US and Iran head to Doha amidst uncertainty over a potential meeting. Iran says officials are going to Doha to seek frozen funds and not to negotiate with US officials. Crude oil prices remain largely steady. US Ambassador to India Sergio Gore continues to maintain that a trade deal is in the final steps. Says US Secretary of State Marco Rubio has invited Prime Minister Modi to visit Washington. The invitation was given during the G20 summit in the US this December. The CEO of Persistent defends the $1.4 billion deal with German firm Nagaro. He expects the deal to be EPS accretive from the first year as it provides a footprint in West Asia and Japan. Says Persistent will be the best growth company in the sector. The government clears an outlay of 1.25 lakh crore rupees for the next leg of the semiconductor mission. Sources say the mission will be geared towards creating the entire stack from design and fabrication to packaging. Insurance companies should consider going public only if they need capital, says the IRDA chairman Ajay Seth. Adds he does not want companies to list for transparency. He also calls for linking the remuneration of top insurance executives to product claims and grievance redressal. Dheeraj Seth takes charge as the new chief of the Army Staff. General Seth holds the rare distinction of leading 2 operational army commands along the Western Front. The new global CEO of WhatsApp, Kunal Shah, makes his first move, introduces usernames to allow people to chat without sharing their phone numbers. The move sparks concerns over a potential rise in impersonation scams. The suspected data theft at Tata Electronics worries Apple. Details about the iPhone 18, including the list of suppliers, parts and device photos, likely to get exposed on the dark web. It's been a night of upsets at the Football World Cup. Germany and Netherlands knocked out in penalty shootouts by Paraguay and Morocco. Brazil keeps its hopes alive after scoring a late winner against Japan. Well, let's start with the day's market action. The Sensex and the Nifty closed in the red after a volatile session. The Nifty has dropped more than 8% in the first half of 2026, and that is despite gaining 7% in the first quarter of this fiscal year. Mid-caps have outperformed, and the Nifty IT has emerged as the top losing sectoral index, all on account of the AI phenomena. It's closed lower for the third straight session. That's the Nifty down today by about 80 points, 250 on the Sensex. The Nifty IT index 730 points lower. Mid-caps closing in the green. Hormuz is here with the markets report card for the first 6 months of 2026. Doesn't look very flattering, does it, Hormuz?
Well, on the index level, it's a pretty forgettable first half of 2026. At the start of the year, we saw a record high, and within a couple of months, we ended up seeing a low for the year as well. 26,373 on the 5th of January, and then in April, we ended up going down all the way to 22,182, and now we are struggling to where we are right now within this very narrow range. So an 8.5% downtick on the Nifty over the first 6 months of 2026. We'll take a look at the historical trend as well, right? I'm looking at the last 10 years because it's the last decade that the Nifty has delivered positive returns every single year. This 2017 was one year when the first half and the second half both saw double-digit returns. You take a look at the 2020 period as well. There's the first half of the COVID period when the index was down and then saw a very sharp rebound as well. In general, the second half here has been better than the first half, but then you can't necessarily say that over the last 3 years when the first half has generally been a better one in comparison to the second half, starting 2023 onwards. So no definitive directional trend that the market takes either in the first half or on the second half of a calendar year. But if you take a look at the best performers or the worst performers actually, take a look at IT, no surprises for guessing here, no prizes for guessing. Look at Infosys down 37% in 2008. In the first half of the year, it's down 38%. So it's a decline more than what it did during the global financial crisis. ITC is down 28.5% so far in the first half of the year. Never before in the last 3 decades it has declined to such an extent. HDFC Bank, this is the third worst year that the stock has had in the last 3 decades. Now, if you take a look at the price performance as well, it's down 19% in the first half of this year. The last time the stock fell double digits was in 2008, and before that, it was all the way back in 1998. You look at the broader markets, and Hitachi Energy is the best performer on the midcap index, and every single year of it being a public company, it has delivered positive returns. It's up 90% this year in the first half as well. We just spoke about KPIT a few minutes back, and it is the third straight year when the stock has delivered negative returns, already down 42% in the first half of the year. The one stock that stands out though is BHEL. Between 2010 and 2020, only 2 years of positive returns, and now 6 straight years of positive returns. The first half of this calendar year as well, the stock is up 45%.
All right, Hormuz, thanks for wrapping up the first half of 2026 for our stock markets. But the top story this evening, banking. HDFC Bank has named former Finance Secretary and former Chief Election Commissioner of India, Rajiv Kumar, as the new part-time chairman. Ritu joins us now with more details. Ritu, after Tanu Chakrabarti, the former Chief Election Commissioner, the former Banking Secretary, Rajiv Kumar, it is at HDFC Bank.
Well, yes, big leadership moves at HDFC Bank overnight, and one that hopefully closes the chapter on months of governance overhang. Now, HDFC Bank has named former Finance Secretary and the ex-Chief Election Commissioner Rajiv Kumar as the new part-time chairman for a 3-year period, and this will be subject to RBI's approval. He has also been appointed an additional independent director on the board, and shareholders will vote on his appointment at the AGM on the 5th of August. Now, importantly, with the chairman's appointment in place and that clean chit, if you remember from the external legal review on the allegations that were made by the former chairman, Tanu Chakrabarti, some of that governance overhang on the HDFC Bank stock hopefully goes away, and importantly, it clears the path for the reappointment of CEO Sashidhar Jagdishan, which is expected to be taken up next in the coming days, as we've been reporting right here on CNBC TV 18. Now, it is an interesting choice by HDFC Bank opting once again for a seasoned bureaucrat as its chairman rather than someone from banking or the corporate world, as many in the market had anticipated. Also, Rajiv Kumar, by the way, and Tanu Chakrabarti were contemporaries in the finance ministry as well, both serving in senior roles around the same period. Rajiv Kumar was the finance secretary, Tanu Chakrabarti at the same time was the economic affairs secretary. So a very interesting choice indeed. And now, of course, for the CEO reappointment, which still remains.
Yes, and we'll get to that in a second. But Ritu, don't go anywhere. There's a lot more to discuss. It's also a leadership shuffle unfolding across India's banking sector, with CFO changes triggering a chain reaction across private lenders, from HDFC Bank to Axis to Bandhan. A 3-way rotation is now taking shape in top finance roles. Ritu, take us through who moves where and who's the gainer.
Well, a merry-go-round or musical chairs, call it what you will, but a whole lot of moves in India's top private banks. We told you first right here on CNBC TV 18, and it is now official. HDFC Bank has now appointed Axis Bank's outgoing CFO, Puneet Sharma, as its new Chief Financial Officer. Now, Puneet Sharma has been with Axis Bank as its CFO since 2020, before which he was also the Group CFO at Tata Capital, so brings plenty experience, and he will now become the CFO designate at HDFC Bank first from September, and then officially take on the full-time role as the CFO from December after the incumbent HDFC Bank CFO Srinivasan Vaidyanathan retires sometime in October. So the question now is, who replaces him at Axis Bank then? And our sources indicate that Bandhan Bank's outgoing CFO Rajiv Mantri, who also, by the way, announced his resignation at the bank just yesterday and brings more than 25 years of experience across Bandhan, Citi, Standard Chartered, etc., is all set to join Axis Bank as its new CFO to replace Puneet Sharma, who, of course, in turn is going to be heading to HDFC Bank, completing this 3-bank CFO reshuffle, with now Bandhan Bank left to hunt for a new CFO for itself.
All right, Ritu, many thanks. Well, let's move away from banking now. Let's talk about the big deal in the IT space. The CEO of Persistent has defended the $1.4 billion deal with German firm Nagarro. Speaking to CNBC TV 18, Sandeep Kalra said he expects the deal to be EPS accretive from the first year, as it provides a footprint in West Asia and Japan. He also said the company will be the best growth company in the sector. Take a look.
This is not a scale-led acquisition. This is not about consolidating revenues. This is a strategic acquisition. This combination gives us truly a global footprint. Persistent does not have a Japan footprint. And obviously within Europe, we are not present in countries at scale like Germany, Switzerland, France, Italy, even places like Turkey, which is closer to MENA and so on. So this is a good acquisition from a geographic diversification. Significant confidence is we can bring the growth of a Persistent over the next 1 to 2 years to the combined entity. Obviously, we have to pass the regulatory hurdles, come together and start executing.
Well, that's Persistent on the Nagarro acquisition. The government has cleared an outlay of 1.25 lakh crore rupees for the next leg of the semiconductor mission. Sources tell CNBC TV18 the mission will be geared towards creating the entire stack from design and fabrication to packaging. Ashmit is here with the details. Ashmit.
Well, a big development this coming in for India and its semiconductor aspirations. We're given to understand that an outlay has been approved by the Finance Ministry for phase 2 of the India Semiconductor Mission. Now, we're given to understand that the Expenditure Finance Committee, or the EFC as it's commonly called, held a meeting last week. And in that meeting, they approved an outlay for the draft ISM 2.0 that had been submitted by METI. The outlay that we're picking up that has been approved is 1.25 lakh crore rupees. Now, this is a massive jump for India, for its semiconductor aspirations. Bear in mind, for phase 1, the outlay that had been approved and then also approved by the cabinet was 76,000 crore rupees. This is nearly double that amount. This is 1.25 lakh crore rupees. The aspiration of the government is clear. It wants to go beyond just fabrication as well as ATMPs and OSATs. It wants to go and play as far as the entire ecosystem is concerned, including design, including fabrication, including packaging. So that's the whole ecosystem that ISM 2.0 will be targeting. What's also important to understand that this EFC approval is the penultimate step. The next logical step will be for preparing of a cabinet note and then seeking cabinet approval. So clearly, ISM 2.0 inching closer, taking one step closer to coming to seeing the day of light. An important step being taken, 1.25 lakh crore rupees being approved for the outlay.
All right, that is a big one. Thanks very much, Ashmit. And shares of Dixon Technology rose in trade after CNBC TV18 reported that the company's joint venture with Chinese company Vivo is getting closer to securing the centre's final nod. Sources tell us that the government is in the final stages of issuing an approval letter for the JV. This was cleared by an interministerial panel earlier this month. Switzerland-based Mediterranean shipping company group will acquire 49% stake in Vizhinjam International Seaport in Kerala for about 13,220 crore rupees. Adani Ports and Special Economic Zone has mentioned that the deal marks the largest foreign private investment in India's port infrastructure sector. The investment will be made through MSC's container terminal operating arm in India. President Trump has said that negotiators from Washington are heading to Qatar for talks with Iran. Speaking to reporters at the Oval Office, President Trump said the meeting could be, and I quote, perhaps important, perhaps not. We're going to find out. End of quote. This as Iranian officials rejected confirming that any technical talks will be held in Doha. Instead, they maintain that the consultations would be held with Qatari officials. But Qatari officials now confirming that talks will in fact take place in Doha. In the oil market, price of Brent crude remained largely stable. This is ship movement in the Strait of Hormuz remains constrained after Iran and Oman also said that the responsibility of demining the waterway rests with Tehran as per the MOU.
There'll be a meeting on that tomorrow in Doha, and to go into Qatar. I think they've already left, or they're just about getting ready to leave. So we'll see how that goes. But we're doing very well on that front. But the meeting in Doha is going to be perhaps important, perhaps not. We're going to find out. But we're winning militarily. It's almost won militarily, I would say. And it's really very simple. It's the denuclearization of Iran. We don't want them to have a nuclear weapon, and they're not going to have a nuclear weapon. And they've agreed to that, in all fairness.
Well, that's President Trump. And speaking of the U.S., American ambassador to India, Sergio Gore, continues to maintain that a trade deal between the two countries is in the final steps. Speaking at the U.S.-India Strategic Partnership Forum Leadership Summit in D.C., Gore added that the U.S. Secretary of State Marco Rubio has invited Prime Minister Modi to visit Washington during the G20 summit in the U.S. this December.
We had announced an interim trade deal. That trade deal we thought was done until the Supreme Court decided to have another way. And so we continue to pursue that, and we are very close. Just last week, U.S. Ambassador Greer visited us in New Delhi for 2 days, and we are hopefully in the final steps of this deal. Most of this deal is complete. There's a few items that remain from both sides, but it's in the last 1 or 2% of that deal. This is not one side or the other. This is a win-win situation where both sides can do incredible things and do take this relationship to the next level.
Well, that is the U.S. ambassador to India. Time for us to head into a break, but up next, the new global CEO of WhatsApp, Kunal Shah, makes his first move, introduces usernames to allow people to chat without sharing their phone numbers. More on that when we return. The parent company of Oyo has filed an updated draft red herring prospectus with the market regulator SEBI. The company is planning to raise more than 6,600 crore rupees, and 75% of the proceeds will be used to pay debt. The updated papers also show that 83% of Oyo's revenues come from international operations, and India accounts for just 12% of the total revenue. The US is the largest market for Oyo on account of the acquisition that they did. Now, the new global CEO of WhatsApp, Kunal Shah, has made his first move. WhatsApp has introduced usernames to allow people to chat without sharing their phone numbers. Meanwhile, the suspected data theft at Tata Electronics has worried Apple. Rachna joins us now with more on what's brewing in the tech space today. Rachna.
For 16 years, identity on WhatsApp meant one thing, a phone number. To add someone, message them, add them in a group, the number was the key. That is now changing. Now, WhatsApp has started rolling out usernames, a unique handle like how we see on Instagram that lets people connect and message without the phone number ever showing. Username could be from 3 to 35 characters, lowercase letters, numbers, full stops, underscores, all of that. And once live, a first-time contact will only see the handle. The number will stay hidden, locked to the account for login and verification, but no longer the thing handed out to strangers. Now, unlike Instagram, there will be no directory to scroll through, no suggested profiles. To reach one will have to know their exact username. There's even an optional second lock, a key which will be a 4-digit code which a new contact must enter before sending that first message. Reservations for usernames have opened. The handle name can be reserved now by updating the app. The feature will be live in a few months. Kunal Shah, the new CEO of WhatsApp on X, said that he has joined the company early to reserve his username. The other update is a serious one. Apple is concerned, and when a company that guards its secrets as tightly as Apple does, and when they use that word, it means it is serious. Now, the company is concerned over data breach at Tata Electronics, a company that is one of Apple's most important manufacturing partners. According to Reuters, at least 6 files are now circulating on the dark web. These are specific iPhone 18 Pro components list, model sketches, and their component suppliers. The kind of info Apple guards tightly and has never disclosed publicly for other models as well. But it is not just the design leak that has Apple worried. It's the details of the supply chain. And this data sits inside a cache of more than 200,000 files, around 630 gigabytes, dumped by a ransomware group called World Leaks. Tata has confirmed the incident, restricted access to sensitive systems, and brought in a global consultant for a forensic audit. Now, data from other companies, including Tesla, is also said to be part of this data breach. But this is not the first time a Tata company is dealing with a breach. It was only a few months ago that we saw JLR go through a similar leak, because of which production was halted for almost 6 weeks. So the impact of this data breach, we will have to see when it happens. But right now, Apple is quite worried about it.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. We're back in a minute. Stay tuned.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. The month of June has been negative for commodities. Markets have priced in a 60% probability of a US Fed rate hike by September and an 80% probability of a rate hike by December. The dollar index has also risen to a near 14-month highs, and tensions in West Asia have eased, putting further pressure on prices of commodities, especially gold and silver. The gold prices have witnessed a double-digit decline in the month of June. They're down 6.5% so far in this year and 14% down for the quarter. The silver prices, in the meanwhile, are at the lowest level since December 2025, after witnessing a decline of about 20% in June alone. Palladium and platinum also are facing a sell-off. Palladium prices have declined by 12% in a month, while platinum is down 18% in a similar period. We are now joined by Shailesh Sanghani. He's founder and MD at Priority Jewels. Thank you, Mr. Sanghani, for joining us. First of all, what is your sense on the gold prices? The kind of decline that we have seen for the Indian markets, it is 50,000 rupees off its all-time highs that we saw in the month of January. How are you looking at prices and the impact that it has had, if at all, on buying?
Thank you, Manisha. Thank you for having me on your show. My answer would be that yes, it is declined quite a bit in the international market as well as the Indian market, and I am actually seeing further decline also than this currently, because the dollar index is going higher, and the demand, the basic demand for gold is still not picking up. So I am seeing that gold consumption is reducing. Plus, overall, the situation in the Middle East is also not improving. I mean, it's one day on, one day off, one day on, one day off, which is not helping the gold price so much.
Mr. Sanghani, you said there's further decline anticipated in case of prices. How are you looking at the demand trends? What would you say on how June has been, or how has been the first quarter of this financial year in sense of volumes? Would you say there's a considerable decline to the tune of 20-30%? How are you looking at it?
For June, for the month of June, yes, for sure, that there has been a decline. It's a vacation month. Normally, every year, June is supposed to be a slow month. So year and year, if you see, June are supposed to be quiet. School vacations, college vacations, but this June particularly has been extra quiet. We had our Prime Minister come in and request people to buy less gold or no gold, and plus the duties went up, so all of a sudden there was a gold price hike over there. So putting all that factors together, the demand has reduced quite a bit. So we had an extra slow June this year, you can put it that way.
All right, an extra slow June, but how are you getting into July now? The new quarter, does it promise demand and participation come back?
July is also not going to be a very bright month. Still, people are coming back from vacation. Schools will reopen now, so it's back to school. All those kind of things will happen. But I see a positive year going forward. August, September, I am seeing good months. We have a big IIJS coming up in August, and I am expecting IIJS, which is our kind of the biggest show that happens in India, and that I'm expecting to be a great show this year. The retailers have been off the market for quite some time, so there is going to be a good buying which is expected from the retailers, and that will pick up the season.
Mr. Sanghani, how is the exchange market? Is a lot of old gold coming in for new? That's one as a part of my question. And the second is, are you then focusing on lower caratages or lower weights going forward? Is that going to be the new norm?
Yes, that is going to be the new norm. As you know, that BIS has allowed now 9-carat gold to be sold in India. So there is a good demand for 9-carat gold, not only in diamond jewelry, but also in plain gold jewelry. In plain gold, there is good consumption in Bengal side, West Bengal, and there's also good consumption in the north side, North India also. People are accepting 9-carat gold easily. And also for diamond jewelry, small product, gifting product category is working quite well as far as 9-carat is concerned.
And how would you look at the exchange market? Do you see that picking up and sustaining on the higher levels?
Sorry, I didn't get your question.
The exchange market, are you looking at people coming back?
Yes, exchange market is working very well. Currently, I think the numbers should tell you that India has not imported so much gold over the last month. So most of the gold which is coming or whatever jewelry is being made currently is all with the exchange gold only. So consumer is coming with their old gold and exchanging it for new gold. Lot of jewelers are offering also that bring in your old gold, will give you the best price, or they have some or other schemes asking people to bring in their old gold for new gold. So all those things are happening, and consumers are getting into that. So consumers are not demanding actually new gold, but people are coming in with their old gold and buying.
Mr. Senghani's final question then, what are your plans going forward from here? I mean, I've had the opportunity to look at your designs and your jewelry as well.
Yes.
Very innovative, very design themed there. Well, how are you stepping into August, September and October, the time that you have festivals, wedding season, and then you'll of course have Dhanteras and Diwali and extending there?
So, Manisha, we at Priority Jewels, we have always been in the day-to-day market. We have always been in the jewelry for youngsters, for teenagers. So we keep on developing new things for them. And I think this year the theme is going to be more on color stones and lightweight jewelry with color stones in it. So it becomes very price point product, and also it makes it look large. So that is going to be this year's mantra. And I think already we are seeing a lot of lot of ordering and lot of PD work, product development work is happening towards that. The chain stores are already in action for the coming up season. So we are developing a lot of new things for the chain stores. And what we are seeing, the trend, that way what is happening is this is the new trend which is going to come in.
All right. Mr. Senghani, thank you so much for joining. It's always a pleasure speaking to you. So that really is the new trend going forward. It is going to be uncertain, especially in case of July as well. But moving forward from there, because of exhibitions and festivals and wedding, there is a pickup expected. Exchange continues to be a bigger part. And then, of course, it is going to be about lower caratages, colored gems and lighter jewelries. With that, let's move on. And joining us now is Gautam Choksi. He's Executive Director at Hindustan Platinum. Thank you, Mr. Choksi, for joining in. While, of course, Mr. Senghani pointed to the fact that the imports have kind of declined into the markets there, how has that impacted a premier domestic refinery like yours?
Yeah, thanks for having me, Manisha. So I think, our focus has not been on gold, but rather silver and the PGMs. And although we don't rely too much on imports, certainly I think the effect of, the restriction on silver bars being imported in June imports have practically dried up, which have driven domestic premiums as high as $5 to $6, right, an ounce. And you can see this in, reflected in the prices on MCX. So this is certainly causing a major effect in the market right now. We understand that a lot of, banks and even importers have applied to DGFT but are awaiting licenses. So till that is not done, I think silver imports are, on hold.
Oh, yes,
there is pent-up demand here. So, at lower prices, it seems that, the premiums in the market say it all, right? So, but on the industrial side, I think there is...
Gautam, let me interject on that. As you said, that there is
what industry wants is stable prices, right? They don't want, $120 an ounce and then back to, $60 an ounce. It doesn't help. So stability in prices helps companies plan their supply chains and their products for the next few years.
Mr. Choksi, I wanted to know, as you said, there's a 5 to 6% of a premium right now.
Losing your audio, Manisha. Sorry.
As you said, there's a 5 to 6% of a premium right now into the markets, and this is not even a strong demand period. Gautam, can you hear me now?
Yeah, I can now. Sorry.
All right. So, Gautam, I was asking, as you said, there's 5 to 6% of a premium right now into the markets, and this is not even a strong demand period. As we get into August and September, and if the licenses from DGFT do not come and the import concerns continue the same way, what kind of premium are we looking at then at that point in time in August and September?
Sorry, Manisha, that was $5 to $6 an ounce. That's already 10% premium. We could have had much higher. We could have had much higher. Just one data point, right? In June itself, MCX stocks, the stocks that MCX has in their warehouse, the beginning of June, it was about 280 tons. And enough yesterday, we're already down to 195 tons, right? It's not going to take too long if this continues for the stocks at the exchange to get depleted completely, right? So would be a cause for concern unless imports start.
I understand, Gautam, that you not recently, but sometime back, you announced plans to scale up import with the kind of logistical bottlenecks that have been there. What is the capacity? What is the kind of investments that you're now working with?
So currently, we're already refining, but our focus has always been on the industrial side. So while we're catering to customers from all over the world, most of the business that we do is, toll refining, whereby we're refining material and we're bound to give the metal back to the customer. So that metal doesn't stay in India. So that doesn't help the current situation from supply side from India. But yes, being a good delivery refiner and, MCX also launching their new 100-gram contract, it's encouraging smaller investors to participate and invest in silver. The success of it will be seen, but I think their first delivery is, their contract's expiring today, if I'm not mistaken. So yeah, I think overall, we're supporting there. We do make deliveries on the exchange as and when there is excess metal available.
Gautam, you also have a strong global footprint. How are the geopolitical shifts impacting that?
Certainly the uncertainty, and the whole dollar strength, right? I think rate cuts were expected earlier this year, and now we're talking of rate hikes. This doesn't, augur well for precious metals, which are largely, non-yielding assets. So what we've seen is, platinum, for example, down from a January high of $2,900 down to about $1,600 today, and palladium down from about $2,000 to $1,250 today, right? So we've seen, at least on these two, on the pent-up demand side from industry, right, some demand coming in from the industrial side. You have to understand that industrial demand is quite not price sensitive, but it does, when prices reach sky high, they do hold back their purchases and push it back as far as possible. So we have seen some of that demand come in. But definitely on the jewelry side, the demand has been down sharply on the platinum jewelry.
I do know, Gautam, that you are into e-bullion as well. How have you seen the digital adoption into the Indian markets?
So it's picking up. It's, I think, post the Prime Minister's announcement, and even, because it's not a regulated industry, there are quite some concerns from SEBI, etc. But, as a company, as a responsible company, we have been trying to address those and, instill confidence that the metal is actually there in the vault. But I think regulation in the digital metal space will certainly help instill confidence in investors to put more money in precious metals, knowing that their metal and their money is safe. Right? So we have a long way to go there from the regulatory side.
Oh, absolutely. Gautam, since you are into silver and platinum and palladium as well, what business seems better than the other right now?
I think we don't have favorites. They all are our children. So I think, yeah, we're quite active in all of them. And silver seems to be the favor of the month right now, the favor of the year, on a refining side at least. I think a lot of the business that we do are with petrochemical companies, and with somewhat shipping routes opening up from the Middle East, we're seeing a steady flow of material coming from there.
A final question then, as you move ahead in 2026 with the first half of this year done, what really is that you are going back on the drawing board with? What are the strategies?
Steady product lines and looking to expand geographically as well, and just serve our customers more effectively. I think the price volatility and price fluctuation is something that they're not used to. Seeing silver come down from 4 lakhs to 2,20,000, 25,000 a kilo doesn't go well with industrial customers like it does with investors. But we are trying to hold our customers' hands through this.
Oh, absolutely. It's been a difficult time, uncertainties, and a very, very volatile markets therein in sense of precious metals as well. Gautam, as always, thank you so much for joining in and taking us through the business and, of course, the markets as well. On that note, it's a time for a short break, but don't go anywhere. We'll be discussing the outlook for diamonds. And this time around, Devansh Shah of Venus Jewels will be joining us on the other side of this break. Welcome back. You're with us on Commodity Champions. Let's shift focus on now to diamonds. In 2025, prices fell by an average 11.3%, but this year they seem to be stabilizing. To discuss the outlook, we are now joined by Devansh Shah, his partner at Venus Jewels. Devansh Shah, thank you so much for joining in. Let's talk about the prices now. And 2022 was a high year. 23, 24, 25. We didn't see prices gain. We did not see demand do a lot well as well. And there have been various factors to that. 26 seems to have started on a stronger note, would you say?
Yeah, thank you for having me. I think diamonds are the bright spot amongst all the commodities you're discussing today. Prices definitely have started going up. 2022 was a peak after seeing a lot of price increases over 2021 and 2022. So things now seem to be in a very stable mode, like you said. The leading categories of the higher sizes and the higher expensive diamonds have led the stability, probably a good growth there as well. And it's an aspirational product, so we expect whatever the most aspirational end of the product will do will be followed by the rest. Overall, of course, even the volume of sales have looking to do well, because in May the net exports are up 5% over last year. So even in terms of the volumes, the net exports against the imports have been doing very well this year as well.
When you talk about the Indian markets right now, how would you look at it as a product? Is it more about affordability, or do you think diamond is moving more as a luxury or as an aspirational brand?
I think luxury is what leads the way for diamonds, and rest of the smaller sizes follow in aspiration of the ultimate luxury. In India, diamond sales have been growing significantly well over the last 5 years. We are already seeing India now become the second largest consumer of diamonds worldwide, beating China last year. And this position already shows the power that the growth that the economy and the consumers' purchasing power and confidence has. And India now, having the tier 2 and tier 3 cities also becoming more well connected to the world, and having the same aspirations as the rest of the country, we're seeing a significant growth in diamond sales in those regions. Another way to look at it is, today in India, across the whole high-end luxury segment, diamonds are still only about high single-digit percentage, 9 to 10% of the overall luxury goods sales in India in the jewelry sales segment. So this shows that there's a lot of headroom for growth in the Indian segment, as and when consumers get more aware and used to seeing diamonds as a nice luxury to own. We are confident that India is still having lots of room to grow.
Absolutely. How are you looking at the overall demand right now? I understand that one is luxury, and there it's more about owning the diamond and not so much about the prices. But on the other side, with the gold prices gaining as much as compared to last year, is diamond the hero right now? Are people looking at lower caratages, lower weightages when it comes to gold within the diamond jewelry?
Yes, overall, we are seeing the proportion of diamond value, had taken a hit when diamond prices reduced over the last 2-3 years. But gradually, with gold becoming, more expensive in the fashion segment and the lower price bracket segments, definitely the diamond value is going up. There is a balance that in gold versus diamonds that is usually looked up to by most manufacturers, and the diamond component is definitely consistently increasing. Like you were mentioning earlier, lower caratages of 9 carat being allowed now in India. It brings the focus back to the diamond as the main component of the jewelry piece.
All right. So while the other commodities may not be doing so well in sense of diamond, in sense of jewelry, but diamond definitely seems to be pushing up right now. As Devansh says, luxury continues to do well. Affordability also seems to be picking up in tier 2 and tier 3 cities therein. Devansh, as always, thank you so much for joining in and taking us through, of course, that important market as well. And with that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello and welcome to this special. I am Ashmit Kumar. Now, Delhi is set to roll out its new electric vehicle policy from the 1st of July after receiving the cabinet approval. Now, the government has framed an ambitious roadmap to accelerate the capital's transition to clean mobility. The policy envisages a total investment of 15,000 crore rupees, with 7,000 crore rupees earmarked as purchase incentives for electric vehicles and another 8,000 crore rupees allocated towards expanding charging infrastructure and offering tax concessions. It also aims to set up over 30,000 charging points across the city. The government has set a target of electrifying 30% of Delhi's overall vehicle fleet by March 31st, 2030, with a phased roadmap that gradually moves away from fossil fuel-powered vehicles. As a part of this policy, only electric three-wheelers will be eligible for new registrations from January 1st of 2027. This will be followed by a bigger shift from April 1st, 2028, when the registration of new petrol and CNG two-wheelers will be discontinued. To boost the adoption, the policy also offers purchase incentives of up to 30,000 rupees for electric two-wheelers and up to 50,000 rupees for electric three-wheelers. During the first year of the policy, over the next 2 years, the incentive becomes lower. The policy also extends a full waiver of road tax and registration charges for private electric cars priced up to 30 lakh rupees, making EV ownership more affordable for consumers. However, there is no subsidy for hybrid vehicles. That's an important catch. That's not all. There's also an incentive if a person decides to scrap their old vehicle in order to switch to EVs. For four-wheelers, it is 1 lakh rupees. For three-wheelers, it is 25,000 rupees. And for two-wheelers, that's 10,000 rupees. With stronger incentives, tighter timelines, and significant investments in charging infrastructure, the Delhi government is betting on this policy to drive the next phase of EV adoption while tackling the air pollution crisis and reducing transport emissions in the national capital. Joining us now to help us decode this policy is with us Mr. Amit Bhatt, I beg your pardon. He's the India Managing Director of the International Council of Clean Transportation. We also have with us Mr. Saharsh Damani, the CEO of FADA. And also finally is with us Mr. Nitin Gupta, the CEO and co-founder of Tero. Thankful to all of our panelists for joining us. Mr. Damani, I want to get your response first. The situation that we find ourselves in, we've just heard from the Delhi government on this new EV policy. Very tight timelines what we're looking at. 2028 is, of course, by when we'll have a complete shift in terms of new registrations for two-wheelers as well as for three-wheelers. Tell us, from a preparedness standpoint, how ready are the dealers? They'll, of course, be at the front line of this transition. How ready are the dealers to make this pivot from ICE, from conventional engines to, of course, electric vehicles?
First of all, thank you and good evening to all of you and to all the viewers. I think dealers are ready for the transition and more importantly, they are willing to lead it. The automobile retail industry has, successfully adopted to every major technological shift in the past, made with the BS emission norms or to the fuel injection, ABS, airbags, connected vehicle, and come what may. EVs are the next phase of that evolution. However, the preparedness is not just about the dealers, it is about the entire ecosystem. And, the dealers can invest in EV infrastructure, train technicians and educate customers. But they can only sell what the OEMs manufacture and allocate to the dealers, and especially the dealers of Delhi. If you see some numbers, Delhi sells nearly 50,000 two-wheelers and around 5,000 three-wheelers every month. And as the EV-only registration, timelines come into effect, this demand will, progressively shift towards electric mobility. So today, India retails around 1.7 lakh electric two-wheelers and about 70,000 electric three-wheelers every month. So Delhi alone, can require nearly 30% of the country's current electric two-wheelers volume and around 10% of the country's electric three-wheelers volume. And this is why production planning and Delhi-specific allocation becomes extremely important. From FADA's side, we are fully committed to supporting the government. We have already offered to facilitate around 150 electric vehicle chargers through our dealer network, and our members are continuously investing in technician training as well as the EV readiness. So I would say dealers are ready, and now the focus should be on ensuring that OEM's production, charging infrastructure, financing, and customer confidence grow in the step with the policy. And if all stakeholders move together, I'm confident that Delhi can set a benchmark for the EV adoption in the country.
Well, those are important levers that you're pointing out, Mr. Damani, as far as financing should be ready, charging infrastructure should be ready, as well as consumer confidence. But is it ready already? Let's also get Mr. Bhatt's perspective on that. Mr. Bhatt, even as we talk about making this transition, there are questions being asked. Is the charging infrastructure available? Do we have enough time? The first tranche of this timeline, of course, becomes effective 1st of January 2027. That's only a few months away now. Do we have enough time to gear up Delhi, the national capital, for this EV transition?
So thanks, Ashmit. I think one thing we have to understand.
We have a difficult line there with Mr. Bhatt. We'll try connecting with him again. Mr. Gupta, coming to you again, the very same question that many of us are asking is that even that we're looking at these timelines, 1st of Jan 2027, of course, when they start to become effective, the first tranche. Are we ready? Do we have enough charging infrastructure in the ready? From a battery standpoint, do we have enough capacity to cater to this demand? Since there will be no ICE registrations, only electric three-wheelers and two-wheelers going forward.
Thanks, Ashmit. And first of all, good evening to all the viewers as well. Ashmit, the important question to look at, or important perspective to look at here, is that it is an anti-air pollution measure. And as citizens of Delhi, we should be sort of applauding this policy. This is a step in the right direction. In my opinion, we are ready. And if the charging infrastructure or the battery manufacturing needs to ramp up, it needs to ramp up. It will ramp up. The second order effect of this policy is that it will give a lot of boost to the production capacity that will come up in battery manufacturing, and in proportion to the requirement of critical minerals in the country, like lithium carbonate, cobalt, required for making these batteries, which can again be recovered either by the recycling or refining output from mines, for which Atero is ready. We are ready for all the raw materials that are required to fulfill this policy and similar policies that will be rolled out in other cities in the country as well. And I believe it's a step in the right direction, Ashwin.
Sure. We have Mr. Bhatt back with us on the phone line. Mr. Bhatt, again, the question I want to ask is, again, the first tranche of this EV policy becomes effective with the 1st of Jan of the coming year, 2027. Do we have enough chargers, essentially, to complement this fleet of EVs that we're looking at going forward?
No, Ashmit, I think charging is definitely an important point, but I think it's also slightly misunderstood point. The reason I'm saying it is slightly misunderstood is that unlike a petrol, diesel, or CNG vehicle which has to go to the station for refueling, electric vehicles can also be charged at home. And in fact, if you look at the US data or even the Indian data from Indian OEMs, almost 85 to 90% charging happens at home. So the big question is two parts. Can we catalyze charging at home? And especially if you look at two-wheeler or three-wheeler, you just need something like a 16 ampere plug. So, and most of the housing societies have. So that's one part. The second part is when these vehicles go to intercity or regional travel, that's where we'll need charging, and especially on the highways. So I think two parts to the story can be done. One is how do we then accelerate charging at home, especially in RWAs and group housing societies where RWAs don't give permission. So we need some kind of a legal mandate to enable charging. And second is accelerate deployment of fast chargers, especially on the cities which are connected to Delhi, Chandigarh, Delhi, Jaipur, and some of the other high density places.
Just one follow-up question, Mr. Bhatt, that when we talk of building a charging infrastructure, what we're hearing from the Delhi government is that they're looking to deploy as many as 32,000 charging stations across the city. That's what the plan is. That's what there's an allocation for as far as 8,000 crores are concerned. Is that the approach to follow, to have these community chargers, or will that perhaps not succeed in respect to what we're actually looking at, the right to charge at home, like what you're indicating?
I think there are two parts to the charging puzzle, right? So, for example, if I am a resident of a group housing society and I have my parking, I would absolutely like to have charging at my parking. And so I need to empower the owners to set up charging. Second, if I am a tenant or I'm a visitor, I may not require a charging and I may require something like a community charging. Or even in localities where we don't have dedicated parking spaces, community charging can be the solution. So I think we have to look at the mixing of the solutions. So right to charge for having charging in your parking, community charging for people who are not residents, who are tenants or who are visitors, and then some public charging to facilitate long distance travel.
Sure. Mr. Bhatt, as well as all of our panelists, I'll request them to stay on with us. It's time now for slipping into a very short break, but we'll come back and we'll continue this conversation on the other side. Well, we have our focus on the Delhi EV policy, asking for commuters, for passengers, for people, for vehicle buyers to make the transition from ICE, that's your internal combustion engines, to electric vehicles. 1st of Jan 2027 is when it begins. That's the transition for three-wheelers. And then subsequently in 2028, we'll see a cutoff where no more ICE two-wheelers, only electric two-wheelers will be permitted. That's, of course, the Delhi EV policy, the way it's been floated. It's, of course, yet to be notified. We're discussing it with the help of our panelist, Mr. Amit Bhatt. He's the Managing Director, India, of the International Council of Clean Transportation. We also have with us Mr. Saharsh Damani, the CEO of FADA, and finally, Mr. Nitin Gupta, the CEO and co-founder of Tero. Mr. Damani, coming to you first, there are two issues I want to address. Firstly, we're yet to see the language of this policy, the wording of this policy. How important will it be to have some kind of protection, safeguard as far as domestic players are concerned, to ensure that there is some kind of cap or at least a restriction as far as imports are concerned, so that they don't take over the markets?
Yeah, so if we are also yet to read the fine prints of the policy right now, as you rightly said, it is yet to be notified by the Honorable LG. But on your first point, I think we should wait, as I already said, for the detailed notification, because operational guidelines and exact wording will determine how certain provisions are implemented on the ground. And as an industry body, we'll study the notification carefully and work with the government wherever implementation related feedback is required. On the second point, India's EV transition should certainly strengthen domestic manufacturing, no doubt about that. The country has already made significant investments through initiatives like Make in India and the PLI scheme, which has been rolled out by the central government. And we believe a strong domestic manufacturing ecosystem is in everyone's interest. At the same time, also, consumers should continue to have access to quality products, competitive technology, and adequate choice. But we should also keep this thing in mind that most of the electric vehicle components, still come from China. And it is very critical and very important for the Indian manufacturers that more and more products and more components, whatever they are importing right now, should be made in India, so that our reliability on the Chinese counterpart keeps coming down day by day or month by month.
Well, speaking of components, let's also get Mr. Gupta in on this conversation. Mr. Gupta, again, similar question to you. How important will it be for such policies, such mandates to have some kind of safeguard, some kind of protection from reckless imports?
Ashwin, overall, from a sort of a policy standpoint, like Mr. Damani said, it's important that the Indian manufacturers be given the right protection that is there. And domestic production is good for job creation in the country, is good from geopolitical perspective, that we're not dependent on China or any other single country from either a component perspective or a product perspective. But this needs to be balanced with making sure that the product quality in India is world class, right? So both of these need to go hand in hand. A complete protectionist policy is probably not the answer, but some sort of protections need to be built in there, Ashwin.
Sure. Mr. Bhatt, another aspect I want to get your thoughts on, and this is something we've been discussing in the newsroom as well, that as far as internal combustion engines are concerned, and between electric vehicles sit this segment of hybrid vehicles. No incentives have been provided for hybrid vehicles. That raised a few questions as to why not have a policy that perhaps deals with these vehicles in a staggered manner with respect to their level of emissions, and therefore have some kind of provisioning even for hybrid vehicles.
I think it's an important thing to understand what is an hybrid vehicle, because what we have in India is something called a petrol hybrid, and which is that these vehicles run on internal combustion engine. They use regenerative braking to charge the vehicle, to regenerate the vehicle, and then it is used for start and stop and go. And basically, most of these vehicles have batteries which is less than what electric two-wheelers have. On the other side, countries like Europe, US, and China have two different kinds of hybrid as well, which are plug-in hybrids and range extender hybrid. Both these vehicles can be charged, and theoretically, they can run on pure electric as well. So the Indian version of so-called strong hybrid is a petrol hybrid. It's a nice vehicle. It's not an electric vehicle. And therefore, I would give a lot of credit to Delhi government for removing that concession, because it was actually diverting the attention from electrification to intermittent technologies. Having said that, if the manufacturers come up with plug-in hybrids and range-extended hybrids, maybe that is something that could be looked at. But right now, the current set of hybrid vehicles in India are nothing but a slightly more efficient ICE vehicles.
Sure. Mr. Damani, coming to you for another perspective on a slightly different point. The issue that has been discussed and it has been talked about is that how two-wheelers are often, there's a certain strata of society in terms of their financial capability who would prefer to buy two-wheelers. What I want to ask is that where do we stand in terms of the cost of ownership of an EV as compared to an electric vehicle? For the first 3 years, of course, the Delhi EV policy envisions incentives. But as these incentives peter out in a staggered manner, where do we stand on the cost of ownership? What will it do for a certain segment of population when they're looking out to go buy two-wheelers for commuting, for their work, for gig workers, say, for example, who use it as a means of earning?
Yeah, that's a very important question because affordability will ultimately determine the pace of EV adoption in the country as well as in the state of Delhi. Today, in the entry-level two-wheeler segment, the upfront purchase price of an electric vehicle is still higher than that of a comparable petrol vehicle in many cases. However, the gap has been narrowing steadily because of increasing localization, better battery technology and higher production volume, which is ultimately bringing the cost of electric two-wheelers down almost on a weekly or a monthly basis whenever a new product is getting launched. With this policy, what this policy does is it makes that transition easier. Purchase incentives, scrappage benefits, and road tax and registration fee exemptions will reduce the initial cost of acquisition, while the lower running and maintenance cost of EVs will also improve the total cost of ownership over the life of the entire vehicle. At the same time, affordability is not just about price. It is also about easy financing, reliable charging, product availability, and customer confidence. And the dealers will, I think, play an extremely important role, in educating the customers on the overall economics of EV ownerships and not just the sticker price. As volumes increase and as OEMs scale up their productions, we expect EVs to become even more accessible for an average consumer compared to what an ICE vehicle costs today.
Sure. Mr. Bhatt, I'll come to you for a look at the road ahead. Delhi EV policy has taken a leap as far as the national capital is concerned. A two-part question for you. Do you see this being replicated? Are you privy to conversations in other big cities, other big municipalities, other big states as well to replicate this model of having some kind of EV mandates, one? And two, how far away are we from seeing such mandates even for passenger cars and vehicles?
Was this to me, Ashmit?
Yes, Mr. Bhatt, please go ahead.
No, absolutely. And I think so. A couple of things we have to understand that right now Delhi is dealing with an air pollution problem, which is a health emergency. And unlike farm fires or festivals, transport emissions happen all around here. In fact, a 2024 study that we did from ICCT, we found that the real world emission from the motor vehicles is much higher than lab values. And we also found that CNG vehicles are actually not clean because they have very high NOx emission, and which is a cause of concern for us. And therefore, there is no other option but to shift to zero tailpipe emission vehicle scenario. And therefore, the question is, how do we accelerate this transition? Subsidies are important, but subsidies can drive only to a limited level. We also have to move towards supply side regulation. We have seen from global evidence that countries that have accelerated electrification have also used supply side regulation, either having some kind of ZEV sales mandate, which California pioneered long back. London is doing it. Some of the European countries are doing it. Or we have more stringent fuel efficiency standards, which China is doing it, and Europe is also doing it. So I think the question larger is that if electric vehicles help address air pollution, improve public health, the onus of buying electric vehicles should not only be on the buyers. In fact, it should also be on the sellers. And this is what the ZEV sales mandate or phasing it out does. Because what manufacturers need is demand certainty. And once you give these policies that you will not register a conventional two-wheeler, then manufacturers are bound to come up with good products, increase production. It leads to competition, and which ultimately results to better quality products at lower price. And therefore, I think it's a welcome step. It's a game changer if implemented, and Delhi can be the lighthouse city for electrification for India, but also for the rest of the Asia as well.
Well, that's an interesting phraseology as far as Delhi is concerned, a lighthouse state. But I'd like to thank all of our panelists for joining us, Mr. Bhatt, Mr. Damani, Mr. Gupta, for joining us, sharing your perspective on what the road ahead may look like with the Delhi EV policy. But that's all the time that we have for on today's edition of Motown Centimeter. Thank you so much for watching. News and updates will continue right here on CNBC TV 18.
Welcome to Indianomics. The monsoon deficiency for the month of June is a whopping 42%. The total sown area for all major crops as of June 28th for cereals, pulses, oilseeds, all major crops is between 4 to 20% below the long-term average. The IMD has forecast good rains in the first half of July, but has also said that El Nino conditions are seen rising through August and September. So, are there chances of the monsoon getting more deficient than the 90% that the IMD has forecast so far? What will this mean to agri output, to food inflation, and more importantly, to rural prosperity? For all these questions, I have with me Dr. Ramesh Chand, former Niti Aayog member and currently distinguished professor at ICRIED. Also with me is another agri expert, Harish Damodaran, rural affairs and agriculture editor at the Indian Express. Gentlemen, good morning and thank you very much indeed for your time. Dr. Chand.
Good morning.
To start with you, sir, minus 42% for June, and area sown in terms of acreage is about a good 8% less for rice. For oil seeds, it is, a minus 19% compared to year ago levels or compared to the long-term average. Would you worry that this time the agri output can be badly hurt?
Yes, there is a concern, but first I would like to make a technical correction in the deficiency that we are looking.
Yeah.
You see, two things have combined. One is late arrival of monsoon, and second is less rain than what normally we expect. If I make allowance for late arrival of monsoon, then deficiency is about, say, 30%. It is not 40%. So that's why when we are comparing area, we should compare the net sown area of previous week with the current week.
Okay.
That is just one correction. But of course, the magnitude of deficiency, even if it is 30%, it is quite big. It is quite large. So even if subsequently rainfall is normal, the output in rain-fed area is going to be affected. This is what I can say as of now, that if in the future things are normal, then what is the effect? Then I would say that rain-fed area is still affected. Irrigated area may not be affected. But since we have this forecast that El Nino is going to affect rainfall in August, in July, so I think we should prepare ourselves to meet the contingency, to meet the eventuality. Just one more number for the your viewer I want to add, that if we look at the total rainfall, June we normally get about 18 rainfall. 18% is the share of June rainfall in the total rainfall. So 40% efficiency would mean you can just say in the overall 7%.
Okay.
So that is the kind of situation.
Because June is much less than other months, therefore it is more like a 7% is what you're saying.
Yeah. Overall, in the overall, if the rest is normal.
Got it. Harish, if you can add a little more color to what you are picking up from IMD and from your prior experiences of covering the country like no one else has, do you think we have to be prepared for more than 90%?
See, I think this June has been a shocker because this deficiency which we are talking, 42% or something, it is even without El Nino, because El Nino is still in what they call as a moderate phase. It's not yet strong or whatever, super strong or something. So even with a moderate El Nino, we have 42%. And plus, you must see how. First of all, it arrived in Kerala on June 4th, which was basically 3 days late. Then you had some initial progress. Okay, and then if you see, I think till 15th, I think the deficit was something like 32%. Then you had the monsoon made no progress at all between 15th and 21st. Okay, then there was some revival, your Bombay, Maharashtra and all gone. Now again, after 24th to 30th, the monsoon, whatever, the northern limit of the monsoon as they call, it's static, it has not been moving. So I think when we started off the season, what we thought was, June, July will be okay, and then El Nino's effect will kick in. So here we are seeing that even before El Nino has kicked in, we are seeing a deficient monsoon, and we have the prospect of, whatever strong and super strong and all, maybe from September onwards. And then we enter the Rabi seasons, and El Nino is not, it's not, the impact is not just, low rainfall. It also translates into warmer and shorter winters. So I would be more worried about the Rabi crop. I think Kharif will manage. Somehow we have enough stored this thing. And as I think Dr. Chand was saying, we have some irrigation cover. So I would be more worried about Rabi than Kharif right now.
Dr. Chan, what do you expect in terms of impact on specific crops? The output of rice, the area sown, as you pointed out, is less because it's -8% because it started late. But do you think we are going to end up with a much lower crop in terms of cereals, pulses and oilseeds? Oilseeds is -19% if you compare June end to June end of 2025. So which specific big crops would you be really worried about?
I will be worried about, say, soybean, because more than 95% area under soybean is rain-fed. As far as rice is concerned, you see, in case of rice, 3/4 area is under irrigation.
Yeah.
Last Sunday, I came back from Punjab and Haryana, I found all around the national highway, the rice transplantation is not less than the area covered last year.
Okay.
So rice is a 3/4 area irrigated. I think there the impact will be much lower. The biggest impact will be where we have more than 90% rain-fed area under individual crop, and there we have this soybean, even maize in Madhya Pradesh, irrigated area is only 4-5%. So we have pulses, we have millers, we have oilseeds, which will be worst affected, and that is the experience from the past also.
Okay.
That in the irrigated area, the impact is much less. Though impact is there, but it is much less.
Okay.
So I would say that oilseed, since soybean is our biggest oilseed,
yeah,
and in Kharif it is a dominant oilseed. So the other one is groundnut. So biggest impact I expect on soybean, then cotton, then in some state, then these nutri cereals,
okay,
they will be affected much more.
So would you worry about inflation, sir? Because ultimately cereals are the biggest weight in the CPI, and there we have good buffer stock. Oilseeds, edible oils is importable. We depend a great deal on imports anyways. So if you have to make an assessment on inflation, what would it be at this stage?
It looks like market is already factoring in this fact. In the case of rices, we have comfortable buffer stock, and even otherwise we produce 26% more rice than what we require. And if you look at yesterday's retail price and 1 year back retail price, rice is only about 5%. But the impact is visible in case of edible oils. There could be many reasons at international level also. So it's not that El Nino is affecting only India. Some other reasons are also going to be affected. This heat which we are witnessing.
So imported prices of edible oils are also likely to be higher, you're saying?
Can be. Yeah, can be. You see, for two reasons. One is, and we are seeing this so much heat in Europe, and sunflower is a major crop in Europe. We also import some sunflower oils. Like you see, it affects through so many channels. And also, since India is the biggest importer of edible oil in the world, so if there is domestic shortfall and market factor in, so price generally goes up.
Okay. I will come back to you for a more exact number, which you all may have calculated in a career, even if it is a floating number. But Harish Damodaran, the other reason why we want, rural, why we worry about monsoon is rural prosperity and rural consumption has been a big bulwark in terms of consumption for the Indian economy. In your perambulations in rural areas, would you worry that rural demand for, as a fuel for Indian economy may be less this year?
Last 2 years, in 2024-25 and 2025-26, we had excellent agricultural output.
That's right.
Both these were non-El Nino years. So if you see last year, I think we sold something like 11.6 lakh tractors. I think tractors are the best indicator of rural consumption demand and those kind of things. Whereas and plus you had relatively low food inflation also. So I think definitely if the rains aren't going to be good and more worryingly, if the temperatures during the winters are not going to be good, I think there will be a problem as far as rural demand is concerned. But overall, I mean, just adding to what Dr. Ramesh said, because see, not only India, the world over had very good the agricultural output both in 2024-25 and 2025-26. In fact, record production. So it is not just India, even world over. Whether you see rice, wheat, rapeseed, palm oil, everything. So we have entered this drought here, whatever. Like I think Dr. Ramesh was talking about. The high temperatures in Europe, and then of course now El Nino, which will also impact places like Indonesia and Malaysia. Our palm oil. So we have started this year with high stocks. And that is what is keeping our inflation low.
Okay, I want to tie down both of you to some exact numbers in terms of food inflation and likely impact on rural prosperity. Those questions after the break. Welcome back. The shortage, of the 42% shortage of the monsoon only for the month of June has been a matter of worry, and I have been speaking with two agriculture experts, Professor Ramesh Chand, distinguished professor at Eicher, and Harish Damodaran, the rural affairs editor at Indian Express. Gentlemen, thank you very much for your patience. Dr. Chand, now if I may tie you down to some numbers at Eicher, can you give us some idea of which crops and overall food inflation?
So among crops, as I said before, that the biggest hit will be for oilseed, mainly soybean. Soybean is our biggest oilseed crop in terms of quantity of output and area allocation, and less than 5% area is under irrigation. So I think soybean will take the worst hit. And since it is the biggest oilseed of India, and this is not something which we can meet through buffer stock, etc. It is entirely market driven. And there are already signals, as Harish also pointed out, that Indonesia thinking of diverting some palm oil for diesel, etc. Malaysia also affected, Europe also affected. So I'm seeing this signal already in retail prices of edible oils. So I think this high inflation in edible oil will be bad. This is one indication. Even if there is a serious shortfall in rice production, which I don't expect is going to be there, I don't think that will affect availability of rice in the country. We are not even able to export our surplus, and we are using large quantity of the rice which is procured by public agencies for making biofuel, etc. So I think in some way it may be a blessing in disguise if there is a less procurement. And as you know that any rice that is procured at MSP, we can't export it. So rather than this compulsion of the government that rice which cost you 46 rupee a kg, it is the market is not buying that even at 28 rupees a kg in OMSS. So big saving for exchequer, that kind of thing will be there. I see Harish is worried about Rabi. I think for two reasons that though rainfall matter for groundwater also, but Rabi crops, most of the area is under irrigation, particularly wheat. In Rabi, the concern may be about chickpea production because it is largely rain-fed and lentil, masur. They are the and then rapeseed mustard, though it is also now more than 60-70%.
I assume Harish's worry is that excess heat will impact yields. Is that right, Harish? Chances of yield being impacted is higher because of excess heat?
See, I think our last episode of high food inflation was, I think, from July 2023 to end 2024, right? I mean, almost, 1.5 years. So I don't see any reason why this time it won't be different.
No, Harish, okay, may I squeeze in another question? Harish, my bigger worry is with vegetables because they have a very visual impact. Somehow, rice and wheat, since the government has controlled for decades now, that has not been the main driver of inflation. But tomatoes at 100 rupees and onions at 100 rupees have usually visually led to the price-wage spiral. Would you worry that these short-duration crops can be the problem?
Right now, there's not much worry on those. I don't think we are paying hell of a lot for onion or potato or something.
Not now.
I think the impact of this will be only down the line.
Okay.
And as I said, the last if we go by the record of the last food inflation, the last episode, it was quite a painful episode. And we know what happened to FMCG companies and all, right?
Yeah.
I mean, I think we have to get prepared for that.
Okay.
There's and fine, we had 2 fantastic agriculture years, and now we get a bad year. I mean, and that is natural. I mean, there's nothing to be excessively worried. But I think food inflation will be there to stay, and probably it will call for very deft stocks management by the government, supply side management.
Okay, Dr. Chand, you already have with you the areas where the deficiency is very severe. Saurashtra minus 92. So even in fact, East Gujarat minus 72%. I'm giving you numbers from yesterday that IMD released as of, I think, June 29th. Then East Madhya Pradesh minus 67. Now, when you look at these kinds of numbers, Saurashtra, the oilseed growing region, and Chhattisgarh, Jharkhand, which specific crops, do you think there are any vegetables grown here? Even West Bengal is impacted. I think it's about minus 25% as of now. And that's one of the vegetable bowls of India. Do you think we should worry about a vegetable inflation?
We should be, because this El Nino effect is not localized. I was checking IMD data. 75% of the districts of this country have deficit to highly deficit rainfall. So the impact is across the country over larger geographies. It is not restricted. So, as I said, that the general rule of the thumb is that irrigated crops are affected less, and rain-fed crops are affected more. As far as vegetables are concerned, most of the area under vegetable is also irrigated. That is somewhat
of a consolation
factor. But vegetables are also very, very sensitive to short-term changes.
Yeah.
That's why in case of vegetable, volatility is more important than trend.
Okay.
That for some period, prices may shoot up.
Yeah.
See, it can happen.
Okay.
And already we are seeing that tomato and onion.
Sir, RBI has a 5.9% inflation forecast for the third quarter. That is October, November, December. It may overshoot, you think? I mean, they gave this forecast on June 5th. Now, 1 month into the monsoon, you think we have to prepare for something higher than that?
It looks like it will go a bit higher.
Okay, okay. Well, usually at 6%, RBI has to think of rate hikes, and that's why I'm asking you that number. Harish Damodharan, a final winding up from you. What would be your hierarchy of worries, briefly?
Number one, as I said, Ravi. Ravi is my major worry,
Okay.
And number two, I think the prospect of course, the El Nino worsening, and making things worse. But on the positive side, I'll say that the worries on fertilizers, etc., have reduced considerably. When I went just last week, I was in Haryana, Rajasthan, that belt. I mean, most farmers were saying that they are getting the fertilizers. Only I think DAP was in short supply, but instead of DAP, farmers were using NPKs, complexes, etc.
Okay.
So on the input side, I think there is no problem. If you had El Nino plus war, that would have been a perfect storm. So right now, there's no perfect storm. So right now, it's a very predictable. I mean, it is El Nino, and we know it's going to strengthen.
Fair
so I think there's enough time to plan.
Fair enough. Actually, Dr. Chand was on the channel after the war was 1 month in, and he assured us that the fertilizer situation is not as bad at all, and we were starting with a 6 million ton positive actually on urea. I remember those numbers, Dr. Chand. Very quickly, sir, your worry for the economy. Will it be rural prosperity, consumption? That will be the bigger worry. Will inflation? Just your hierarchy of worries.
I would say even for rural now, 2/3 economy is non-agricultural.
Okay.
So impact will be much more muted than but we see through a lens of agriculture. Because 2/3 income of rural people now come from non-agriculture. So there will be impact on rural economy, but impact will be much more muted than but appears from the deficit marks.
Fair enough, sir. Thank you very much indeed, Harish Damodaran and Dr. Chand, for allaying some of our worst fears and giving us a clearer picture of what we may be in for. The rest is, of course, with the rain gods. Thank you very much for joining us. The key takeaway, we should worry about oilseed inflation. We should worry about likely impact on Rabi crop. But rural prosperity itself, with only about 11-12% coming in from agriculture, perhaps rural areas will not be that much impacted in terms of their purchasing power. That's it on this edition of Indianomics. Thanks for watching.
What a video. I want to know who did that video so we could hire him at our embassy. I've been in India now 6 months, and we've seen some incredible things happen. As President Trump likes to say, we're results driven. And so we like to see things happen. We like to achieve things. I did not go to India to sit at receptions. I went over there to be able to increase this partnership that is so vitally important to both of our sides. In my first month there, we had announced an interim trade deal. That trade deal we thought was done until the Supreme Court decided to have another way. And so we continue to pursue that, and we are very close. Just last week, U.S. Ambassador Greer visited us in New Delhi for 2 days, and we are hopefully in the final steps of this deal. Most of this deal is complete. There's a few items that remain from both sides, but it's in the last 1 or 2% of that deal. And people ask me, why is this taking so long? We've been at this trade deal for 1.5 years. To put it into perspective, the European trade deal took 20 years. And so no matter what, as long as we beat the European deal, I think we're in good shape. But I'm determined to bring this to a close because this is a deal that is beneficial to both sides. This is not one side or the other. This is a win-win situation where both sides can do incredible things and do take this relationship to the next level. It's also a deal that, frankly, for a lot of individuals in this room, brings stability. For those of you that trade bilaterally, it's something that's incredibly useful and helpful. India was also invited and joined among the first 10 nations into Pax Silica. I understand you just heard from Jacob Hellberg, who was here a few minutes before I was. It's an incredible partnership. And Pax Silica comes down to one thing, and that is trust. The United States didn't just invite every single country in the world to join Pax Silica. We're inviting individuals that we trust, that we can work with, and that can continue working with us in the future. In the 6 months that I've been in India, I've seen the incredible potential. And that incredible potential is in every sector. There's not a day that goes by that a new item pops up for our two countries to work together. You name the sector, and the United States and India can work together and take it to an incredible height. So whether that's AI, technology, defense, it's unlimited potential, as I like to call it. And I aim to harvest that and to bring the two sides together. And it comes down to that win-win situation. The United States wants to work hand in hand with India. We care about this relationship. We have a president who deeply cares about this relationship. I was just with him before the weekend started here in DC, and I got to spend about 2 hours with the president. And he was captivated by what I have seen in India. He has very fond memories of India. His visit last time, it was one of his most remarkable visits that he continues to talk about. He holds India in a very fond place, that it's an incredible thing to have. And so I look forward to, at some point, as Al mentioned, having the president visit us back in India. One thing that I'm proud of is all the embassies compete. So you got your work cut out for you, Dave. But all the embassies compete to bring investment back into the United States. And you have these beautiful embassies in Europe, and they come up on stage and they say, we're proud to announce $500 million. We're proud to announce $700 million. Our embassy in New Delhi, this year, we were very proud to announce that we brought in $20.5 billion in new investments. And thank you. And that put us in first place by far. So it's an incredible, gratifying thing. Again, it comes down to trust. Not a week goes by where an American company comes to see me and they ask me, Ambassador, is it safe to invest in India? Will our IP be protected here? Or will the laws change next month? Is the tax system here safe? Or is someone going to come and shake us down in 6 months? And it's an incredibly gratifying thing to say that the United States trusts India, we work with India, and we look forward to identifying those next opportunities for both of our sides. Since I've gone there, we've also focused on bringing high-level visitors. And that included everyone from the Secretary of the Army to the Secretary of Commerce. And recently, I was very proud to have my dear friend Marco Rubio visit India for 4 days. And not only did he visit India, he went across India and to multiple places. So from Calcutta to Jaipur, Agra, Delhi, he had an incredible time. The President and I were with Prime Minister Modi just last week in France at the G7, and Secretary Rubio was there. And the Prime Minister came over to the Secretary, and his first question was, how did you like Jaipur? And the Secretary was amazed by the history, the colors, the beauty of these incredible places, and promised the Prime Minister that he's actually looking into coming back before the end of the year for another visit to India. So I know I'm excited to have the Secretary back, and the word has gotten out around Washington. I will tell you, I was only in Washington 1 day last week, and I probably had 3 or 4 different cabinet secretaries that have all asked, when can I come visit? And so I anticipate having several more before the end of the year, and we're very pleased with that. I want to make an announcement here today. As the video mentioned, we were very pleased to have the Quad meeting in Delhi, and that's something we aim to build on. And one of the things that we're actually looking to do is, in about 2 weeks, all 4 of our foreign ministers will be in the Philippines. And we're looking forward to having a Quad meeting on the sidelines of the Philippines. And so that is not to take away from any of the other nations. Those will continue. We do aim to have a Quad meeting at some point, a ministerial Quad meeting in Australia. But in the meantime, in 2 weeks, we're hopeful to have this Quad meeting in the Philippines with all of our 4 partners. Results matter. Every single week, I tell my team, what is it that we're going to achieve for the American people? And what is it that we can identify that is a win-win for both of our sides? To everybody here, and I've met most of you and a lot of you in Delhi, but to everybody here, just know, the U.S. Embassy is open to you. The U.S. Embassy is open for business, and you are welcome to show up. And a lot of times people show up without an appointment, and we still figure out how to make it work. I try to meet with any business community individual that does show up, because it's something that matters deeply to me. I come from the private sector, as does the president. And so it's an incredible, gratifying thing to be able to create jobs here at home and identify those win-win situations for us all. As I mentioned, the trade deal, we're close to getting it done. Very active negotiations. I mean, pretty much the last 3 weeks we've had travels back and forth. Minister Goyal was in New York. Then we had the assistant USTR rep in Delhi, followed by Ambassador Greer in Delhi right afterwards. So again, our embassy is open to you. Please come visit us. Please let us know how we can help you. As the video and some other individuals here mentioned earlier, over the past 2 decades, our bilateral trade has increased from 20 billion to 220 billion. That's an incredible jump. And it's also something that we're gonna take to a much higher level. And so what President Trump and Prime Minister Modi announced is a bilateral trade goal of $500 billion over the next few years. That's an astounding number that is unmatched. We already do so much with India. India exports more to the United States than anywhere else by far. When it comes to defense exercises, we have more defense exercises together than any other country that India participates with. So to all those pundits that sit online and tweet and say this relationship is in trouble, when you look at the facts of where this relationship stands, whether it's trade, whether it's defense, whether it's the people-to-people ties, the relationship is on strong footing.
All right, so let's jump right in. I know you've got some time pressure, Ambassador. You mentioned embassies competing. I know you set the bar high for Congressman Bratt as he gets ready to go down to Australia, but you set the bar incredibly high with your A250 celebration in Delhi with Secretary Rubio. You had the president call in on the line. You somehow found a way to get the village people there. So you did set the bar really high, and I think you're going to be the envy of all your fellow ambassadors around the world for taking that bar to the really next level, celebrating America's semi-quincentennial. So well done there. You've had 6 months under your belt. You have a direct line to President Trump. So with that in mind, let me start with a couple questions. India is one of the fastest growing major economies in the world with a population of roughly 1.5 billion people. How do you think about India's trajectory today, and what does it mean for the U.S.-India reliance through the administration and well beyond the Trump administration?
Well, first I want to thank Jeff and Salil and all of our other sponsors that stepped in and helped make that celebration possible. And so I know some of you are in the room, IBM, Micron, Google. You care about this relationship and we appreciate it, you stepping in and helping us. You know, when I first called Jeff, I am a competitive person. I first called Jeff and I said, you got to help us with our sponsorship. And he said, well, we have an amount that we're giving to 5 or 6 select embassies around the world. I said, that's great, but we got to have more than that. I said, I don't care if it's $1 more, but I got to have more than London. I got to have more than the other embassies. And so to his credit, he delivered. So thank you for that. It's you care about this relationship. We care about Boeing, frankly. As
Thank
you
you.
know, that the president in every meeting, and this has nothing to do, by the way, with their donation, but in every meeting for the last 2 years, and I've been in a lot of them at the White House, when foreign leaders show up and meet with the president, Boeing is usually on the agenda because we care about Boeing. We care about taking you to the next level and making sure that these countries are buying the best and the most efficient planes in the sky. And so I can tell you, we've not spoken in a week, but it again came up with the Prime Minister because we're this close to getting another big deal done with India, and we're looking forward to bringing that across the finish line. Look, to answer your question, it's the limitless potential. The United States wants to work hand in hand with India. India's rise is here. India has arrived. We recognize that. We want to partner with India. I was with a minister in New Delhi a couple of weeks ago, and he said to me, he said, no matter what you hear in the news, 50 years from now, our two countries will still be friends. You're the world's oldest democracy, we're the world's largest democracy. And the second part that he added to that is, we have the same principles when it comes to democracy, which include robust oppositions, by the way. Not every nation has that. India's in a tough part of the world. There are some tough and rough neighbors. And you have individuals that wake up in a bad mood and things change in that part of the world. The United States and India have so much in common that is something that will sustain us for decades to come. With that said, we do see the opportunity that exists between our two nations. And as I mentioned, you pick the sector, AI, technology, aviation, no matter what it is, we have a potential to work together. And that's something I hope to build upon and set the stage for the next few decades. These next 2 years will set the relationship on a path for several decades ahead. And so for everyone here who participates in this, think of this as a long-term project. This is not a 1 year or 2 year, but what we sow now will continue to sustain us decades ahead.
Awesome, awesome. Hey, so let's shift gears a little bit, Ambassador Gore. You know the president very well. You obviously know how to get things done within this administration. How does it help you move the U.S. relationship forward, especially when it comes to cutting through bureaucracy, red tape, bureaucratic friction in the U.S. to make progress over the last 6 months, the next 6 months, and then the balance of your term?
I think the circumstances that place me in this position, in this chair, are very unique. And in my first year at the White House, when I was Director of Presidential Personnel, when a new president comes into office, there's 4,000 positions open. And it was that role that the president entrusted me with to fill those positions. And so today, when an issue does come up, I don't have to call 20 levels down. And there's no long process, because almost every secretary that we have in our cabinet is a friend of mine. I talk to Secretary Rubio sometimes 3 times a day. And you name the secretary, whether it's Scott Besson or Jameson Greer or any of those, I consider them friends, and they are friends. Some of them I've known for years before. So it's extremely efficient to be able to take that, to pick up the phone, and somebody on the other end answers. I'll give you an example. We had a group of American pharmaceuticals companies and Indian pharmaceutical companies, and they had some issues, and they just had things that were getting stuck, and have been stuck that way for several years. And as they're in my office, I was able to call Secretary Kennedy, and within a week, he arranged a video call where he involved 4 or 5 other people, including the heads of CDC, FDA, all these other entities that are involved in this. And so we do cut through red tape. And in a way, it's very similar to the way the president works. And also, by the way, the prime minister. I've seen the prime minister in action. Both of them are results-oriented. So if it takes somebody picking up a phone and calling directly, that's something that we'll do, and that oftentimes achieves a much faster result.
Awesome. Hey, in addition to knowing the president well, you also know how the inner workings of the White House churn. You've already served as special envoy across 11 countries, 3 of which, I might add, have become larger Boeing customers since you took the role. Thank you. Now you're focused on one of the most important relationships in the world, U.S.-India. Tell us what you're most focused on delivering next. You mentioned the trade agreement, but what comes after that?
So to your point, as special envoy, we've done some incredible things. I want to mention specifically Kazakhstan and Uzbekistan. I've visited all those countries, but in the last 9 months, both Kazakhstan and Uzbekistan have signed with the United States real deals, real tangible results, with each country signing over $20 billion in trade from the United States. It's Boeing, it's locomotives, it's Wabtec, it's Franklin Templeton. There's some incredible wins because this president, again, this is not me. This is this president paying attention to a region. In the White House's entire history, it was President Trump that organized a C5+1 summit and invited these 5 heads of state. And it's something we're going to continue doing. And it's President Trump, for example. We have the G20 coming up this December. President Trump invited the heads of Uzbekistan and Kazakhstan to the G20. That has never happened before. Within 24 hours of those invites going out, we had 60 other countries around the world calling the White House asking for an invite. And so the fact that the president is paying attention to this is delivering real results. What I see next, look, the trade deal is a massive thing. It's something we have to get across the finish line. And we honestly had the deal. The deal was done. Things have to change, and the reason things have to change is because the offset previously was based on IEPA. Now the offset is going to be based on something else. And so the trade deal is in place. Most of the items that we had agreed upon are there. Both sides continue to honor that. And it's just, but that one last percent, I'm telling you, we're going to have a big party that Mukesh is going to throw when this trade deal is in place. And I hope all of you will be here as we celebrate that.
Awesome, awesome. Hey, you also mentioned the importance of the Quad relationship. As you think about areas like space and cyber and AI, which are moving really quickly, where do you see the biggest opportunities for US, India, and other Quad members to work together in a way to strengthen our shared security objectives?
Look, I mean, the Quad is extremely important. And I just want to mention something, because a lot of individuals made hay over a name change. I don't care what name is on a letterhead, but look at what actually the United States is doing. And so, yes, the name changed. We're still there. India still has more exercises with the United States than any other country by far. Every single month, there's something happening, whether it's Indian troops coming here, whether it's US troops going into the region. Just this morning, I got another dip note on the next delegation from the Indian Navy. They'll be traveling here over the next, I believe, in the next 2 weeks. In terms of what we're doing with the Quad, we are very much focused on the maritime security. One of the deliverables that was announced in New Delhi was that the 4 countries will focus on building ports in the region. That includes Fiji specifically. And so we want to make sure that we're present in the Pacific, we're growing, we're enhancing our security, and we're working with trusted partners. And India is on that list, very high on that list, I might say. And it's one of those things we'll keep building upon. It's one of the reasons the Secretary wants to have this meeting in the Philippines in 2 weeks, followed by a meeting in Australia, and followed ultimately by a leaders meeting, which we're trying to nail down, that would include President Trump coming to India.
Great, great. Hey, let's shift gears just a little bit again. I've seen firsthand how you've supported the Boeing company, not just on the commercial side, but also on the defense side. Can you talk a little bit about your kind of results-oriented goal as you support not just companies like Boeing, but some of the others in the room, RTX, ExxonMobil, FedEx, and the important role they play in the US-India relationship?
Absolutely. I mean, some of the biggest companies in the world, right, are sitting right here. Raj from FedEx, Boeing, of course. There's incredible companies in this room and beyond, and they all touch India. And for us, we are results driven. It's one of the things I try to push across to my team every single week. Look, I'm not in Delhi for a long time. As you know, we're halfway through our administration, but I'm going to make my time there count. And it's one of those things we're going to do our best. We're going to deliver for the United States, but we're also going to identify those win-win situations. I have seen firsthand during the energy crisis, I'll give you an example. We had a company that came in without an appointment, and they said, we're trying to sell more energy to India from the United States. I said, how long are you in India for? They said, 48 hours. I said, okay. I said, that doesn't make it easy. I picked up the phone and called a handful of individuals. The next day, they had a meeting in New Delhi. Within 30 days, they had signed contracts for new energy exports to India. And that's an incredible, thank you. The reason I share that story is because if you don't knock, if you don't ask, nothing happens. And so I want to make sure everybody in this room also understands this. If we can help you in any way to get something across the finish line, sometimes things get caught in bureaucracy, as you know, on both sides.
Yep.
If we can somehow jump that and bring it to the right person's attention, please call on us. You will find an open embassy and a very receptive embassy to you. That's something that I've been trying to get across, and I think we've been very successful at that. We're increasing both our economics team at the embassy, our foreign commercial services at the embassy. So we'll continue building on that, and please call upon us if we can help.
Well, I'd say on behalf of everyone in the audience, just a big thank you for the support we get out of the administration all the way up to the president himself, members of the cabinet, folks out on the front lines, the ambassador corps like yourself. It's been a phenomenal.
And I'll share this with you. There's no deal that is too small. I've literally called the president sometimes in the evenings on something that is, I'm embarrassed to even say the amount. But if it creates a job here in the United States and we're able to sell this across, the president will pick up the phone and call on that company's behalf. And that's something that's extremely proactive that we've never seen on either side of any political party. The president will pick up the phone and call on company's behalf. And so that's an ask I'm willing to make of him. He enjoys doing it, frankly, because he comes from the business community. And so, as you know, I think I've shared this story with you. A couple of months ago, I was with the president at UFC in Miami. And we're sitting backstage. And he said to me, let's call the prime minister. And I said, sir, it's 6 a.m. in the morning there. He said, he'll be up. He's like me. He doesn't sleep. And so by the time we were able to get a hold of the prime minister, I think I reached out to Vinay and some others in Delhi. The president was already on stage. He got announced, so we scheduled the call for the next day. But the message there, the louder message of that story is when you're friends with somebody, not everything has to be scheduled. And the president truly considers the prime minister a friend. And when you're friends with somebody, you pick up the phone, you say, how are you doing? Not everything has to be scheduled 6 weeks in advance at 2 p.m., in the afternoon. And that is how he sees India. By the way, that's not what every leader in the world. I've seen leaders that we do schedule things because he does not consider them at the same level that he considers a prime minister. But his years with the prime minister go back to his first term, to his warm memories of India. And so that's an incredible benefit, frankly, to our embassy there.
Well, I would say in addition to calling heads of state at interesting times, he also calls some CEOs at interesting times.
He called both Boeing. He called the CEO of Boeing that same night, if you recall.
I do.
From the backstage of UFC.
Yeah. Hey, we're running short on time, but I want to just first of all thank you. But also, what are you doing? What are you doing for the America's 250th this week?
So I'll be traveling some with the president. He's going to be visiting some places earlier in the week. And then on the 4th, we have an incredible celebration here on the mall. So I hope everybody here is here for the week and is able to see that. There's going to be an absolutely spectacular flyover of things that you might have never seen before. So I highly encourage that. Also, the president will be giving a speech. There'll be several performances right here in the National Mall. So come one, come all, and bring all your friends.
All right. Awesome. Have a great week. Thank you for being here. And thanks for what you're doing for all of us in India.
Thank you, Jeff. Appreciate it.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Oyo parent Prism has filed updated IPO papers with SEBI for a 6,650 crore rupee public issue. Existing investors including SoftBank and founder Ritesh Agarwal will not sell any stake through the offering.
Digital lender Five has filed draft IPO papers with SEBI. The issue comprises a 750 crore rupee fresh issue and an OFS of over 4 crore shares, with proceeds earmarked to strengthen its lending business.
SMBC Asia Rising Fund has doubled down on India, making follow-on investments worth up to $15 million in fintech startups, Easy Home Finance, Vayana and DPT Zero, as it bets on financial infrastructure and inclusion.
Private equity and venture capital investments in India slumped 59% year-on-year to $2.1 billion in May, marking the weakest monthly deal activity since November 2023. Deal volumes fell 36% to 76, even as exits jumped 162% to $2.7 billion, according to IFCA EY report.
The new global CEO of WhatsApp, Kunal Shah, makes his first move, introduces usernames to allow people to chat without sharing their phone numbers. The move sparks some concerns over a potential rise in impersonation scams.
Those were the headlines that we're tracking for you this evening on What's Brewing today. Oyo's parent company has filed its updated draft red herring prospectus with market regulator SEBI, reviving its IPO plans. Now, the company is looking to raise over 6,600 crore rupees, with nearly 75% of the proceeds slated for debt reduction. Aishwarya Anand joins us now with all of those details. Aishwarya?
Well, after multiple attempts at going public, Oyo parent Prism is back with fresh IPO papers. The hospitality technology company has filed an updated DRHP with SEBI for a 6,650 crore rupees IPO, comprising only a fresh issue with no offer for sale. That means existing shareholders, including SoftBank, founder Ritesh Agarwal, Microsoft, Airbnb, Peak 15 and Lightspeed, will not dilute their holdings. Now, the biggest takeaway is the use of proceeds. Nearly 5,000 crore, or about 3/4 of the issue size, will go towards debt repayment, strengthening the company's balance sheet. The filing also highlights a sharp financial turnaround. For the first 9 months of FY26, Prism reported revenue of 6,941 crore, surpassing its full-year FY25 revenue. Net profit stood at 748 crore, while EBITDA more than doubled to 2,127 crore. But there are risks. Over 80% of Prism's revenues comes from overseas markets, leaving it exposed to global economic conditions and travel demand, especially in the US and Europe. The prospectus also notes that this is the company's first public issue with no listing track record to indicate how the shares may trade. The filing also comes after the Delhi ITAT quashed a 3,885 crore angel tax demand, removing a key legal overhang ahead of the IPO.
Thank you, Aishwarya, for those details. Appreciate you joining us. Also on What's Brewing, rising electricity bills, government incentives and the push for energy independence are turning residential solar into one of India's fastest growing consumer categories. And riding that wave is Solar Square, which has just raised $53 million to expand its full stack rooftop solar platform. The company has already powered over 50,000 homes and says India's energy transition will be one not just at the grid, but home by home. Joining me now is Shreya Mishra, the co-founder and CEO of Solar Square. Shreya, welcome to Startup Street. Residential rooftop solar, has been long considered a difficult business to scale because of high upfront costs, fragmented installers, and of course, customer trust issues. Yet you've raised one of the largest funding rounds in the sector. What's changed, Shreya? Has residential solar finally reached its inflection point in India?
Thanks for having me here, Shruti. So obviously, we always looked at rooftop solar as the future of home energy in the country. But 5 years back, in fact, in FY21, when we started residential solar, it wasn't as obvious, neither the market nor to other players or to investors. So it has been, the category has completely inflected. When we started in FY21, this was hardly a 2,500 crore a year market. This year, as we speak, this is, 6th year in FY27 is expected expected to be more than an 80,000 crore market. So the category is now unignorable. It's grown more than 30x. India has, has actually seen a solar revolution. We are the world's fastest growing residential solar market, and we are still less than 5% penetrated. So we still have a lot of headroom in this category, and that's what investors are seeing. The company has now raised over $100 million across rounds of funding, and this round happens to be once again the largest venture capital round in a rooftop solar company.
Okay, Shreya, like you mentioned, you've positioned yourself as a full-stack home energy platform. You manage design, financing, installation, maintenance, and in fact, one of your biggest differentiators is offering a performance guarantee. That's a bold promise. How exactly does it work, and what happens if a customer system doesn't generate the energy that you've committed to?
Right. So we're the first company in the country that eliminates all the doubt and anxiety from rooftop solar by actually guaranteeing performance. The guarantee works very simply, Shruti. A consumer, depending on his rooftop solar design, depending on his location, how much sunlight falls, we commit a specific power production to every customer of Solar Square. We now have 50,000 homes with a savings guarantee attached to them. And if there is any shortfall in the performance that we committed, we actually pay the customer back at 8 rupees per unit. So that's thereby removing all uncertainty and anxiety from the customer, and this makes their investment extremely secure because irrespective of what happens, a customer's savings is assured. And as you know, India is a very mileage obsessed country, so deti kitna hai is always India's
okay. Sure.
So a savings guarantee really strikes a chord with customers.
All right. Let's get to the fresh capital, Shreya, that you've raised. I believe it will go towards expansion, technology, financing, and battery storage. If you could elaborate on the details, and also as rooftop solar adoption grows, do you see Solar Square evolving beyond solar panels into a broader home energy company, covering batteries, EV charging, energy management, and perhaps even virtual power plants?
Absolutely, Shruti. So the aspiration from the beginning has been to become the home energy brand of future India. As energy transition is evolving, Solar Square's business model will also evolve because as policies evolve, as batteries and all other technologies become more mainstream, that's where Solar Square will also grow. So today, most of our customers are going for a grid-connected rooftop solar system because India is the first country in the world to have made net metering a legal right. And so all our customers take advantage of net metering. But for India to have resilience and energy transition, batteries are going to be key, and that's also something we will get into. And virtual power plants, I would say maybe 3 to 5 years away for India. And when that happens, we want to be the largest player in the country.
All right, you're already run rating at over 1,000 crore rupees in revenue and have now crossed 50,000 homes. What are the next milestones we should watch in terms of revenue, profitability, number of installations, or market expansion? And Shreya, do you already have a roadmap towards a public listing?
Great question. So we've done 50,000 homes. It's taken us 5 years to get here. And this year, in our 6th year, we intend to solarize more than 50,000 homes in the year itself. So by the end of the year, we should cross the golden number of having more than 1 lakh homes powered by Solar Square in India.
Okay.
And end the year at more than double the run rate, so more than 2,000 crores in run rate. IPO, Shruti, maybe 3 to 4 years away.
All right, we'll surely keep a watch of that. The government PM Surya Ghar scheme has dramatically boosted consumer awareness. Shreya, how much of your recent growth has been policy driven, and how sustainable is demand if subsidies are eventually reduced?
Yeah, that's a great question, Shruti. We've been doing rooftop solar for 10 years.
Yes.
We've seen commercial solar subsidies go away. We've seen educational institute solar subsidies go away. And subsidies are always a mechanism for the government to boost a category. They are never supposed to be perpetual. And we don't believe that rooftop subsidies, even for residential solar, will be perpetual. But the economics of solar for a consumer on a standalone basis are great. The subsidy is actually added as an accelerant on awareness. And that's what has happened. And the industry is ready to, stand on its own without subsidies, very much like EVs. Post-subsidy.
All right, one final question before I let you go. Electricity demand is rising rapidly as India adopts air conditioners, EVs, and more energy, intensive lifestyles. 10 years from now, Shreya, do you believe every new home in India will come with rooftop solar as a default feature, much like, broadband or air conditioning today? And if that happens, how large could this market become?
100%, Shruti. We have 28 crore households with an electricity connection in the country. And despite India being the fastest growing resi solar market in the world, we still have only 0.4 crore homes powered by rooftop solar. So this category still has a lot of headroom for penetration. And we do believe that this is going to be a way of life. Every new home will come with, a provision for rooftop solar. And India doesn't have coal or oil, but we have a lot of sun. And we are a very energy hungry country. So we'll make good with the power of the sun.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Shreya, for joining us on Startup Street, and wish you the very best.
Thank you so much, Ruti. Thank you for having me here.
And moving on, India's wedding industry is worth an estimated $130 billion, yet it's still one of the most fragmented consumer markets in the country. From venues and decor to catering and photography, couples often juggle dozens of vendors to plan their big day. Bangalore-based The Wedding Company wants to change that with a tech-enabled end-to-end platform that's already working with over 2,000 verified vendors, fresh off a 25 crore rupee fundraise, and after more than doubling its service order value in the last year, the startup is now looking to scale even faster. Joining me now to discuss this further is Pawan Gupta, the co-founder and CEO of The Wedding Company. Pawan, thank you so much for taking time out and being here with us on Startup Street. You know, India's wedding industry, as I pointed out, is worth $130 billion, right? Yet it sort of remains highly fragmented. What was the biggest pain point you set out to solve? And how are you using technology to bring structure to an industry that is largely operated offline?
I think, as you rightly pointed out, I think we're sitting on a mammoth opportunity of organizing the most disorganized sector into organized sector. So I think the problems that we faced was making sure that we have KYC of our suppliers, right from venue, decorators, photographers, makeup, artists, and so forth. There's warehouse visits, there is inspection, there is scoring, there is training, there is contracting. These were not there in the market. So we were the first ones to do it. And then we were able to get the top of the suppliers, the top 1% to 10% of suppliers, and make it in an easy to form, easy to use format for consumers in the mobile app and web app. And the TWC, the Wedding Company platform, is very simple. It works like how Blinkit would work or how Urban Company would work. That's what consumers want today, and that's what we do it, for consumers. So all the hard work off the ground, actually, but it just in a very simple to use format where you can just go book venue, decor, photography, talk to the planners, project management, escalations. All you can do it on your phone itself. That's I think, a little magic that we try to create in the market.
So that's the magic you're trying to bring to these wedding planning for the people getting married. But you've raised this 25 crore rupees in fresh capital. Which part of the business offers the biggest opportunity here to create value today? Expanding your vending network, building new technology, or entering new cities? Where do you plan to spend your funds?
I think the biggest one will be the product development and category development. When we talk about that, everything should be, the catalog should be curated, personalized, the pricing has to be available, has to be there, the availability of the vendors has to be there. And you have to do it with all of these categories, like it's just not one. So that is the first, I think, major investment that we will do. I think the second will be the awareness part. So, we are expanding into the Meta network and YouTube network. Today, I think last year we delivered 500 weddings. This year we are going to deliver over 1,000 weddings at mega scale. Nobody does that, but we are the ones who does it in 8 cities of India today. So these are 2 big, I think, areas of investments that we are doing. Naturally, we'll be strengthening our vendor supply. For next 12 months, we are not opening new cities, but at some point, more cities in India and more international cities will be added.
So looking at international expansion as well over there. But, you've more than doubled your service order value from, as you pointed out, 51 crore rupees to 115 crore rupees in just a year, right? And you're now targeting this 350 crore rupee figure. What's driving this growth and momentum? Are you seeing more bookings, higher ticket sizes, or just a wider basket of services? What does this sort of mean for your revenue growth?
So ours is a premium brand. So our customers spend 45 to 50 lakh just on their weddings. I'm talking about just wedding event services. When you look into their commodity spend on jewelry and apparel, it goes to 80, 90 lakh rupees. So one is, I think, the quality of the segment that we have chosen. The customers who get, let's say, wedded in Goa, Jaipur, Udaipur, hill stations, Thailand, and plus we also do domestic weddings, same city weddings in Delhi, NCR, and Bangalore. So that is first. The second is asset-light model. So we don't own assets today. We don't own venue. We don't own warehouse or decor warehouse today. We have very strong SOPs, platform, training, SOPs in checks so that the quality can be controlled. And that is what is what our customers get so that the wedding happens seamlessly. Our weddings are rated 4.8 out of 5, star rating, which is consistently what we have been able to drive. So these two are driving the entire backbone through the platform that we have, packaged into just two things. I think a great consumer experience and I think a great vendor experience. These two are the key metrics to get there.
So that's your key metric. But then where do you stand in terms of profitability then today?
First, all cities are profitable. Number one, I'm talking about contribution margin. So we don't lose money on any single wedding. Yes, today on a company level, we are able to offset our corporate cost as well. I think at about 2x of the volume, not more than 2x, maybe 1.8x, we will be also profitable at the company level. I think our target is to get to 350 crores in the next 1 year itself. And I think that is the time we'd like to report an EBIT profitability as well, which is the break-even to positive status.
All right. And where is this demand coming from? Where's your strongest demand? Is it the metro cities? Because you did say it's a premium service, but are you also seeing demand coming in from tier 2 and tier 3 India? And what are the customer preferences at this point, and how are wedding budgets evolving?
So the guest size usually it used to be very, very big before, but I think we see about 200 people, 300 people guest size. In local same city weddings, in destination, we are seeing roughly 150 to 200 people. Our customers are across 20, 30 cities of India, and for the destination cities, we are seeing customers. 80% of customers are coming outside India, so they're from US, Canada, Dubai, UAE, UK, Singapore, Australia. So we are seeing an increased demand, coming, from these countries.
All right. So are those the countries you're looking to expand into? What are the new geographies you're looking at?
So today we are live in Thailand. When we see let's see a smaller wedding size of 100 people, then we recommend people to go to Thailand. But at some point, more South Asian, places and countries like Bali will be coming in, then Sri Lanka. Then you're looking to Dubai and UAE. I think those are international cities, which I think will be added to our catalog maybe in 12 to 24 months of time.
In 12 to 24 months of time. So that's the expansion plan you're looking like. All right, Pawan, thank you so much for taking time out and joining us here on Startup Street. And we wish you all the best on this journey going forward.
Okay. Thank you. Thank you so much for the interview.
On that note, it is time for us to head into a short break. But coming up next, US cybersecurity firm Enable has chosen Bangalore for its first global capability center. Details when we come back. Stay tuned.
Welcome back to Startup Street. US-based cybersecurity company Enable is strengthening its India presence with its first GCC in Bengaluru. The company says the center has been set up not as a support hub, but as an end-to-end product development center with teams building AI-powered cybersecurity, automation and data protection solutions for global markets. Enable also plans to expand its Bengaluru workforce by more than 50% by the end of 2026. CNBC TV 18's Meghna Sen caught up with Mike Adler, the Executive Vice President and CTO at Enable. Take a look.
Bengaluru already hosts GCCs of most global technology firms. So why did Enable choose Bengaluru as your first GCC, and why do you think now is the right time to make an investment?
Well, we made this investment. We're really excited to be here. We've made this investment really because Bangalore has this great innovative talent base that's developed. They're experienced. They know how to operate in product companies within larger organizations. And so when it came time to think about, we want to expand, we want to tap a new talent market, Bangalore became the obvious choice because we can gain access to that experience, we can gain access to that talent, we can gain access to folks who know what it is to innovate within a larger company. And it became obvious to us that Bangalore is the right place to do it. And even though there's many GCCs already here, we offer something different. We offer a type of company with a strong culture, strong values, and really an opportunity for folks to grow their careers and help small and medium-sized businesses be successful with technology solutions, cyber resilience and cybersecurity solutions, and have a greater impact. And so we're really excited because we can take advantage of the talent pool and give that talent an opportunity to have a direct impact on small and medium-sized businesses.
Speaking about the talent pool, you said that your Bengaluru team is going to expand by 50% or more by December 2026. So what kind of roles are we talking about here? And will it be just restricted to support or core product and engineering development?
Yeah, we actually are expanding our core engineering teams here. And actually, it's beyond engineering. It's our core product teams. We have product managers. We have architecture. We have cybersecurity specialists. We have AI developers. We have operators. So SaaS operations is here. The entire spectrum of product development, from its very beginning design and decision-making and ownership, all the way through the code development, the exercise, the process, and the operation of those products. Those are all done exactly here in Bangalore. And we're really excited about that because it really gives the India team the opportunity to contribute at a high level. They're not taking instruction from other areas. They're given a mission. Here's the business strategy that we want. Here's what we're trying to achieve from a business perspective. And now we can hand that to a complete team that can operate within a larger team, but operate independently to go drive that mission and go be successful. And they understand what the business outcomes that we're looking for. And so it's not support. Yes, we have our SOC here, and that contributes on a worldwide basis to all of our customers. Yes, we have other functions here, but what we really have is a contributing team end to end that solves the business problem.
Okay. As a NYSE listed company, how does Enable, how do your investors look at this kind of large-scale investment like the one you have made in Bangalore? And what kind of returns are you looking from this center particularly?
So I think, listen, our investors really want us to deliver business outcomes, right? We need to meet our mission. As long as we achieve our business goals and deliver the financial results, investors are going to be happy. And so I think they're looking at us and saying, listen, are you investing well? Are you investing intelligently in building the right talent that's going to allow you to deliver small and medium-sized business solutions? I think when folks look at it and you go, oh, look, Enable's expanding. They're tapping a talent market. They're tapping a proven, innovative talent market. I think investors are pretty excited about the idea that we're making the right choices at a business level, at a strategic level, to help us deliver results that are going to impact the bottom line.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC TV 18. Born in Mumbai, Jeetu Patel arrived in the United States as a 19-year-old with little money in his pocket, waiting tables at Sizzler for just $4 an hour. Today, he is one of the most influential Indian origin executives in global technology. After spending over 2 decades building and scaling enterprise software businesses, Patel was appointed President and Chief Product Officer at Cisco in 2025. Under his leadership, Cisco has accelerated its push into artificial intelligence, cybersecurity, and enterprise software, helping drive record-breaking growth in recurring software revenues and AI infrastructure demand. As businesses race to adopt AI, Patel's mandate is clear: transform Cisco from a networking giant into the software and security backbone of the AI era.
Hello and welcome to this edition of Young Turks. I'm Shireen Bhan. We're celebrating our 24th year at Young Turks and our 14th year of bringing you voices from the Valley. So it's our great pleasure to have with us on the program a man who's quite literally at the center of things here in the Valley related to all things AI and tech. The man leading products for Cisco, the CPO. Thank you very much. And President Jeetu, it's great to have you here.
Welcome to Cisco.
Thank you very much for having us. And wow, I mean, this gives a seat at the table an entirely different meaning, doesn't it?
There's a lot of seats at this table.
There's a lot. But are there really that many seats at the AI table today?
We just actually had our Silicon meeting here with our entire Silicon leadership team, and every seat was filled. But it was a fun day. We spent 2 days over here.
But what about the AI table? Is the AI table shrinking or is the AI table expanding?
Ever expanding.
Ever expanding.
Yeah.
What's the most exciting thing? I know you've been talking a lot about the fact that you believe we're in networking super cycle. And what does that mean exactly for all of us?
So as you and I have talked about before, we're moving from this world of chatbots to agents. And these agents tend to be far more consumptive in their network consumption patterns than humans are. So for example, we just did a study. An agent consumed about 450% more bandwidth than a human for the exact same task.
Because they're not sleeping.
They're not sleeping, they're working around the clock. And by the way, what is an agent? An agent is basically a file that actually describes the skills, a file that describes its memory. And so you have to keep making sure that those files get uploaded to the model. So there's a fair amount of kind of network bandwidth because of the chattiness of the system. So what we have here is an infrastructure that's completely going to need to be reimagined to accommodate agents. And we're not even at the physical AI realm yet, where the moment physical AI takes off in a big way, you'll see an even more consumptive pattern on that front. So the reason it's a networking supercycle is because you're going to see this not just in the data center. Now what you're seeing is these agents are also running on your desk side. In fact, there's a whole new class of computing called desk side computing. I don't know if it's actually been something you've talked about during your trip over here, but think about an agent not just running in the cloud.
Right.
You now have people saying, hey, I have a laptop for the human to work on, and then I have like a Mac Mini or a Mac Studio or an NVIDIA PC or an AMD PC, and that's what they call a desk side computer. And that's where the agents run. And you might have hundreds of agents running over there and doing and conducting tasks for you. And that's going to have an enormous amount of bandwidth consumption because for every human, you might have 10, maybe 100, maybe 1,000 agents.
Yeah.
And they're working 7 by 24. They're 450% more consumptive in their infrastructure needs. So think about what that does to the network, to the compute, to the power.
Yeah.
It's going to be enormous.
It is going to be enormous. So how do you reimagine the network when we're talking about this kind of surge in traffic and consumption? And what are the numbers telling us? I mean, what is the kind of traffic surge that we're already starting to see?
Well, I'll give you some numbers that'll actually just be completely eye-opening for you, which is if you think about our campus branch networking, which is what we call our workplace networking, in offices like this, when you have Wi-Fi access points, you've got switches, you've got routers, that business for us grew at about, it was pegged to inflation. It grew about 3 to 4% a year.
Right.
Last quarter, we had 25% order growth. So imagine that.
Yeah.
And that's not something that's a blip for a quarter. I think we can see sustained level of double-digit growth for a while. That's because of this kind of pattern shift that's going on in the architecture of the networks itself. So when you look at the numbers from the financial standpoint, there's a fair amount that's going to be spent on these networks because everyone wants to modernize their workplace. When you look at it from agents and what they're doing, every human is going to be a manager of agents. And we now have at Cisco our first product that is completely written with AI. No human lines of code.
At all?
At all.
Okay.
Humans will verify the code, but the agents wrote the code, right? By the end of the year, we'll have about 6 products that are completely written with AI.
Wow.
By the end of next year, get this, we will have 70% of our products that will be 100% written with AI. And in 2 years, Cisco will have no legacy code. We will have refactored all of our code. So when you start thinking about that level of implication on of agents on the workplace, there's going to be a tremendous amount that changes in the campus. Of course, we've been working with data centers, as you know, on the numbers. 3 years ago, there was barely any revenue with AI-related, kind of data center revenue. Last year, Chuck Robbins, our CEO, said, hey, let's make sure that we actually let the market know what we think we're going to be able to do. So we put out a number. We said we'll do $1 billion in year 1 in AI revenue for data centers. We ended up at 2.3.
Yeah.
So we said, next year, what do we do? Which is this year, this fiscal year for us. We said, let's do 5 billion. Let's double it.
Yeah.
We're going to end up at 9.
Wow.
And so there's this kind of massive exponential curve of increase in infrastructure. And then you add on top of that things like security because of Mythos and what's happening over there. And you see different models that are going to be there from OpenAI and from Anthropic that are going to be very, very potent. I think there's going to be a tremendous amount of emphasis placed with every class of customer we have, whether it be a hyperscaler, whether it be a neo cloud, a sovereign cloud, a service provider, or the enterprise, in completely kind of changing their architecture to go out and accommodate for these new patterns of work, the new ways that security is going to be implemented, the new kind of exploits that the agents are going to be participants in and drivers of sometimes, and they'll also need to be participants of the defense against the agents through machine scale.
Yeah. I'll address that and what you're doing on that front in just a second. But that was pretty mind-boggling what you just said, that in 2 years, all legacy code will be re-architected as far as Cisco is concerned.
There will be no such thing as legacy companies anymore. That's a thing of the past.
But what does that mean exactly?
So what does a company... But by the way, this is an interesting thing because legacy used to be where I, as a company, have actually enjoyed so much success.
Yeah.
And products have been used so much by so many people that I need to now make sure that I slow down my innovation so that I don't go, because I've accumulated tech debt over time.
Right.
And so large companies had a harder time in moving as fast and with the level of agility like a startup would. Now what's happened is we are starting to see that when you actually do write this code and you do have success in the market, you can continue to keep refactoring the code. So for example, in our security business, we had our firewall. I'll give you a couple examples. It's just mind-boggling. So we have our firewall management console. And what we did was we said, let's refactor the code here. 8 million lines of code. Within 6 weeks, the teams were able to refactor it to less than 1.5 million lines of code. So firstly, you've compacted the code. What does that mean? Performance is faster. It's more efficient. It's actually got less security vulnerabilities. The way in which we've designed the product can be updated faster. All of these things have a profound effect on the customer. And now, all of a sudden, our scale of being with all those customers, but being able to go out and innovate at a very, very fast speed becomes our very asset. And so I feel like as time goes on, you're going to have very little legacy code because everyone's going to write code using agents. And what you're going to then do, 1,000 engineers right now, I think in 2 to 3 years, they're not going to be writing code. So then the question is, well,
what are they going to do?
What are they going to do?
Yeah.
Well, they're going to review the code. And in a world where you can write anything, what you choose not to write and what you choose not to build is actually far more important. So the product judgment and the product intuition is going to be really important. The other thing that these engineers will do is they will actually be the front lines for our customers because they will help our customers adopt better. So every engineer will become a forward deployed engineer at some point for a certain percentage of their time. And so you'll see the configuration of the entire workforce change, where a product manager is going to actually become a product developer of some sorts. And the first prototype will actually be built by the product manager and the designer. The engineer is not even involved. The engineer gets involved in the architecture. And then the engineer is involved in the front lines with the customers. And so I think you'll actually start to see a workforce shift, which is very different from what we've been used to. But I don't think it's going to be around this notion that there's going to be fewer jobs. What I've started to see and observe is every single time we've seen a massive step function improvement in AI, actually the bottlenecks have been largely human. So when we have much, much higher volumes of code, now my bottleneck is code review. So I say, okay, I'm going to automate code review. My bottleneck then is going out and building a test harness. So I automate that. My bottleneck is going to be what kind of products do I build, and do I need to do the right kind of market research, and do I need to do deep thinking and apply intuition to it? So I think there's going to be a snowball effect, and I think you're going to need more people.
Really?
I think over time you will have a shortage of people that are dexterous with AI and have fluency in AI. Now, by the way, the gap between someone who is really fluent in AI and someone who is not fluent in AI is not going to be like a 10% productivity gap. I think it's going to be 50x or 100x. What does that mean? That means it's going to be very hard to justify someone who's not AI fluent to be in a job. It would be like saying, let's hire someone that doesn't know how to use the browser or the internet today. It would be an absurd concept in knowledge work. So I think that'll be an area that we'll have to make sure that collectively between public-private partnership, we will have to make sure that we raise the dexterity level of people with AI. But if you look at every single person that we hire today that is fluent with AI, they get paid really well. In fact, I would say if I was in my 20s getting paid that kind of money, I'd be in trouble. So they get paid really well. They have a tremendous amount of shortage of those people. And the value that they add is enormously high compared to what they're getting paid. And I think you're going to see more and more of the workforce get there. So there's going to be more of a demand, but there will be this painful period where the retraining of the workforce will require some displacement, and there will be some people that'll lose their jobs. I think every job is going to get refactored, and there'll be entirely new industries created.
Have we moved now to production cycles, production stage in companies, or is it still sort of, okay, let's sort of experiment and figure things out before we actually make those big calls?
No, it's completely a non-controversial issue at this point in time that chances are you're not going to lose your job to AI, you're going to lose it to someone that uses AI, but actually that's not even the most non-controversial thing. Now what people are saying is, if I don't use AI, I don't even know how I'm going to get my job done, right? And so that I don't think, now that's not an evenly distributed viewpoint yet. I think you go to different geographies in the world, it's different. I think we live in Silicon Valley, we tend to live in a bubble. That's why I tend to travel a lot, because I want to make sure I keep my pulse on the ground and like what is actually happening in the field with the customers. And what you do find is across every industry right now, there's a fair amount of momentum, but certain industries are doing much better than others. I think if you look at the life sciences industry and biotech, amazing levels of innovation happening over there. You look at financial services, crazy levels of stuff happening there. Software was the biggest industry. And by the way, in software, the thing that was really strategic in my mind is the fact that it started with this whole notion of, hey, I'm going to use software to write software. And you're going to use AI to write AI. That self-learning loop that got created has actually created an exponential curve that is a vertical line. And so that's why the time is so compressed. So I think it was a genius move to say that's the use case we should start with, because one, it had the most amount of data that you could train the models on. Two, the data was very quantitative in ways. So you could know right from wrong very quickly. There wasn't too many shades of gray. And now what you're starting to see is it's become almost a habit where we have to figure out ways that the use of tokens, in fact, we were recruiting a candidate recently that went to another company and then came to us. And I said, hey, why are you leaving there so quickly? He said, well, I went there and they weren't going to give me tokens. Like, I don't know what I'm going to do without tokens. That's like not giving me a computer to work on and saying code. And so that was his entire reasoning in 6 months for him saying, you know what, I'm going to throw in the towel there. That to me is very telling on the state of what the expectation is going to be from the talent pool. Poverty will get eradicated. Education will get evenly distributed. Those are things that we never could have the audacity to think that those would actually happen. And I think those things are going to happen.
But is that optimism real? And what do you base it on?
I base it on the level of exponential progress that we've seen in the past 3 years specifically. And there's a snowball effect. And that snowball effect is creating not just a high rate of improvement, but that rate of improvement continues to keep compounding and getting faster and faster and faster. And now you have this completely, kind of reinforcing self-learning loop where these systems are building themselves and they're learning. And every single time you ask it a question, it's not only answering you, it's learning from you in the way that it's answering the question. And it just keeps getting better and better and better. And that over time, if you just extrapolate that, most people have a hard time thinking exponentially. We all think very linearly.
Yep.
When you have to start thinking exponentially across multiple different domains, it's actually just humanly not a very intuitive thing to do. But just start thinking about what happens if 4 or 5 industries simultaneously start showing that exponential curve of improvement. What happens to society? Capital flows easier, healthcare gets better, education is actually going to be, like the amount that I can teach myself today compared to what I could teach myself a decade ago is night and day different. Night and day different. In 2 weeks, I am almost a different version of myself every single time. And it's not just me, everyone's that way.
Yeah.
Like we're all learning at a very fast pace. So that's good. Now, what I do think is important is not forgetting the fact that we can't leave behind people in this because that'll cause suffering. And I do feel like that's an area that Cisco is very concerned about. And so what we do is we partner with governments all around the world. We've got tens of millions of people all around the world that we try to make sure that we get up to speed from an upskilling perspective. We had this network academy that we called NetAcad, and now we've added AI programs to it. We've added cybersecurity programs to it because that propels the economy forward.
Since we're talking about opportunities and we're talking about not leaving people behind, I also want to understand from your lens and all the work that Cisco's been doing in India for several decades now, on how confident and optimistic you feel about the role that India is likely to play in all of this. I think the natural assumption is that India should play the applications layer and that is our strength and that should become our competitive moat. How do you see it?
So my take on India is maybe it's a little biased because I came from there, right? And I'm just fascinated by the pace at which the country has developed and grown. And I think the entrepreneurialism that the public sector has shown over there, because like every single time I go to India and I meet with government leaders and, Prime Minister Modi and others, I feel like I'm talking to startups. And they're very keen on, like, I'll give you an example. Like one time I was with Chuck there and we were talking about some export control license that we were trying to, get approved. And that conversation that we had with some of the ministers was very much around, hey, what do you think is broken? How do we need to fix it? Let's make sure that we actually talk about it. Immediately, few people got on it. And by the time we had landed in India and what the issue was, by the time we left India, the issue had been resolved. And I think that level of entrepreneurialism in public sector is very rare to find. You're now starting to see that in many governments, and that speed and scale, you're seeing it in the US, you're seeing it in India. I think that speed and scale is going to be really, really important. And I'm superbly optimistic. I also feel like India has a demographic advantage, which is almost unheard of compared to any other company because the size and scale of the population you have of people below the age of 30 that are in the workforce. I mean, it's a superpower of India, and you should be able to take advantage of that. And like I said, if you assume that there's going to be a human shortage of talented pool of workers, India is in a tremendous advantage.
the other mega trends that you're focusing on as the CPO, as president here at Cisco, that you intend to double down on?
I'll give you like 4 or 5. First one is robotics. I think physical AI is going to be pretty huge. And you will see, I was at an event recently with TSMC and their, you know, our partner for manufacturing chips. We make our own silicon. And a lot of the presentations that were there at that event, I was keynoting, others were keynoting, were around physical AI. So physical AI is actually here already, just unevenly distributed. So I think that's a pretty important trend. And that's only going to actually change, because you can't just change the world as dramatically as you want to only with software. You need to have the physical dimension factored in. That's one. I think there's going to be models beyond large language models that'll need to feed physical AI, like things like spatial models and world models. Those are going to get much, much more prominent in the next 3 to 5 years. And by the way, there's a shortage of data on that one. So just like language models were pretty easy because you could take large swaths of data that, you know, were human generated data, publicly available on the internet, and train the models with. With physical AI and spatial models, harder to do that because you don't really have readily available spatial data. So you have to go out and generate synthetic data. But you're starting to see great advancements in synthetic data for training models. So that entire field will get to be pretty interesting. One big area that there's a huge shortage is power, right? We will see tremendous amount of advancements in power and efficiency of the use of power for terrestrial data centers on Earth. But you'll also see tremendous amount of demand and movement towards suborbital data centers in space. And so I think the SpaceX IPO tells you a lot about like the kind of momentum that can create. But that'll be an area that you'll see. Because why is that the case? Because you will have 90% of the apparatus in Iraq is cooling apparatus from a weight perspective. In space, you have a very different way that you can actually go out and handle cooling. The energy is 30% more potent in space with the sunlight and solar is 30% more powerful in space than here. And the sun never sets, which means you don't need to have batteries. You can actually just get round the clock, you know, kind of powering of the sun. And now you've got payloads that can be taken up on a very regular basis. I think Elon's talking about like a spaceship every hour being launched with a payload. If that were to happen, you actually have a tremendous amount of promise in space. We're not quite there yet today. I think you ask some people, they say 3 to 5 years, might be 5 to 7, maybe 7 to 10, but it's definitely going to happen within the mid to long range. So that's the other piece. I'd say quantum is going to be a big one because of the way in which you'll actually be able to do computing, which is going to be at a very different kind of scale. And you're now starting to see quantum networks. In fact, we have a quantum entanglement chip that we just recently announced that is still in the labs, but it doesn't require, you know, kind of cryogenic chambers to go out and do this stuff. You can do this in room temperature, which is pretty cool. And then what you'll find is a ton of application layer advancements that'll get made in the future around this stuff, which is what specifically do we need to do to innovate in every business process that you have in every company to be rethought and reconfigured and recalibrated. I think that's where you're going to see the most amount of effort. Eventually, infrastructure is great, but it's only as good as the applications it delivers. And you will start seeing a lot of value in applications being delivered.
When you're not working on your desktop or whatever else that you're doing, retail therapy, that's your gig, isn't it?
I am very consumptive in my patterns of, I do feel like Apple should give me like a certain amount of credit because part of their EPS might just be my consumption of how much I consume.
Who else's EPS are you boosting?
I think every shoe manufacturer, every clothing manufacturer.
You're not the monk who sold his Ferrari, right? That's not what you're going for.
But I will say this: my family, my better half is extremely kind of simple.
So you're making up for that.
I'm making up for her. I'm like, you know, I need to. And my daughter is actually, oddly enough, turned out to be. She judges me. There was one time when we were sitting down, and I'm like, she came to one of my keynotes and she said, "Hey, Dad, like my friend thought you were cool." I'm like, "Oh, thanks. Did you think I was cool?" And she goes, "Yeah, but you do a lot of stupid shit."
Well, keeping you grounded. You can count on daughters to do that. But Jeetu, it's been an absolute pleasure. Thanks so much for joining us on Voices from the Valley, and we wish you the very best of luck. As you said, you're just warming up here at Cisco and ready for the AI era. But thanks for your time, and thank you for very comprehensively giving us a glimpse into what the world is looking like and the kind of re-architecting that's going on at companies like yours. Appreciate that insight.
I appreciate you coming to the US, and you're welcome here anytime, and we love having you here.
Thank you so much. Well, with that, it is time for us to wrap up this edition of Voices from the Valley. Do send us your feedback. We always like to hear from you. We'll be back with more headliners and newsmakers. Till then, from all of us here, goodbye, and many thanks for watching.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about a year and a half ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is
and
absolutely.
And how do you plan for it?
Absolutely. Everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is one is it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to like work more hours, we're going to invent more days of the week, like while those things they would be nice, they still probably won't keep up, right? So a lot of it is really making sure we are adapting faster and faster. And so that is a lot of how you kind of change the team dynamic. So one is making sure we do have time to learn, to observe, to be curious with our customers. Two is making sure our iteration cycles are very fast, right? So we don't do, for example, planning over a really long period of time, because you can go and make a plan for a roadmap for 6 months or a year, and
grabbing the headlines, but data is powering the revolution. At the heart of that transformation is NetApp, a $30 billion intelligent data infrastructure leader, helping enterprises unlock the value of their data across cloud and AI. After a landmark year driven by record financial performance and growing enterprise AI demand, CEO George Kurian believes data, not chips, will define the winners of the AI era.
When we last spoke, which was about 3 years ago, it was all about the cloud. And now it's all about AI. What do you make of this massive transformation and shift that's taking place?
I think it's built on the foundation of large-scale digital technology being available with an important couple of other ingredients. One is sophisticated computer models, and of course, the ability to harness the power of large amounts of data, which is where we come.
Your thesis on data being at the center of everything is proving right today.
Thank you. Yes. We've long held the view that in addition to talent and understanding your business or your clients deeply, data becomes the competitive moat of an industry. You know, everybody has access to the same chips, everybody has access to the same models, and the models themselves are largely trained on the same data. And so your ability as an organization to deeply understand your business, your clients and employees using your data becomes the competitive mode.
So that is the competitive moat, as you point out. But I want to understand from you, it's been what, a little over 10 years for you here at NetApp. So you've seen many cycles. What is specific to this particular wave that we are seeing, the AI wave that everybody wants to get on top of? What is different this time around?
I think it has the promise of a platform shift in a broad sense. Certain industries are already experiencing that, digitally intensive industries. I think for that